Hello viewers, welcome back to our CPA House Cafe accounting tutorials, and today we are going to look at the golden rule of accounting, and we are going to basically look at what it means. And we know the golden rule of accounting is also known as the double entry. So the golden rule of accounting, the golden rule. We want to look at the golden rule of accounting. So the golden rule of accounting is also called the double entry rule. That's what we call the golden rule of accounting. And allow me to take off my video so that you can be able to concentrate on the work that we are going to go through for now. So the golden rule of accounting, or what we call the double entry. Now, this is the rule that directs us on the entries that we are going to make. It's the rule that is going to guide us on the different entries that we are going to be making as far as our transactions are concerned. So the golden rule, it is basically the rule that guides the use of recording. So the golden rule, it's basically the rule that is going to guide us. It's going to guide us in our recording of entries. In our recording of entries in accounts or in the books of accounts, especially the ledgers. That's where we are going to put more emphasis to be able to demonstrate the golden rule of accounting. And this rule was developed by an Italian person. We looked at him in the history of accounting, and he was the one who developed this rule. It's called FLA. It's by names of FLA. It's called Fra Luca Pacioli. So this is the person who developed this system in 1491. That's when he developed this, as we saw in our history of accounting, because we looked at how accounting came into existence, and we spoke about this person because he's the one who wrote the arithmetic, the book that was all about arithmetics, geometry, and other proportion stuff. So is the man who introduced this same rule. Now, but according to this rule, it says that for every transaction that you do in a business has two issues. It has a debit side and a credit side point of view. In other words, this rule looks at the sense that every transaction or every business transaction has to pass through what we call the same double entry. But in the sense that we spoke about what a transaction is, and we said a transaction is something, it's It is something that we are going to do, but it's supposed to be financial in nature. Now, what is going to happen with a transaction is that you are going to exchange money, and the other person is going to give you what you are buying. So there are always two things. There is a receiving end and a giving end. If you go to the shop to buy something, you give your money, they give you the goods. So you give out the money, they give you the stock. So there is always two-way. A transaction is like, it's an exchange transaction, but it's supposed to be having something to do with the monetary terms. So that's why they are saying that every transaction or every business financial transaction has to pass through the golden rule of accounting. So once a transaction goes through that, then we can say that we can see the effects to both parties. And for this person said, Pastorioli said that every transaction affects each of the parties to the transaction. It has a double effect. In other words, there is a double effect between the parties at each transaction, all the parties to the transaction. If there is a transaction that you are involving in and that transaction has monetary value or can be quantified in monetary terms, it has a double effect on each side of the parties to that transaction, and that's what we call the double rule. Now, the double rule, it has a double impact or a double effect. The impact for each party that is involved to a given transaction must record the transaction twice in their books. For example, if let's say I'm a seller of books and maybe I sell to you a book. I have a book, let's say I sell it, let's say $10. Now, if I sell to you this book, for you, you are going to give me cash or whichever mode of payment, but you are going to pay. You are going to pay almost the same amount. You are going to pay exactly how much I'm selling the book. So each side, you are going to be the buyer, then me, I'm the seller. Now, what they are saying for the double effect on each party, they are saying that on every transaction, the transaction we're dealing in is a sale of a book. When I'm selling my book, maybe for $10, what is going to happen is that each of us is supposed to record that information twice in their respective books. If I'm the seller of the book and I sell a book out, let's say the price is $10. The first effect that I will be having as a seller, it will be in a sense that I've lost the book. That is the first effect. I've lost the book. And the second is that I have gained the cash. It's like we've done an exchange, but this exchange is in monetary terms. We've exchanged, I gave you the book, you gave me the money. So there are two effects in each and every transaction. Now, what is going to happen on the side of the buyer? Because me, I'm a seller, as a seller, I've lost the book, but at the same time, I've gained the money through selling that book. In other words, instead of me having the book, I have $10. That is the implication. So those are two transactions on the side of the seller. Now, we want to look at what What are going to be those two transactions or the double effect from this same transaction? I've sold the book to the buyer. In the books of the buyer, what is going to happen? Now, on the side of the buyer, we are also going to have a double impact or effect, whereby this buyer is going to be gaining the book, is getting the book or gaining the book, is getting the book, but at the same time losing cash. In other words, his or her bank account has reduced, but he has gained a book. So you are going to see that you are gaining the book, but at the same time you are losing money by the fact that you are buying the book. Therefore, every transaction has a double effect on either side, on the either side of the parties that are involved to that transaction, whereby each party must do the double entry in their respective books of accounts. And that's what we mean by the double entry rule. Now, the double entry rule states that, unless we can have, maybe we can have the rule itself. So it states that every debit entry must have a corresponding, every debit entry must have a corresponding credit entry. Every debit entry must have a corresponding credit entry. In other words, if I've debited a given account, I must credit the other account. And also, because even the vice versa is true, but I'm not just going to say and vice versa is true, but and also every credit entry must have a corresponding debit entry. So that's the double, the rule in full, the golden rule of accounting. They call it the golden because it's the one that is guiding the entire accounting. Without understanding double entry, it's like you are just wasting time. Golden rule of accounting. So if you don't understand the golden rule or the double entry system of recording transactions, then you can't manage to do the accounting. So for every debit entry, we must have a corresponding credit entry. And also, for every credit entry, you must have a corresponding debit entry. So just like the way I've told you in the example of where you are selling a book to a customer, both of you are supposed to record transactions twice, or to record an effect twice of that sale of a book. So that's the golden rule of accounting, where for every debit entry must have a corresponding credit entry, and every credit entry must have a corresponding debit entry. That's it as per the rule. So it means that for every transaction that happens is we are supposed to record that same transaction twice. So using that same just example that I gave of a book, where if it is lost, then I must record to show that I have lost it. At the same time, I will record to show that I have gained the money. Therefore, the double entry rule simply means that for every transaction that occurs, then I have to do a double recording, where one, we are going to have one in a separate account to reflect the first effect, and the other in another separate account to reflect the second effect. Now, looking at what I have just said, I also want to add that double entry recording is done in accounts, because for what they are saying, that for every debit entry must have a corresponding credit entry, and these entries must be done in accounts. But we can't just proceed if at all we don't know what accounts are, or what accounts is all about. So we need to first understand the concept of accounts before we proceed to do the double entry rule. So let's look at what is an account. If at all we understand that, then we can be able to proceed to the next level. I know we must have encountered an account somewhere, and we must have explained it in the previous videos, but we are going into we are going to give it a detailed background of what an account is all about. So I want us to know what is an account. It's really important to know what an account is. Now, we need to understand what an account is all about. And this takes us to another subtopic under the golden rule. But remember that I told you that a ledger, we looked at ledger in the previous video. So a ledger, as I told you, we said a ledger is a principal, is the main principal book, is a principal book of accounts, book of accounts. Now, it's in this ledger, or it's in this book, in which we do what we call the double entry. We always do the double entry within this ledger account. We looked at the different ledgers that we have. So we do the double entry recording. And we said when you're recording in these ledgers, we call it posting. And not forgetting that I told you that a page of every ledger is divided into 2 columns, and each page is the same as the other. We can have maybe this as our page, the whole of this. Now we can say that it has columns that are equal. May not have a straight line, but at least we know. So this is a column, and also this is a column. So what we are meaning is that this, if this is 20%, even this one is 20%. Meaning they are equal, they are in proportion. If this is 100%, even the other side is 100%. Now, you see, once you look at this as your page, your page within a book, you understand that we have divided it into 2 equal sides. And now we are putting a bar at the top. Let me use it. This bar at the top, we are putting it there just to show, to illustrate how an accounting is all about. Now, once you have divided it and you have put a bar on top, that becomes a ledger. Because a ledger is going to be for a given, a ledger is just the whole book where accounts are. We said that a page of any ledger is what we call an account. An account is a page in the ledger book. But a ledger looks like a T account. It looks like a T, capital T. So it is in the form of a T. And that's what we are trying to make here. That's why we are putting a bar on the top to form our letter T, capital T. So every page of the ledger is going to be an account, meaning every page that we are going to be seeing, we are going to be having this. It's going to be looking like this, with a bar at the top, then with these sides being divided equally. Now, accounts, we've said, is basically a page of a ledger. And you'll see that every account is in a T form. It has the left-hand side. The left-hand side, this side, is the one that we call the debit side. And then the right-hand side is what we call the credit side. Now, on the top here, we always put the title of the ledger. If it is a sales ledger, we just say we just come and put sales up here, meaning it's going to be a sales account. So whichever it may be. So we said we put something here. If it is a sales, we put sales account. But we've said that the left-hand side is the debit side and the right-hand side is a credit. It's also called the credit side. And what we mean is that, what we mean by the fact that for double entry, they are saying that for every debit entry, whichever you've made here, should have a corresponding entry. But that if it is a debit, then it's supposed to have a corresponding credit entry, but it can't be in the same account. So it means we shall be having 2 accounts, whereby this one is going to be debited. Let's say we've debited that, then the other account is going to be credited. And what is going to happen is that we are taking the information. If this is a sales account, we've, let's say it may be cash or bank, then what we are going to do, maybe we have received, we have, let me use something that has a debit entry, because this one, the sales doesn't have a debit entry. Let me just use an expense, rent. We've paid rent, and maybe we paid by bank on a given date. So what you are going to do, if this is your rent account, then we are supposed to say if we have paid cash, then the corresponding entry is the one that is going to be here. So we shall come to the cash account, and since the money that we have is reducing, we are going to put here, it is reducing in the names of rent. So you are seeing this account here is reflecting here. That's what we mean for every debit entry. And we are also seeing that this account here is actually showing here. The implication is that when you're debiting this account, the corresponding entry shouldn't be debited, it should be credited, but to the other account. You can't say that this is rent, then you just come and you put the figures here. It will be wrong, because we are supposed to have a debit this side and also credit on the other account. Then the reverse is also true by saying for every credit entry. Now, if let's say we have sales here, sales, so we can say maybe we have sold by cash. We've made a cash sale. We are going to credit this account in the name of cash. We put the amount there. Then we come to, because it is a credit entry, it must have a corresponding debit entry. So we shall bring that value here. But it's supposed to be in the name of sales, so that this account aligns with this, and also this one aligns with that. So that's the double effect that we are trying to talk about. So that's what I'm trying to pick out. So let's try to understand what an account, before we first illustrate the account, what the account is all about, before we go into start doing the numbers or doing computations. Now, we've said that for every debit entry, you must have a corresponding entry. In other words, whatever a debit side, like whenever you record on a debit side, you must find another account where you are going to credit. So if you have a debit side and you are recording on the debit side, then in a given account, maybe the sales account, whichever account it may be, you should go to another account and do the credit side recording. So we said at the top of the bar, that's where we have the name of the account. So if we say that we record cash on the debit side, then you also put the figure for cash on the debit side, or on the left hand side of the cash account. If we just go by the other topic, the other example which I gave, the one for selling a book to a given person, let me just give you something small. Let's say I've sold a book of $10, $100 to James. Now, what is going to happen is that I'm an accountant in this business. The business is the one that does the selling of books. So I'm going to open two accounts. James is our customer. So I'm going to open, we've seen that this person paid by, let's say even if the person didn't pay, you sold the book. So once you've sold, meaning we've gotten, as a business, we are recording a sale. The other side, in the James, who is the customer, we are going to put James here. The account is going to be for James because we've not seen whether we've paid by cash or James paid by cash or by bank. Meaning, if a transaction is just open like this, it means it was sold on credit. So what is going to happen is that this is we, the business. We've lost the book, but at the same time we have received money. But in this time round, we've not received the money, but we got a receivable. Otherwise, if we had received the money, we would have put a cash account here. So what we are going to do, since this person didn't pay us, we are still demanding him. What is going to happen is that we are going to come here to write the sales. We are going to put James's name. We say James, maybe $100. If we had the dates, we would have started with the dates. So for every, now you see, this is a credit entry, meaning we must have a corresponding debit entry. It's going to be in the James's account in the names of sales of $100. But you can't come here, since you have already a credit entry, and you also come and you put it this side. It won't make sense. Now, if this person, if James pays us, what is going to happen is that we are going to have two accounts where his money is reducing, or his money is going to be reducing, but he's going to be clearing himself from the obligation that he has with the business. So we shall look at some of those entries as we go on. Now, as I said earlier, that an account is a page of a ledger. A page of a ledger is what we call an account. Let me hope that you have understood that one at least. And now that we know what an account is, that it is a page of a ledger, but we also need to understand why we conduct, or why we usually record these transactions into those accounts. So an account, we said, is a page of a ledger, but why are we recording this information there? So the information we are going to be recording in these ledgers are going to be the records of transaction related to persons or property. It can be a person, it can be a property. So you will see that accounts will always be related to a person or a property. And we have two broad classifications of accounts. We have the personal accounts and then the impersonal accounts. So we said that the ledger is a page. Say the ledger is a page. It's a page. Said an account is a page. An account is a page. Is a page of a ledger. Is a page of a ledger which records transactions related to a person or property. So any account is going to be, that's the definition of an account. So you will see that the accounts will always be related to either a person or a property. And there are two broad classifications of accounts. When we talk about accounts, I have two broad classifications. We have the personal accounts, and then we have the impersonal. Just like the way we have personal ledger account, personal ledgers, and impersonal ledgers. So we have looked at, when we looked at the definition of an account, we saw that it's only prudent to understand that once we record transactions relating to persons or that are relating to properties, then we have the two broad classifications. Then, of course, we have to understand that the accounts that are going to be related to personal accounts will be related to persons, and the ones that are impersonal accounts, they are going to be those accounts that are going to be related to properties. So these impersonal accounts are going to be related to properties of business organizations. And those are the two broad classifications of accounts. But now we need to understand what are personal accounts and what are impersonal accounts. First of all, let's look at the personal accounts. Personal accounts. Now, a personal account is an account that is kept for a person. Is an account that is kept for a person. That is kept for persons. But I want to clarify something, that in financial accounting, we talked about persons. And when you're talking about persons, we are not just talking about human beings, but we are also referring to the business organizations. Because we said, as per the business entity concept, we say that business organizations have a right to exist separate from their owners, meaning they can own their assets, they can be sued, they can also sue, they can also be liable to the different liabilities that may be there in their capacities. So persons, we are basically looking at the natural person, and at the same time we look at the artificial persons. So an account of a person can be in your book as a creditor, can be in your book as a supplier, or can be in your books as a debtor. So persons may be debtors or creditors, and there is no other way you record an account of a person except when that person is a debtor or that person is a creditor. But when it's a business organization, we can have, because we've said the creditor can actually be a human being or a business organization. Even a debtor can also be a business organization, or you can actually be an individual person. But when it comes to the impersonal accounts, we say these accounts, these are accounts that are going to be kept for properties. But you have also to understand that there are two different types of properties, where we have the tangible properties, the properties that we may keep can have the tangible properties, or we can have the intangible properties. So however much the impersonal accounts are properties, but properties are going to be categorized into those that are tangible in nature and those that are intangible properties. So this means that these impersonal accounts should be split into two broad classifications, whereby one will be taking care of the intangible properties and the other will take care of the tangible properties. But the accounts that are going to take care of the tangible assets, the ones that are going to be taking care of the tangible assets, these ones, they are the ones we call real accounts. They are real accounts. They are going to be taking care of the tangible properties. And the account that is going to take care of the intangible properties is what we call the nominal account. So when we talk about the impersonal accounts, we are basically looking at, we are going to split them into the real accounts and then the nominal accounts. So we have three main classes of accounts. So from what we have discussed, we've seen that we have three main types of or main classes of accounts from the whole information that we've been talking about. We've seen that we have the personal accounts, we have the real accounts, and then we have the nominal accounts. And these nominal accounts and the real accounts are the impersonal accounts. Now, these impersonal accounts will not appear anywhere because the impersonal accounts have been split into real accounts or nominal accounts. So whenever we are going to be talking about the impersonal accounts, we are going to be referring to either real accounts that are going to be handling the tangible properties, or nominal accounts that are going to be holding the intangible properties. So maybe we can try to explain more on these classes of accounts. Now, we are going to break them. We are going to break down these classes of accounts. We've talked about the personal accounts, and these are going to be for individuals. Two, we've looked at the real accounts, and the third one we've looked at the nominal accounts. We need to understand these so that we can be able to apply the double entry system. So we have the personal accounts, real accounts, and then the nominal accounts. And these are the three broad accounts that we have. And we are going to define each of these accounts. Now, we said that for personal accounts, these are basically relating to debtors and creditors, because they are representing these debtors or creditors. They can be individual human beings or they could be business organizations. But the real accounts, these real accounts, we say that for real accounts, these are going to be talking about the tangible properties. And tangible properties are going to be things that we can actually see and we can touch. In other words, they have a physical existence. If, for example, a motor vehicle account, you can actually see a motor vehicle. If you buy a motor vehicle, then you are going to be able to see it and touch it. If it is a building, if it is a land account, if it is a cash account, whether cash is going to be at bank or is going to be at hand, because we can see it and touch it. But when we come to the nominal accounts, these nominal accounts are going to be handling nominal accounts. These ones are specifically handling intangible assets. Intangible assets. Now, for these intangible assets, these are going to be assets that we can't touch and we can't see them. So in intangible properties, we are not mainly meaning assets alone, but intangible assets, properties. When we talk about properties, we are not meaning assets alone, but we are meaning all those items. They could be expenditures, they could be income items. So it may be an income or expense item, because you can't touch an expense. You can't say I've touched rent. You can't say I've touched the electricity. So these are things that we are going to be seeing. So we may have salaries. In terms of expenses, we may have rent accounts. You can't say that maybe you have seen a salary or you have seen a rent. But what we can only see, if for example, for salaries, we can see cash moving in, meaning the money will be paid to your bank account. That's what we can see, but that's not a salary. Meaning the salary account, that can't be seen, but you see the money that has been paid to you. Even for rent, you only see the money you have issued out, like you have paid out, but not seeing the physical rent account. So the nominal accounts that we are talking about, or the intangible properties that we are talking about here, they could be income or expenditure line items. So if we talk about the salary account, is just an imaginary meaning. In other words, it's something you can't see. Even when you have been paid salary, the only thing you can see is the money dropping into your bank account, meaning you'll be seeing cash, but you won't be seeing the salary account itself. So we are going to be having a lot of properties or intangible properties. And these properties, they don't have exist. That's why I was saying, when we talk about the intangible properties, it's not that we are meaning assets. No, we are meaning properties that could be in a sense where they can't be seen, like insurance account. So we shall understand the nominal accounts, especially if we try to do some numbers, but just know these are things you can't touch and you can't see. But we are not basically meaning assets. So nominal accounts is going to be taking all those different items that can't have a physical existence. The reason as why we are focusing on this, by first understanding these three types of accounts, is it's going to help us find a way of how we are going to handle the double entry. So our three classes of accounts, we've looked at them. Personal accounts, those are going to be handling debtors and creditors. Real accounts, those are going to be handling tangible property, things you can touch and see. You have bought furniture, you can actually see it, feel it, and touch it. But the nominal accounts, those are things you can't touch. Like, for example, you can't say you've spent, you have a transport account, but you can't say I've touched transport. The only thing you will be seeing is the money moving out to clear the transport expense. So those are some of the things that we are going to look at. Now, we want to get the general rules or the general way how we are going to handle the double entry using these three accounts, because we said nothing else is going to be opened an account for other than these three accounts that we have mentioned. So remember, I told you that the double entry recording must be done in an account. And because we say that for every debit entry must have a corresponding credit entry, and all that is supposed to be done in an account. And we defined an account as a page of a ledger where transactions are recorded. Now, the biggest problem, especially to people who are just starting, who are maybe a little bit fresh in accounting, is that they don't actually know how even to apply the principle of double entry. And it is just something, it's just a rule that has been tested, whether you understand it, whether you don't understand it, but it's a rule that has been tested for over years. But we want to find a general way how we can understand what is supposed to be debited, what is supposed to be credited, by looking at these three types of accounts or classes of accounts. So I want to make the things a little bit clear, because this very topic is going to help us create a very good foundation for our understanding of a lot of things to do with the correction of errors, things to do with getting the suspense accounts, trial balance, and all other kind of stuff. So if at all you don't understand this, then it means even extracting the trial balance from these ledger accounts is going to be a little bit challenging on your side. So we need to find ways how we can make sure understand this topic. So what we are going to do, we are going to start recording transaction in these three accounts that we have talked about, which are personal accounts, real accounts, and then nominal accounts. But the question is, how do you record? For example, if I see an account like cash account, in other words, how do you know that this kind of transaction is supposed to be debited or credited? And that's the rule that we are going to decide, or that is the one that we are going to, that is going to get to guide us on what to do. But the good thing, we know the general principle or the general rule, which is the golden rule of accounting, that for every debit entry must have a corresponding credit entry, and for every credit entry must have a corresponding debit entry. Now, some rules that we need to look at, some rules that are going to help us break down the other double entry bookkeeping. Because if you just take it the other way and you try to understand it without putting in the aspect of these accounts, it will be a little bit weird, especially for those who don't have an accounting background. So we want to break down these rules, and we see if we look at personal accounts, what do we do? If you identify that this is a personal account, then what do we do? So let's now try to look at recording in those accounts, recording in their accounts. Now, if we take maybe, let's say, the personal accounts. If we take, let's say, the personal accounts, and then we try to create a special rule for these personal accounts. Now, it will be the same thing that we are going to do for the real accounts. And then for the nominal accounts. And what we are going to do is for this double entry rule, which says that for every debit entry must have a corresponding credit entry. We are going to find a way of how we are going to reorganize it into debits and credits. So it is the only way that is going to guide us to be able to handle each of these accounts. So we are going to use the debits and the credits. So let's start the rules. Now, the rules that we are going to use for personal accounts. Now, when it comes to personal accounts, we say that personal accounts, these are going to be accounts for persons. Now, the general rule is going to be the issue is going to be like these personal accounts, we are either someone is going to be receiving because they are going to be for persons. And we've said that the persons can actually be an organization, it can be a normal human being. But let's take, for instance, it is a human being. Someone is going to be receiving something and the other is going to be giving something. So there is someone who is going to be giving out and there is someone who is going to be receiving. Now, the rule that we are going to use is that we are going to debit the receiver, the person who is going to be receiving. We debit the receiver and then we credit the giver. So the person who is going to be giving out, we credit that person. The reason why we are crediting that person, because he's losing whatever is giving out. The other one, the receiver, is going to be, we are debiting that person because he's going to be receiving. He's going to be increasing on what they have. So whenever you see a personal account, just take this rule that for personal accounts, we debit the receiver and then credit the giver. So if you are selling goods, let's say we are selling goods to ABC Limited, for example, maybe for 10 million. Then this ABC is also a person. ABC Limited is a person, even though it's an artificial person. Then you have to ask yourself whether ABC is going to be receiving the goods or is going to be giving the goods. If you find that ABC Limited is receiving, then you debit. You debit its account. And if you find that ABC Limited is the one giving, so if you find that ABC Limited is the one that is maybe giving out or is the one selling, then it means that this ABC is actually the one giving out, meaning it's supposed to be credited. So the rule for this personal account is just simple. You just debit the receiver and then credit the giver. And that's the rule that we are going to use for personal accounts and nothing else. So that's how we are going to be recording these transactions for personal accounts. You just look at who is receiving whatever they are receiving. If it is money, who is receiving? If this person is receiving, we debit. If the other one is giving, we credit. Remember that personal accounts, those are accounts that are belonging to persons, and these persons are supposed to be creditors or debtors. We are not going to have anything to do with any other account other than those two. And not forgetting that we said that a person, this creditor, is the normal person. It can be an individual or a human being or a natural person, or it can be an artificial person or a business organization. So let's look at the other rule for the other accounts. So I've seen one, personal accounts. So now let's look at the real accounts. And we've said these real accounts, we've said that these accounts of tangible properties, meaning that they have physical existence. And because they can be seen and touched, then we can say whichever that falls in that category is supposed to be grouped under the real accounts. Now, since they can be seen and touched, it means that we can see them when they are coming in. We can also see them when they are moving out, because we can see them and we can touch them. So once we can touch them, we can know that this one is actually going out or it is coming in. So we are going to also craft our rule that is going to help us understand the double entry for the real accounts. So as we said that since something is going to be seen coming in or moving out, if let's say we buy a motor vehicle, we will be seeing it. It will come and park at our premises. Once we sell it, we will also be seeing it moving out. So if you are buying motor vehicle, then we can actually see it coming in, and if we sell it off or if we dispose it off, then we can actually see it going out of the business. However, real accounts are dealing with properties and not persons. These are supposed to be properties, not persons, because we said the broader classifications were personal accounts and then impersonal accounts. Personal accounts were dealing for persons. Then impersonal accounts, they are the ones that were dealing with properties. So here for the real accounts, we are talking about properties, not person. So you can't use a rule for real accounts if at all you are dealing with a human being or you are dealing with a person. So now what we are going to do for these real accounts, we are going to debit what is coming in and then we credit what is going out. So the rule is we debit what is coming in, then we credit what is going out. So if they give you a transaction relating to an asset, the question is that asset coming in or it has been sold off? Once it is coming in the business, we debit. Once it is going out, we credit. So that's the rule that we are going to use, that is going to help us work on real accounts. And whether it's going to be cash, whether it is going to be motor vehicle, whether it's going to be land, whatever it is, as long as it can be seen, it can be touched. In other words, the kind of item, the kind of property they have given you will help you to determine whether you're supposed to credit it or debit it. The only thing you have to ask yourself for real accounts is that, is it coming in or going out? And if it is coming in, you debit it. You debit the account. If it is going out, you credit the account. So that's it. That's the rule number 2 for real accounts. So let's look at the nominal accounts. Now, when it comes to nominal accounts, I told you that it's mainly expenditures and incomes. We explained what an expenditure is. It is different from an expense, because expenditure is just a broad category, but an expense is just a type of an expenditure. So it can be an expenditure or an income. And over here, things change a little bit, because the reason as why these things keep on changing is that you could see that for personal accounts, they were debiting the receiver and we are crediting the giver. In other words, for the personal accounts, it's like we are almost the debits were for a gain, and that's how literally it was actually showing from the other side. But if you look at the personal account, now if it comes to the nominal accounts, because we have things like expenses and losses, we are going to categorize it based on whether this is an expense or it is an income or it is a gain. So what we are going to do here, we debit the expense or loss. I was saying that for nominal accounts, we have some slight changes that may appear to be a little bit different from how we've been discussing this. Now, for nominal accounts, we said we have most of the things that we have expenses or expenditure. Expenditures and incomes. We also have equity, expenditure and incomes, and also equity components. So things here are a little bit different in the sense that when we looked at the personal accounts, most of the times we are debiting the receiver. And if we are debiting the receiver, it comes in a sense, it makes someone believe that all debits are going to be gains. Like if you are receiving something, we say we debit, because that's what we've been talking about in as far as personal accounts are concerned. But for now, when it comes to nominal accounts, things are going to be a little bit different. It's not that all debits are going to be gains, as we saw it under the other side for the personal accounts. But we need to see how, or what is the principle behind the nominal accounts. Because for these nominal accounts, the principle is one, that you are going to debit all expenses. In fact, there are expenses and losses. Debit all expenses and losses, and then you credit all incomes and gains. In other words, if you have a gains account, you're supposed to credit it. If it is an income account, something that is bringing in an income, supposed to be credited. So I'm going to explain why we are doing it in that perspective. But those are the basic rules that we have as far as the nominal accounts are concerned. We said nominal accounts are those accounts that are going to be intangible in nature, intangible properties. When we talk about properties, we are not necessarily meaning assets. We are looking at things which we can't see, we can't touch with our own, we can't see them with our own naked eyes. So now, and I pray that you get actually these rules, because if you don't actually get these rules, it's going to be a little bit disturbing. And as a matter of fact, if you don't really understand these rules, then it will take you more time to be able to do the practical simulations, because this is what we are going to be using to help us drive whatever we are going to be doing. It's the one that is going to guide us even on the next sessions that we are going to be having, because we are going to be recording transactions in accounts based on these same rules. So you must understand, and we are going to look at the practicability of these rules. And someone may be wondering, like, for the nominal accounts, why are we debiting incomes? Like, why are we debiting the expenses and we are crediting the incomes? Because someone may be saying, if you go by the other aspect of the personal accounts, you will be seeing as if debiting incomes is like a positive variable, is more of a positive aspect. Someone may be wondering, why are we not debiting incomes and crediting expenses? Because for them, when they look at expenses, it's like, for them, their expenses is just a release of money. But the key point is that however much the other one looks a bit to be as if incomes are something that is positive or a positive variable, yet we are crediting it. And I want to tell you something that, like, for example, if let's say we are paying rent by cash of, let's say, 1 million, the two accounts that are going to be affected, we are going to have the rent account and then the cash account. So what you have to first know is, by knowing, is a cash account is going to be falling under which class of accounts. Then rent account is going to be falling in which account, in which class of accounts. So you have to just know that if I'm looking at the cash account, that one I just know it is a real account, because I can actually see the money I have at hand, even when money is in the bank, it can actually be seen. But now if you look at the rent expense, you can't see it. You just know it is a nominal. It is a nominal account. So what we will be doing, it will be like we will open these two accounts. We have the rent account, and we have this cash account. But we've said, if let's say we paid in, it is in 1,000, just remove some 3 zeros up here. Now what we are going to do for such a transaction, you ask yourself, is rent account a personal account? Is it a real account or a nominal account? You conclude that it's a nominal account. And we said nominal accounts, the issue is if it is an expense, we debit it. If it is an income, we credit it. So since rent is an expense, we are just going to say debit rent account. So it is going to be rent account. We are debiting it in the name of cash, because we are spending money by cash of 1 million. Then, of course, the corresponding entry, as long as you have identified one account, if you have known, if maybe you know very well that cash account is a real account, and you know the rules for real accounts, then you just record that. Then of course the other one is going to be the corresponding of whichever account that you've looked at. Now for rent account, we've debited because it's an expense and it's a nominal account. So the corresponding entry must be credited to the cash. And if you look at it from the cash perspective, real accounts, we said if something is coming in, we debit. If we were receiving money, we would have debited our account. But since money is moving out of the business, but through paying rent, then you can just say credit cash account in the name of rent, 1 million. So you just need to know one account. If the criteria is for you to first identify the two accounts, because we said the double entry system has a double effect or has a double impact on every party to a given transaction. It gives the person double effect, or the impact comes when it is two-sided. That's why we are saying for every debit entry, we must have a corresponding credit entry. Then the reverse is true. So after identifying the two accounts, then the next thing to do is to draw the two accounts that you have identified. Then the other thing is to know which type of account is it. If you can't identify, then you will have a problem, because you'll find yourself you can't know which one to credit and which one to debit. So rent account, a nominal account, and the cash account is a real account. So once you've known those, then you can be able to see if we are paying rent with cash as a business. Because now, when you're answering some of these transactions, you have to make sure that you are standing in as the accountant of the organization. You are the accountant of the entity in the question. Because someone, if at all you don't position yourself to be in the organization, you may see it differently. But if you look at rent, that it is us, the business, that is paying out money to settle a given expense. So you position yourself as if you are part of that organization that they have given you in the question. That's the only way you will be able to see it in a clear way. So the starting point is always on the side of the business. Because if you look at it in the side of the business, you'll be looking at, in a sense, that if you are paying rent for our premises, then it means cash is going to go out, or whether cash is going to be coming in. And that's the first thing that we ask ourselves. Are we paying out or cash is coming in? And the rule for real accounts, we said we credit what goes out, and because cash is going out, then we are going to credit the cash account by that 1 million. But it should be in the name of rent, since the money is going out to pay the rent. So once you know one entry, then the other, the reverse is true. As long as you can identify one account and you know how you can be able to give its rule. If I've identified that this is a nominal account, then you can. Because if I look at rent and I can tell that, I can basically tell that this is an expense. So if you can know that, then you can say we debit it. And we are debiting it because it's a nominal account. And the rule for nominal accounts: debit all expenses and losses, credit incomes, all incomes and gains. So that's basically what we wanted to look at. We can have something small, just like the one transaction. We see how we can be able to interpret it. Can say maybe KC group sold goods worth shillings 150 to James, and bought goods on credit worth shillings 200,000 from KK Limited. Now, this is the case that we have. It's not a simulation. We are going to look at simulation as our next idea, but we want to just sort this small example. We see if at all we can be able to apply what we have got. So KC Group sold goods worth 150. It is, we have KC Group, they are selling goods worth 150 to James. And the same company, KC Group, bought goods on credit worth 200,000 from KK Group. Now, the first thing you do is to identify the two accounts. In any transaction, you first identify the two accounts. Now, in this small illustration, we have two transactions. We have when KC Group is selling goods worth 150 to James. And also we have the same KC Group buying goods on credit from KK Limited. So we have two transactions. We are going to work on one by one. Now, the first one is when KC Group is our first party. KC Group sold to James, and the amount was 150. No, that is our first transaction. Here we are selling, they are selling goods to James worth 150. Now, in this case, we can see that one of the entity, because these are personal accounts, we have Casey Group as a person, even though it's a natural person. Remember, we said these persons, someone can, according to the business entity concept, the company is going to be different from its owner, so it can stand on its own. So Casey Group is an artificial person, but we have James, who is a human being, meaning these are personal accounts. And we say the rule for personal accounts, we debit the receiver, then we credit the giver. Now, in this scenario where Casey Group is selling goods to James, we have James is going to be receiving. James is receiving goods. And at the same time, we are seeing Casey Group, which is the company, is the one giving out. So since James has received goods from Casey Group, then what we are going to do, we are going to debit the James's account with the amount of 150, because the other Casey Group is going to be losing out. So what we will do to them, we shall just be crediting. So the two accounts, we are going to have where James is receiving the goods, but since the company is losing out the goods, but these goods, they are going to be losing them out, but they are going to be receiving the sales as a business. So if you identify in this category, if you can identify that James is a person, just do one entry. The rest will be the opposite. So when you open the account, James's account, because it's going to be a data, it's going to come in the name of sales of 150, because they have not told us whether this person paid money or he didn't pay. But since they have not told us that this person paid, it means they must have sold, the company sold to him on credit. So we get the sales, the business will be having the sales, but the other guys are going to be, James is going to be receiving the goods. So put under the sales, we credit it in the names of James, 150. That will be the entry. But you don't take it to be in a sense that the other company, since it's giving out, you credit the company. No, this one is coming in as a sale. And you know our sales are going to be like, we are more of receiving income. Sales accounts are going to be, they are going to be nominal accounts. Now the other is this last part where Casey Group is actually buying goods. So if we are buying goods for the purposes of reselling, we say we have gotten purchases. So the two accounts, since we are buying goods, we are going to have purchases, and then since we have not paid, we are going to have KK Limited as the other account. So in the books of KC Limited, we are positioning ourselves as the accountants of KC group. That's why for us we are more of recording the purchases than taking the name of the company. So in our books we are going to record them as if we have received purchases or goods that we can sell out. So you identify one item. You just know that this KK Limited is going to be is a personal account, because it's a company that we are buying on credit and we are creating a liability to the business. So you just know an account, then the other you'll be knowing. So you create two accounts, the one for purchases and KK Limited purchases. So KK, since it is a personal account and is the one losing goods to us, meaning for him is giving out, and when we are giving out we credit. So we shall come to KK Limited, we credit it in the names of purchases 200,000. Then we come to purchases. Of course we take the corresponding entry, as long as you have gotten one account and it's right. The other, just take the corresponding entry. So we come to purchases and we debit it with in the names of KK Limited 200,000. So if it was issues to do with cash, we said that cash, we don't open an account for it. Those purchases that were in cash, we paid money, those ones go to our cash book, but we don't open ledger accounts for something that we have sold or we have purchased on with our own money. So that's it. So we shall look at a broader number maybe in the next lecture, then we'll be able to adjust. Hello viewers, welcome back to our YouTube channel, and today we are going to continue with our series on financial accounting. And the topic for today, we are going to continue from where we stopped last time. Last time we looked at the double entry or the golden rule. So I want also to continue with our double entry, but this time around we are going to pick a practical question so that we can be able to go through the double entry and be able to understand how we can be able to post transactions to their respective ledger accounts. That's what we are going to do from here. So we are looking at double entry. We are still looking at the double entry rule. And this is part 2. Because in the part 1 we explained what are the things that we are supposed to know. We looked at the different rules under different accounts. So the double entry rule, and this is our video number 2 on the double entries. So as I said, we are going to look at a simulation and we'll be able to see how we can be able to post the different business transactions as we may come across them in different past papers. So this is going to be something that is very basic, just to help us understand how we can be able to post the different entries in the different ledger accounts on the different accounts that we looked at. Because we saw in the previous video we talked about the accounts that we have, where we looked at the personal accounts, and then the impersonal accounts. We looked at within the impersonal accounts, we had two things. We had things to do with the real accounts and then the nominal accounts. Then the personal accounts, of course, those are the debtors and the creditors accounts. So that's what we are basically going to look at. So without wasting more time, let's dive in and look at the simulation of what we are going to learn today. So allow me to take off the video so that you can be able to concentrate on the screen. So we are looking at a simulation with these different business transactions that I want us to use to enhance our understanding of double entry rule. So the simulation, so we can have something to do with maybe June 1st. This is our transactions. Started a business with cash of 10 million shillings, 10 million. That is our first transaction. The second transaction happened on June 2nd. Opened the business account, the business bank account with shillings 6 million. Then the third transaction happened on June 4th. On 4th, bought goods on the 4th, bought goods on credit from Mark at shillings 1.5. Then on June 6th, bought goods by check, at shillings 1 million. Then on June 8th, sold goods for cash to Tony at shillings 800,000. Then on June 11th, paid rent by check 500,000 shillings 500,000. Then on June 14th, returned goods worth 300,000 to Mark. Then on June 16th, the owner took 100,000 of cash for private use. The owner took shillings 100,000 of cash for personal use. Then the last one, maybe you can look at only those. We paid Mark his account. We paid Mark his account in full, less 10% discount. 10% cash discount. So let's now look at the solution. That's the question that we have. So those are some of the transactions that we are seeing, and we want to look at how best can we be able to solve this question and be able to post in the respective accounts. Now, this is a sole trader's business. It's an example of a sole trader business, and the person started the business, and we are going to look at the different transactions that occurred day by day. We start by looking at what happened on June 1st, because they told us on June 1st they started business with cash of 10 million. So we want to understand what this means. Now, so the first transaction, if I may write it here, started business with cash of shillings 10 million. Meaning this is the money the person started business with. Now, this transaction means that the business started operations from 1st June, and then it started that business with a cash of 10 million. Now, I told you that whenever there is any transaction, then we are supposed to open what we call the ledger accounts for all the transactions that happened. And these transactions, we said that they are supposed to be monetary in nature. And as you've seen, all the transactions have been assigned a given monetary value. So whenever there is a transaction, just like what we are having here, started a business with cash of 10 million, the first thing you have to do is to first identify the two accounts that you are going to open for every transaction. Because I told you that double entry recording means that the transactions will affect each other twice. So there is always what we call the double effect of each transaction. In other words, each transaction is going to affect the two entities twice. There is always a double effect. And thus we are going to look at for those two accounts where we are going to see their double effect. So it means for every transaction that you see, every business transaction, one, it's supposed to be monetary in nature. Two, it is a must, you are supposed to identify two accounts that you are going to open. And why is it so? Is because of the double effect of the double entry recording or double entry system. And the next thing that you are going to do is find out whether we are going to be debiting a given account. We find out which account are we going to be debiting and which account are we going to be crediting. So first, you've seen a transaction, and this transaction should be monetary in nature. 2, you identify 2 accounts in each of the transactions. 3, you look at which account are we going to debit and which account are we going to credit. So you are supposed to know which accounts are we going to credit and which one are we going to debit, because we are sure that for every debit entry, we must have a corresponding credit entry. And that's why we ask ourselves, which accounts are we going to debit and which account are we going to be crediting. So once you have known those ones, then you go ahead and do so, you apply. So we've seen the first transaction, started business with cash of 10 million. Now, what are the 2 accounts that are involved in these transactions? And obviously, there is one, we have the cash account. That's an obvious. The cash account is there. Now, whenever you say transaction that is saying started a business, then just know the only thing that will come to your mind is going to be the capital. Because once you start a business, the money you inject in at the start of the business, we know that is the capital you are starting with. So whenever they say started business in any transaction, it means that they have introduced in capital. So the 2 accounts that are involved in such a transaction, we have, first we have identified the cash account from here. Then the second one, we have known that we have, this is the first, then the second is the capital, the capital account. So the 2 accounts are capital account and the cash account. However, sometimes you will not be able to see this kind of thing, cash, and they will just started a business with 10 million. And whenever they say started a business with 10 million, definitely that is going to be cash, except when the examiner is telling you specifically that 10 million was put in the bank account directly. Then it can be capital account and then the bank account. But if it doesn't specify, then it's supposed to be cash account and then the capital account, because we assume the money you are going to start a business with, you must have it at hand first before you transfer it to the bank. You are supposed to first have it. So what we are going to do is we are going to open 2 accounts, the capital accounts and the other account is the cash account. So let's open the 2 accounts. I'm just going to make them small as possible so that we can be able to incorporate in all these transactions. I'm just going to show you how they are supposed to be done independently. Then at the end of it all, we shall see how we can combine them with other accounts, because I want you to first understand the concept. So we have opened our cash account and the capital account. And once we have opened these accounts, then we show the currency sign. Now, these figures, they are in 10 million, but according to the space that we have, you can shorten them, and maybe you work in thousands. We can put the currency side there, currency there. That's where most of the times we put our currency sign, our figures, and also the currency. You can also put shillings in thousands. You can also put shillings just to show the currency, shillings in thousands. The other, you can choose, this is the most preferred way, but if you see maybe the space, but I know you'll be writing somewhere, so the space will be enough. You can put it up here. You put shillings in thousands, but when you put it there, then it means it's going to be the most, as I said, the most preferred way is to put them inside that T account. But just for a matter of spacing, you can put it up there if at all you're just practicing. But for examination purposes, make sure you put them inside. So we show our accounts. This one is going to be our cash account. This is shillings. Then this is capital account. The name of the account is supposed to be on the top, on that bar. So you pick which one you are taking. So as I said, the other one is the most preferred. So we are going to go by what is in there. Now, we've put the currency signs, and we have also eliminated the zeros. We are working in thousands. Now, we have a debit column and a credit column. We've said that the left hand side of the T account is what we call the debit side. So this one, we are going to call it the debit side. This is the credit side of each account. This is debit, this is credit. So we have identified those ones. In an exam, even if you don't put them there, but since we are doing it for the first time, I'm trying to put everything as possible. Now, the next question that we are going to ask ourselves after identifying the accounts that we have is which of these two accounts is supposed, which one is supposed to be debited and which one is supposed to be credited. And looking at both of these accounts, we need to know which class of accounts are these and what's the rule. Remember, we looked at the classes and we also gave their rules in the previous video. But whenever there is a transaction that involves cash, then it is always advisable to look at it from the cash point of view or the cash side. So if you have seen that we have a cash account in a transaction, then you have to ask yourself whether is cash coming in or cash is moving out of the business. And that is going to inform you of the entry that you are going to be doing in the other account. So as long as you can identify one account and you know where it falls, then you will be able to know how you can be able to work around the other entry. Therefore, looking at the cash and the capital accounts, you will see that once you introduce in cash into the business, then it means that cash is going to be coming in. And remember, we said cash is a real account. Cash falls under the class of accounts of real accounts. So for real accounts, the rule is debit what's coming in and credit what's going out. So we've seen that cash is a real account. And once we introduce cash into the business, it means cash is coming in into our business. So once cash is coming in, then we are going to debit cash. And once you have debited cash, then automatically we are going to credit the other capital account, as long as you can identify one account and you know it very well that this is a real account and its rules are these: debit what is coming in, credit what is going out. So what we are going to do is we are going to debit the cash account and then we credit the capital account. So as long as you can identify one account correctly, the other will be the opposite. Because once you have known what to do with one account, because we said for every debit entry, there must be a corresponding credit entry, and vice versa is also true. So, but what you need to know is that most of the times when there is introduction of capital, when you are introducing in capital into the business, if you look at it from the capital point of view, whenever we are introducing in capital, we always credit the capital account. And I will explain it why it's done in that perspective. But for now, we are looking at it from the cash point of view, or from the cash account. And we concluded that cash is coming in, and we shall debit cash with 10 million, but it will be in the names of capital as the narration that we are going to put in the corresponding account. So we come here, we put the date. If we had a year, if the year was available, we would say given that year, but they have just given us June 1st, we are putting in capital of 10 million. But we are working thousand, so we are going to write 10,000. But according to my space, it's not enough. One thing I want you to learn is that whenever you are writing the dates within these accounts, they are supposed to be written in this format. You start with the year. This is the correct format that we are supposed to follow. You start with the year. Then you put the month, and then finally with the date, with the day. The reason as why we are taking it in this sense is that we always do accounting for annually for a given period. So it means most of the times, I'm not saying it doesn't change, but most of the times the year will remain fixed. So since the year is not going to be changing, it's better we start with writing the year, followed by the month. Even the month will not be changing most of the times. So if the month is not changing, we first put what is going to remain fixed, then the one which is nearly going to be fixed, which is the month, but the day of the month will keep on changing. So once they have given you a year, let's say we are writing in 2020. So it will be 2020 if it is we are doing it in June 1st. So that every time you are writing, you will be writing 2020 June 1st. But the next transaction which came, let's say the next transaction came on 2nd, you are not supposed to write all this and this. You just put 2nd. If the month changes and maybe that transaction happened on 1st, you just add just this. You just put June, but you don't write the year again, because the year has already been written. So that's one way of saving time, not writing too much, but you are being organized. Remember, these accounts, we are supposed to be neat whenever we are filling in this information. So I hope you have got that. Now here we are just working in only 1 month. It's going to be June. You start with June 1st. When you are going to the next transaction, you're not supposed to write June again. You just put the date second, because you used a correct format. Now just imagine if at all you had started with first, then June. It means every time you are going to be writing a transaction, you are supposed to write it, all of it. You can't say you put 2 here and here you don't write. So the other side looks more professional. I hope that one helps. So this happened, can put it here, June 1st, then capital 10 million. Then I come to this side, I also put June up here, 1st, cash. It's going to be in the account of cash, 10 million. I'm writing 10,000 because I've already wrote the 3 zeros up. That's how we treat that first transaction. So whatever we've just done, we've made sure that we've recorded the cash, but we looked at it from the cash point of view. And I also explained how the dates are supposed to be handled. So that will be done. We shall look at how we close off the accounts. But since there are transactions going on, but as I said, I'm going to be handling transaction per transaction. I'm not going to combine all the transactions at once. No, I'm going to show you how you should handle each transaction. Then at the end of the day, I will show you how you can merge all the transactions and you have few accounts. So if you want to close off this account, you just close it off. You know the normal way we've been closing them off. I'm closing them off because we are dealing with one transaction at a time. We are not going to combine, even though the question is combined, but we are not going to combine them. I first want you to understand. So you put here the 10 million, that is going to be 10,000, even here 10,000 because this side is bigger, even here 10,000, even here you'll have the 10,000. So you bring your balance carried down. This one is going to be done at the end, 30th June. Balance carried down is going to be 10,000. We shall look at balancing off these accounts, and you also bring the balance brought down this side of 10,000. Even this one, balance carried down of 10,000. You bring the balance brought down of 10,000. So this will be the figure that will be taken to your trial balance. We shall look at those. Let's first finish filling in these transactions. So we look at number 2, the second transaction. Transaction 2. Second transaction says opened business bank account with 6 million. Opened business bank account with shillings 6 million. Now, opening a bank account means that some of the cash that we had started with will be transferred to the bank account that we have just opened. Because you know, when you're opening a bank account, it means you're supposed to keep their money. You don't just open the bank account and you just leave it like that. You may be required to deposit some money or to leave with some money, especially if it is a business account. And even opening itself requires some money. You incur some costs when you're opening these accounts. So they are saying opened business bank account with 6 million. Now, we are seeing that we have two accounts that are involved. We have the bank and we also have the cash, because this is the transaction that happened next. But at first we started the business with the 10 million. But now if they are telling us that they opened the business bank account with 6 million, the issue is they are not introducing in more money, but they use the money they had already gotten in cash of 10 million and they put the 6 million in the bank account, meaning that the other side it is only remaining with 4 million. We shall do accounting equation and we'll do some of these practically to see how we can reduce this. But let's first understand how we can post these transactions into the different ledger accounts. Now, I have said that there are two accounts that are involved here, the bank account and then the cash. Even though cash is not mentioned in this transaction, but it is the cash that we started with. It's the cash that we started the business with that we are partly using to open up an account. Therefore, this is cash and bank as our two accounts. So the two accounts are cash account and bank account. So those are the two accounts. Now the next thing after identifying the two accounts, we need to know which class of accounts are they. Now, if we are doing if we are going to combine doing this question at once, we wouldn't open another cash account because the cash account was already opened at the start. But as I said, we are going to first understand how to deal with separate transaction. Each transaction we are going to look at it individually. After we have understood that, then we can combine the question and then we extract a trial balance. I hope you are getting the reason as to why I'm saying so. So we are going to open two accounts here, the cash account and the bank account. But I'm repeating that if at all we are doing this question as a one question, we wouldn't open another cash account because the cash account was already opened in part one or in the first transaction we opened it. So since we are doing it independently, we open two accounts. We have the cash account and then the bank account. We put the currency. You're working in thousands. You can also put shillings in thousands, but according to the space is small, so that's why I'm putting only this. So this question we are doing is requiring us to open two accounts. One of the account was already opened, but we said that we are opening these financial transactions independently. We are first dealing with them independently. So that's why we opened two accounts. Now, after that, we need to know which one of these two accounts is going to be debited and which one is supposed to be credited. And we know that cash account, since there is cash, we said it is a real account, and also bank account is also a real account, because one, cash can be in two ways, can be cash at hand or cash at bank. So both of these are cash account, they are real accounts, or accounts that are relating to tangible things or tangible properties. And we said properties, we don't necessarily mean assets. So you go to the previous video and you watch this to be able to understand this. So we are now making the application of the rules that we created. Therefore, from here, we need to ask ourselves, which of these two accounts is going to be giving out and which one is going to be getting. So from here, we are saying that one of the account is getting money and then the other is giving out money. One is getting cash, then the other is giving out cash, since they are all real accounts. Now, once we are talking about cash moving in, we are transferring cash that we have to the bank. It's like we are banking cash. It means that cash is going to come into the bank account. And by the rule of real accounts, we say that we debit what is coming in and then we credit what is going out. So this transaction happened on 2nd. So since the bank account, we are receiving money, we are going to debit it. So it's going to be June 2nd. Let me use a different color so that we can be able to isolate. So let me just put here June 2nd, we are receiving cash. As I said, for you, write it the whole. You start June 2nd, then you put cash. But since I don't have space, I'm just going to write, I'm going to ignore the dates. So here I'll put the cash of 66 million. So since I've taken the other 3 zeros up, I'm going to write 6,000. So once you have debited one account, then it means there must be a corresponding entry on the other account. So since this is a debit, we are going to credit this cash account in the name of bank. The name of bank with the same amount. So that's what we are supposed to do in that account. So on June 2nd, we debited the bank account in the name of cash of 6 million, and when we went to the credit side of the cash account, we credited it with the same amount on the same date. So you are saying that this account here, the account I have here, corresponds with where the transaction is coming from. Even when I look at this, it shows me where the transaction is coming from. It is coming from here. I hope you can be able to recognize that. So that is going to be done, and that's what we call the double entry. As long as you know one side, then the other is going to be the corresponding entry. But we can't have a debit and a debit. That can't happen. So that's what we are supposed to do. Then you close off this account. Because I said we are closing each account individually. You know the rules of closing accounts. You look at which side is bigger. This side is bigger, 6,000. Then here is going to be the balance carried down of the same amount, 6 million. Then also this one, the total is going to be the same 6 million. So here we bring our balance balance brought down of 6 million. We do the same thing here, even this one is 6 million, the total 6 million, then the balance carried down is going to be 6,000, then the balance brought down will be 6 million, 6,000. So this figure is the one that we shall take to our trial balance. This one, the brought downs, they are the ones we take them in their respective sides. When you are taking these values to the trial balance, we don't consider the double entry. We don't do a double entry that what is on the debit side you put it on the credit. No, you take it the way it is. If this is the cash account, if this is bank account and it has a debit balance, you take it as a debit balance. If this is a cash account and it has a credit balance, you take it, the brought down is on the credit side, you take it on the credit side. So that's how we are going to be doing some of these things. But remember, I said we are separating these transactions individually. If it was mixing the other transactions, this cash account wouldn't appear again. We would only open the bank account. Then we would have taken this account to the other side where we had already opened. But since I said we are working transaction per transaction, then that will be done. Let's look at transaction number 3. The next transaction happened on June 4th. On June 4th, and they told us they bought goods on credit. Goods on credit from Mark. From Mark at shillings 1.5. So we need to goods on credit from Mark. So we need to see how we can handle that. Now, the two accounts that are involved here, we have, because it's the goods that they are buying, and we said when they are buying goods for the purposes of resale, they are called purchases. So the first account is going to be purchases account, and then the other account, because I told you that purchases are for goods that are bought for the purposes of resale, meaning they are purchasing stock, and that's why we are saying we have the purchases accounts. 2, we shall also open Marker's account. You have to note that we are only opening Marker's account because it's on a credit. It's a credit, say a credit purchase. So since it is a credit transaction, then we open Marker's account, and Marker is a human being. But if it was a cash transaction, then we wouldn't have opened a purchases account and a cash account. Of course, we wouldn't open Marker's account if at all they had paid him by cash. But since these were bought on credit, because we said you can't open a personal account if at all the person you sold to paid cash, or you bought goods and you paid cash. We don't open personal accounts, but we open cash accounts, and then we represent the purchases. I hope you remember those principles that we spoke in the previous videos. So if it was cash transaction, Marker's account wouldn't appear anywhere, wouldn't appear in our accounts. But since it is a credit, then we are supposed to open that as Marker's account. So the second account is going to be Marker's account. And these symbols are actually recognized. This one, call it account. These are They are recognized. You can also use them, they have no problem than writing the whole word. So let's be mindful that the only time we open a person's account is when the transaction is on credit. And that's why I say that personal accounts are accounts of debtors and creditors are loan. So once you don't have those, then it means you are not going to be opening a personal account. And not forgetting that we say the person can be an individual, can be a corporation. So since it is on credit, we are going to open Marker's account. So let's open the two accounts. So we can call this Marker's account, Marker account. Then this is purchases. Then you put the currency sign. Can put in thousands. We are working thousands because we don't have space. So, and what we are going to do, or what we do next, is to find out which accounts are going to be debited and which accounts are going to be credited. So, looking at this transaction where they are buying goods on credit from Mark, so we need to know, we need to see, or we need to know which account are we going to be debiting and which account are we going to be crediting. Now, Mark is a personal account, and we said that the rules for personal accounts, we say that once you are able to apply the rule on any account, then automatically the corresponding entry is supposed to be on the other side. And I said there is no way you are going to get a debit entry on one account, then you also get another debit entry on the other account. So that's why, since we have identified Mark as a personal accounts, then we need to know what are the rules of personal accounts. But we should always avoid double debits or double credits, that I credit Mark at the same time I credit purchases. Doesn't make sense. Or I debit Mark at the same time I debit purchases. That's not the double entry rule. The rule is you debit this account, then you must have another account that is going to be credited. Once the other account is credited, then you must be having another account that is going to be debited. That's the rule, and that's what we are applying here. So since we have identified one, that we are buying goods on credit from Mark, then we have to ask ourselves whether Mark is going to be receiving goods or is going to be losing out the goods. Is Mark giving? Because we have identified Mark as a personal account, and the rules for personal accounts are you are going to look at which side is receiving and which side is giving. So the rule for personal accounts, we debit the receiver and then we credit the giver. And in this case, Mark is giving out the goods. And we, the business, we are receiving the goods. And because Mark is giving the goods out on credit, then Mark is going to be credited because he's the one giving out. We are going to debit ourselves, then we credit Mark's account. So the same date. So we are going to credit Mark as of June 6th in the names of purchases because it's the corresponding account and the amount is 1.5. And when we come to the purchases account, because we have the purchases in the Markers account, then automatically we are going to debit purchases account as the corresponding entry. So let's see. Let's fill in the values. So we are going to credit Markers account in the name of purchases. Make sure you put the dates. It is 1.5, but I'm taking 1,500. So we are going to come and debit purchases in the name of Mark 1.5. So the reason that's why we are taking here Mark is because it is where the information came from. And the reason why we are putting purchases here is because that information is coming from the purchases account. The other way is to look at the purchase account and you try to know what a purchase is. You know, when you are purchasing, you are buying. And once you are buying, it means you are spending money. It's like an expense. So, because it's like an expense account, we are going to debit it. Because we said that we always debit all expenses and losses. That is for nominal accounts. Purchases are falling under nominal accounts. And we said with the rule for nominal accounts, we debit all purchases, we debit all expenses and losses, and then we credit incomes and the gains. And that's why we are debiting the purchases account, but on the same date, and it will be in the names of Mark with the same amount of 1.5. So that's what we do in that. So we can close off this account too. So this side is bigger, so we take the 1.5 to be the total for both. 1.5. So this is going to be the balance carried down of 1.5. Then here will be the balance brought down of 1.5. So we also close off this. It is the same 1.5 as their total for both sides. Then balance carried down of 1.5. It will be the brought down this side, the opposite side, balance brought down of 1.5. So when you are taking it the 12 balance, we pick only this balance. We pick the balance brought down this side. So for Markers account, we shall take the 1.5 on the credit side. For purchases account, we shall take the 1.5 on the debit side. So that's how we do those. So let's go to the fourth transaction. So transaction number 4. So the next transaction, they bought goods by check of 1 million. They bought goods by check of 1 million. 1 million shillings. So once they bought goods on credit, so they bought and they paid by check, meaning they paid by bank. Now, we need to know what are the two accounts that are involved in here in this transaction. And we are now seeing that we bought goods. And when you buy goods, those are purchases. So the first account is purchases account. We are buying goods. And the other account is going to be bank because we are paying by check. So anytime you see check, then it's the bank account, because it is going to be the bank account that is going to be affected, because a check is going to be withdrawn from our bank account. Therefore, once you are buying or once you are paying by check, then it's automatically affecting your bank account. Now, we need also to ask ourselves, which of these two accounts are we going to be debiting and which are we going to be crediting? But remember, we had already opened a bank account and we had already opened a purchases account. If at all we are doing this this number as a one entry, this transaction wouldn't be opened for, wouldn't have any account opened, because we had already opened them in the previous transaction. We would just post those values. I hope you are getting that argument, but we shall understand and we shall learn how we can be able to do this. But let's first understand what are the things that we are supposed to do. So we say the purchases account is an expense account. And the rule for expenses is that we debit all expenses and losses. And obviously, we are going to be debiting the purchases account. And once we have debited the purchases account, then automatically we are going to be crediting our bank account. On the other hand, you can look at it from the point of the bank. You look at from the banker's account, and you see, we know that a bank account is a real account. And the rule for real account is that you are going to look at whether cash is coming in or cash is going out. And that's the rule for real accounts. So the rule changes. The rule will be changing from that of an expense. And once cash is moving out of the bank account, then we shall credit the banker's account in the names of purchases with the same amount. So either way, you have been able to understand it. If you understand it from the bank, the bank side, then it will be fine. As long as you can understand one transaction, the rest will be the opposite, will be on the opposite side of the other. So let's open the two accounts. So this one is going to be, let's call this one the bank account, and this one the purchases account. So put the currency sign. We are working in thousands. So they have told us they bought goods by check 1 million. They are worth 1 million. So we've said that purchases are expenses, and we said expenses, we debit all the expenses. That's for the class of nominal accounts. So we are going to come here and we debit, but it's going to be in the names of bank. So bank 1 million. We are writing 1,000. Then you come here. The corresponding entry is supposed to be on the. Sorry. This is supposed to be on this side of the purchases. Bank 1,000. Then you come here on the bank account. You put purchases. So you see, you can actually make mistakes. So you just need to follow the rules. You see, if you want to go by the banker's account, we know that as we buy goods, we are losing money. Money is moving out of the business. It's moving out of our bank account. And that means if money is moving out, then we are supposed to credit that account, because that's the rule for real accounts. So that's going to be done for that. So what we are going to do, we close off. So we close off this. This is going to be 1,000. Even here 1,000. Then the balance carried down of 1,000. Then it will be the balance brought down of 1,000. We also close off this. This is 1,000 because it is the biggest part. 1,000. Then the balance brought down, balance carried down of 1,000. Balance brought down will be this side. Balance brought down of 1,000. But at some point, since these two accounts are the same, we had already opened these accounts, you'll find that some of these accounts will disappear because you may purchase and you offset. You'll find that some accounts will have no balance carried down. So we shall look at when we do a combined approach. So let's look at the next transaction. So the next transaction is all about, number 5 is all about, they are saying they sold goods on sold goods for cash, and the amount is 800,000. Sold goods for cash and the amount is, so we need to identify two accounts. Now the two accounts that we are going to have here, once it is goods that we are selling, then it means we are going to be having sales account, and then the other account, they are telling us that sales, they have made sales of 800,000, but we received the cash, so it is going to be cash account, and then the sales account, and then the cash account, because we are receiving money in cash. So because remember we said sales, those are disposal of stock, but since this is not a credit sale, then we are not supposed to open for the other person. The other person we sold it to, because he paid us. We can't open a personal account because the other person paid us. So that's why we are opening a cash account and then the sales account. So I told you, even if they attach a name of the person whom they sold it to, but we still open a cash account, even if they put that we sold goods worth 10 million to James. James's account is not supposed to be opened as long as the payment was made. We only do that if at all we are selling on credit. As long as cash has been received, we don't need the person's account. So the two accounts are those. So we open the two accounts. So this is the sales account and then the cash account. So now we are going to identify. We know that cash, you can look at the cash. The cash is a real account. So we need to see, is cash coming in or cash moving out? And for cash, we can see that actually cash is coming in because we are selling goods. So what we are going to do, since cash is a real account, we are going to, the rule for real account is that if you debit the receiver, then you credit the giver. So here we are receiving cash. So we are going to be debiting it. So we come here and we debit it, sales of 800. Then, of course, automatically the credit side of the sales account will be done in the names of cash. Cash 800,000. But not forgetting to put the currency sign. So don't forget to put the currency. So we close off this account. So this is going to be 800. Even here it is 800. So the balance carried down will be 800. Then balance brought down here will be 800. Also this one is 800. Even here the total 800. Balance carried down will be 800. Then the balance brought down this side will be 800. And that's what we do for that account. So we know sales money will be coming in. and that will be a nominal account. So when money is coming in, we credit the account, if you want to look at it from the sales perspective. So looking at the next transaction that happened on June 11th, where we paid rent by check. We paid the rent by check, 500,000. So paid rent by check. $500,000. So we need to identify which two accounts that are available. And what I said that once you see check, then you just know we are referring to the bank account. So the two accounts, we have one bank account, and then the other is the rent account. So the rent account and the bank account, those are the two accounts that we have. So we can now open the rent account and the bank account. But since we already know the other bank account, we've been opening the bank accounts. But as I told you, we are handling transaction per transaction. If at all we are not handling transaction per transaction, we wouldn't open another bank account. So we open bank account, then the rent bank account, and then the rent account. Now we know that if you look at it from the banker's side, we need to see which one are we going to be debiting and which one are we going to credit. So if you look at it from the banker's side, we know bank account is a real account, and obviously we need to know whether cash is coming in or cash is moving out. And when you are paying rent, it means cash is moving out. So in that perspective, we can see that our bank account is giving out or is losing money. Money in the bank account is going to be reducing or decreasing. And since it is going to be decreasing, we credit it. But also when you look at the rent is an expense. And we say the rule for nominal accounts is that we debit all expenses and losses, then we credit incomes. So whichever way you go, as long as you can tell that this account is belonging to this class of account, it will be good to go. So we put in the currency. So either way you take, so we know that this is an expense account. So we debit all expenses in the name of bank. So we shall come here, we say bank, 500,000. That's the money we are paying out. So this is bank, 500,000. So once you have identified one entry, then the other one in the corresponding side is supposed to be on the opposite side. So we come here, we say rent, in the name of rent, 500,000. So that's it. Then we close off the accounts. So this is going to be 500. Even this side is 500. This is 500 also. Even this one is 500. So balance carried down is 500 this side. Then the balance brought down will also be 500. Then also this is the balance carried down of 500. Then balance brought down of 500. And that will be that will be done. So we look at the other transaction. The other transaction, they said returned goods worth 300,000 to Mark. Returned goods of 300,000 to Mark. Remember, Mark is our person who supplied to us goods on credit. Is our supplier. So there is a return. Now, we know that Mark is our supplier or is our creditor to the business because he is the one who sold to us goods on credit. We bought goods from Mark on credit. And that was, the goods we bought were worth 1.5 million. And we returned, they are saying that we returned goods worth 300,000 to Mark. Now, what we need here, we need to find the two accounts that are involved here. And Mark's account is obviously one of them. And then we can have the goods returned to Mark. Of course, the goods returned to Mark is actually the return outwards, because these are returns on purchases. We are returning goods to suppliers. That is a return outward. If it was customer returning to us, then it would have been return inwards. So this is a return outward because it is the business returning goods to the supplier, since Mark is our supplier. And return outwards is the same as the purchases return. So we'll open both accounts for Mark's account and then the purchases return account. But if at all we are doing this for the entire question, Mark's account, we had already opened it, we wouldn't open it again. We would just post the transaction there. So we have Mark's account and then the purchases return account. So we are going to open two accounts. So since I said we are doing it separately, let's open both accounts. Purchases return account, then Mark's account. Mark is our creditor, or is our supplier. So put in the currency sign. So we can now put in the figures. Now, the next question we shall ask ourselves is whether these accounts are going to be, which of these accounts is going to be debited and which one is going to be credited. But one thing, you can look at it from the Mark's side. Mark's account is a personal account. And we said, since we are returning goods to Mark, and the rules for personal accounts are you debit the receiver, then you credit the giver. And from this case, Mark is receiving goods. And once we are receiving, then we are going to be debited. So we shall debit Mark's account, then we credit the return outwards, or the purchases return. And that's basically what happens with the purchases return. Remember, we said purchases, they are from the other side in the perspective of expenses. But now, these ones are returns. It's like we had paid some money, but they are bringing back the money. In other words, we had made an expense, but now we are cancelling the expense. How are we cancelling? We had bought goods of 1.5 on credit, and the supplier was demanding us 1.5. But what happens with the return is that we returned some of the goods and we are not going to pay for those goods that we have returned. So it's like a cancelled expense. So if the expense was debited previously, then this one is supposed to be credited to reduce on the other on the other figure that we were supposed to pay. I hope you are getting this kind of argument. So there are so many ways you can access some of these things. Others, you can actually access some of these things by understanding the accounting equation. I will address more when we do the accounting equation. I know we illustrated how it comes about, but we haven't done any practical simulation to help us understand more. But when we do that, I will help you, because we can understand that this mark is our creditor. We know that liabilities always have a credit balance, and when the liabilities are reducing, we debit by reducing the liability. So we shall understand some of those things as we progress. So we are returning some of the goods. Now what we are going to do, you don't forget the debts. So Mark was demanding us more, so we are reducing some of them. So we can call this return outward, RO, to mean return outward, or purchase return of 300,000. Then of course we come and debit the purchases return. This is from the marker's account. So we can balance this off. The total this side is going to be 300. This is the balance carried down of 300. Then this will be the balance brought down of 300,000. So this is 300, even here 300. This is balance carried down of 300,000. Balance brought down of 300. I hope we are able to pick some of these arguments. So let's look at the next transaction. Transaction number 8, which happened on June 16th. They are saying that the owner took 100,000 cash for personal use. The owner took 100,000 cash. The owner took 100,000 of cash for personal use. So the same thing that we are going to do here, we want to identify the two accounts. They are saying that the owner of the business took 100,000 for personal use, 100,000 cash for personal use. And I told you that whenever the owner of the business takes cash for personal use, then we call that drawings. So the two accounts that are involved, we have the drawings account and then the cash accounts. So we need to open accounts for cash account and then the drawings account. If at all we are doing this question at once, since we've been opening cash account, we open one cash account, then you put all transactions that are related to cash. So this one we will just open the drawings account. But as I said, we are only looking at each of these statements independently. That's why we are going to open two accounts, the cash account and then the drawings account. So we have drawings account and then the cash account. So we draw them. So this is cash account, this is drawings account. Now we know that cash is a real account, and we need to know whether cash is moving out or cash is coming in or is moving out. So the question will always remain the same. So the two accounts involved, we have seen them. Then what you have to see is, or what you have to ask yourself is, which accounts should be credited and which accounts should be debited. So if you look at If you look at it from the cash point of view or from the cash aspect, then you can ask yourself whether cash is coming in or cash is going out. But here, the person or the owner is picking out cash, and then it means that cash is actually going out of the business. And the rule for real accounts, we always credit what is going out and we debit what is coming in. Therefore, once you are able to identify that this is actually a real account, a personal account, or a nominal account, the class, then you can be able to do what we are doing here now. So the drawings accounts are supposed to be debited in the names of cash. And remember, the drawings accounts, these are private accounts. They are private accounts. We looked at what private accounts are. They are the ones that are private to the owner. So we put the currency. So cash is moving out, so we credit cash in the names of drawings. They are taking 100,000, so we shall write 100. So we are coming to debit the drawings account in the name of cash, 100. Then we close off the accounts. So the total is 100, even here 100, so balance carried down is 100, and then balance brought down is 100. Then we also close off this. So this is also 100, balance carried down is 100, then balance brought down this side is also 100. And that's what we do with the drawings account. So we now look at, I think, the last transaction. The last transaction, which is transaction number 9. Transaction number 9, they are telling us that we paid Marker's account. We paid Marker's account in full. Paid Marker's account in full. Marker's account in full after deducting a 10% cash discount. Now, here we have a concept of discounts coming in. And they are saying that we paid Marker's account in full, less 10% cash discount. And over here, there is no amounts that they have mentioned. So we have to get the amounts that we are going to use. And we can only get those amounts after drawing the Marker's account. Meaning we shall look at the Marker's account and we know the amounts that we are looking at. Remember, Mark is the person who supplied us goods worthy. We bought goods on credit from Mark of 1.5, meaning that Mark is actually demanding us 1.5 as of that date when we purchased. And then we also returned to him goods worth 300,000. Out of the other 1.5, meaning that the difference of 1.2, because he supplied to us, the cost was 1.5 at first. Now, we had a discount. we had a return, we returned some goods. Returns, it was 300,000. So that gives you 1.2 that we are demanding. But now they are telling us we paid this person in full. This is the full amount that is demanding us. But on top of paying him in full, he gave us a discount. He gave us a 10% discount. So a 10% discount will be 10% times the 1.2, because this is the money we are supposed to pay him. That will give you that will give you 120,000. So meaning the discount alone that we received from Mark, because Mark is our supplier, we received this. Remember, we are supposed to pay him 1.2. Meaning, if he gave us a discount of 10%, which is 120, we must have paid this 101.2 minus the 120. That is the money that we paid to him. So it was 1,080,000. So this is the money that we paid him after deducting. So we paid all of this to him in full. So the discount of 10%, we deducted it and we remained with that. So you have to be careful. We are supposed to pay 120, but because we received a cash discount of 10%, then we are supposed to deduct that 10%, which is 100, which is giving us 120,000, which is our discount received. So when we take it out, we pay him 1,080,000, and that's the amount that we gave to Mark in cash. Since it was a cash discount, it means we must have paid him with the cash. That is the assumption. But even if you deduct it from the bank, maybe if it's not there, but if it is there, you can also deduct it from the bank account. But it is more preferred if you deduct it from cash, because by him giving us the discount, we must have paid on time, or we must have paid money promptly within the time frame that we had estimated. So now I want you to listen very, very carefully on what we are going to do, because this is the math that we did. So we have now two accounts. We have cash account and then the Markers account. We need to know which accounts are we going to be debiting and which one are we going to be crediting. And of course, cash is actually going out because we are using our cash to pay off this Mark. So cash is going out. But the only amount that is going to move out is only 1,080,000. So we shall credit cash account with that same exact amount of 1,080,000 of cash that we are going to use to pay Mark, because that's the actual amount of cash that we are losing in the payment of our supplier. But we came to when we come to the corresponding entry, remember we are going to have cash account is going to be credited by 108. So once we come to the corresponding entry or the corresponding side, that is the debit side of the Markers account, because Markers account had a liability. There is a liability is demanding us, was demanding us this 1.2, meaning Markers account is still reflecting this figure. because remember we deducted the returns. The cost was this, we deducted the return, we remained with this. So meaning in his account we are still demanding 1.2. Now what is going to happen is that we are going to take off. Remember, we have just taken off this 1,080,000, meaning there is this difference. This one we are supposed to open a third account for discount received. If it was a customer, it would have been a discount allowed. So we shall learn about those discount received and discount allowed under the cash budget as we are going to see. But just know we are going to create a second account, a third account for discount received. The reason as why we are creating it is in the sense that, remember, we had a credit balance of this of 1.2 and we debited it with this, meaning this balance is not offsetting, and they told us they paid in full, meaning the marker's account must disappear. The only way it's going to disappear is by debiting it with the discount received of 120. It will be balancing, because when you add this plus this, it will give you this. That will sort the mismatch. And that's basically what we are going to do. But remember, discounts are going to be credited, because the discount received is an income. You have, it's like they have forgiven you to pay some amount, otherwise you would have paid it. So it comes as an income to us because of the amount that we've received. So let's go into the posting. So sometimes you may find yourself having to decide on certain things. So we have said we are going to have, then the third one, maybe we shall have this is as a discount received. Discount received, this is the cash account. Then this one is going to be the markers account. We show the currency signs. So we said we are going to be debiting markers account by cash, the money we paid, which was cash of 108. So we come here, credit, cash is moving out, we credit. It has gone out into markers account. That's why we are putting the name of mark 108. Then remember, this one had already a balance, so we shall also bring in the discount received here. Discount received over 120. So we shall take it this side as June. We give its date 19th. It is coming from the markers account as 120. So that's how you write all the entries. So once you are done with that, then we close off the accounts. Remember this one here we had, remember we had some returns. We shall look at, we shall see. So this one is going to be 1.2, the total 1.2, and it's also going to be the total for this 1.2. So balance carried down of 1.2. So this one is going to be June 30th, balance carried down of 120. So we close off that 120. Even this one is 120. So we come to the other month, July 1st, balance brought down over 120. Then we also close off this. Of course, this one is going to have a balance brought down here. balance brought down is going to be 120 here. So we can close off this as well. Then we shall have 108. This is balance carried down, 1080. 108 as the total, then balance brought down, 108. And that's how we are supposed to do those accounts individually. But now what we are going to look at in the next video, we are going to summarize all these in one document, whereby we are going to have a page of these different ledgers. And after that, we shall be able to extract the balance sheet. But I told you, these balances that we have here, they are the ones that you take to the balance sheet. And we shall see, sorry, not the balance sheet, the trial balance. And we shall see from there. So this is the end of part 2 of this double entry. So we are going to look at part 3 where we are going to take the same question, but we make sure that we get all these accounts drawn at once, we balance them off, then we extract the trial balance at the end. So thank you for watching. Hello viewers, welcome back to our YouTube channel, and today we want to look at our next video as far as financial accounting is concerned. And the video for today, we are going to look at what we call the double entry part 3. Double entry part 3. The double entry part 3. That's what we are going to look at. Now, basically what we are going to look at here under the double entry, we are going to look at balancing of the accounts. Balancing of accounts. How do we balance off our accounts? Of course, when we are done balancing off the accounts, the next thing we are going to look at extraction. We are going to look at how we can extract the trial balance. How to extract the trial balance from the balances of different accounts that we have. So we have already learned how to post transactions in various accounts, and I want us to assume that these accounts that we are going to put below are the accounts that we are going to balance off. And at the end of the day, we are going to extract the balances of these accounts into a trial balance. So let's have some accounts. Maybe we can have like 1 or 2 accounts. Then we see how we can balance them off. Once we have learned how to balance these accounts off, we can then be able to generate their balances from the different accounts until we form what we call a trial balance. So let's have this ledger account for cash. This is a cash account. That's a cash account. Of course, here we have shillings. As our currency. Now, let's have some entries within our ledger account. We are just going to draw on one account. Then we see how we can balance it off. And towards the end, we shall look at very many accounts from the previous work that we did, and we see how we can balance them off. But I just want you to understand how we can balance off a ledger account. So let's put, maybe we have some capital. Maybe it is 10,000. Maybe we have made also some sales. We have sales. Let's say the sales were 6,000. And maybe we have paid some expenses. Of course, when you pay off expenses, expenses are going to be reducing your cash account. So they are going to be on the credit side. This capital is just money that you have. Maybe that's the money you contributed in cash. That's why it is on the debit side, but it will be on the credit side in the capitals account. The sales are the revenues that is coming into the business after you have sold stock or inventory. So once you sell off stock, if you have not sold the stock on credit, meaning you have received cash from the sale of the stock, you have to debit the cash account because money is coming into the business, then you credit the sales ledger account. So maybe you have some expenses. Let me say we have rent. Let me assume it is just 1,500. Maybe you have also bought some equipments. Maybe you have bought furniture, office furniture. We have paid by cash. Let me assume it is just 3,500. So let me assume those are the only transactions that we had. Now, so I want us to assume that that's our account. And what we want to do, we want to balance this same account for cash. We want to balance it off. Now, we need to, when we say want to balance off an account, or balancing of an account means that you want to make both sides equal, either the credit side or the debit side. You want to make both of them equal. This is our credit side. This is our credit side. Then this is our debit side of the T account. We want to make these sides equal. This side being equal to this side. That's what we are basically trying to do when we say we are balancing off accounts. We try to make these two accounts, these two sides equal, the credit side and then the debit side. However, what we do is that we will add up these values that we have. We have the amount for capital, that is 10,000. We also have cash sales of 6,000. We add the debit side, and at the same time we add the credit side. The credit side has rent of 1,500 and furniture of 3,500. So we add up and we get the totals of each side, the debit side and then the credit side. Once you have gotten the totals, you select which one is higher than the other. So if the debit side is higher than the credit side, then we are going to take the balance on the debit side to be the balancing figure for all the sides. So we have seen that when you add up these two accounts, we can see that here we have, on the debit side, we have 16,000. 16,000, and this side we only have, on the credit side we only have 5,000. So the debit side is bigger than the credit side. So the debit side, the DR, is greater than the credit side. So if that happens, then it means we are going to take the balance on the debit side to be the balancing figure for the two sides. So even this side, we are going to take the same balance as 16,000. So once you have done with that, the next thing that you are going to do, this one we have taken that as the balancing figure. So we close off with a double underline at the bottom. We double underline our totals at the bottom. And the reason as why we do that is because we have gotten a side that is bigger than the other, and what we are trying to do is we are trying to make all these sides of the ledger accounts equal. So we have seen that on the debit side you have 16,000 as the total, and on the credit side the total is 5,000. And this tells us that the debit side is more than the credit side. So what we do, of course we leave some space. We leave a space on the credit side because the credit side is now the smallest. We leave some space here. That's why you're seeing we have left some space here. We leave some space because we are going to write the balance that we are going to carry forward to the next period. Next period can be a month, can be a year, it can be any period that they have given to you in the question. So the next thing that we are going to do, after leaving the space, we have written the 16,000 on both sides. And we have said, of course, this one we look at it, we look at a ledger, as I told you in our previous videos, that we look at a ledger as a book. So by putting these double underlines at the bottom of the total of the highest figure, it means we are ruling off with the totals. So once we have put the big amount on both sides, in an attempt to make sure that we balance off this account with the highest figure. Now, once we have made the two sides equal, like the way we have done here, this side is 16,000 and even this side is 16,000. Now, we know that the credit side has a total amount of only 5,000. So what we need to do is we need to get the difference. We get the 16,000 minus the 5,000. And that will give us 11,000 as the difference between the debit side and the credit side balances. So this difference of 11,000 means that the credit side needs 11,000 to be equal to the debit side. So because it will be the 11,000 plus the 5,000 that will add up to 16,000 to make the two sides equal. So this 11,000, because it is the amount that is remaining to make the two sides equal, or to make the credit side equal to the debit side, we call that a balancing figure. We call this amount, this 11,000, a balancing figure. So this balancing figure is the one that we are going to put in this space we have left. We always leave a space at the top of the side that has the lesser amount. If this debit side is the one which had a less amount, we would have left some space here because there is something that we are going to write there. That's the reason of leaving a space, and that space is left for the balancing figure. So we have said that the amount is 11,000, which is the difference between the two balances, and that 11,000, we've said it is our balancing figure. And since it is our balancing figure, this side we are going to be writing it as a balance carried down. We can either use a balance carried down or a balance brought forward. So this one, we write it as balance carried down. We abbreviate it like that, it's allowed. So that balance carried down is going to be 11,000, and that's the amount that is needed to make this credit side equal to the debit side. And once you have done with that, remember this amount, it is going to be carried down, or it is going to be brought forward to the next period. So we have closed off this account. We always close off these accounts at the end of the period. If you have been working in months, every month you close off the account, and whichever balance that you have either on the debit side or on the credit side will be carried forward, or will be brought forward, or carried down to the next period. If all these transactions had happened maybe in December, then it means that this 11,000 was a balance of December that we are going to carry forward to the next period, and the next period will be January of the next year. I hope you are getting the argument. And what we are going to be doing here is that we are going to have this 11,000 carried down, and we've said carried down means that this amount, which is the balancing amount, is the one that we shall take to the next period, or that will be brought down to the next period. So this balancing figure on the account, we have said that for us to get this balancing figure, there are 3 steps that we went through. This step 1, we first ascertain the total of the debit side, and then we ascertain the totals of the credit side. So we get all the total entries in terms of the amount. We add up those values at the debit side, then also at the credit side. So once we have gotten the totals, then the next thing that we do, we get the difference. We get the difference between the two totals, the debit total and then the credit total, and then you put that difference in the side that has the smallest amount, like the way we have done it, because we have seen that this one has 5,000, the credit side, and we have taken the balancing figure to be on the credit side. And once it is on the credit side, or whichever side that has the smallest amount, we call it a balance carried down, meaning it is going to be that balance that we shall take to the next financial period. And you have to take note that I'm saying period because at some point they may give you in months, they may give you in years. So it depends on the period that they have given you in the question. Now, for verification purposes, because you need to verify, remember I've said that when you're balancing off this account, you have to make sure that the debit side is equal to the credit side. So just for verification purposes, you need to add up these values. You add up the 1,500 plus the 3,500, then you add the 11,000 to make sure that it gives you the total of 16,000, which is the balancing, which is the total, the biggest amount that we have taken as the closing balances for the totals, the grand totals for all the two sides that we've balanced off. So once it is a balance carried down, then it means as you go into the next financial period, or as you go in the next period, it will be called a balance brought down. It will be on the opposite side, because this balance is going to be on the opposite side simply because this side had a highest amount of 16,000 and this one only had 5,000. So this balance is we are going to write it as balance brought down. We use B/D of 11,000, meaning that at the end of that period, the cash account has a debit balance of 11,000. And when you have a debit balance in a cash account, it means that the money that you still have, that's the money that you have with you. So we started with 10,000 as the money that we have received in form of capital. We added the 16,000, that is the money that we got from selling the stock that we have in the business. And when we have paid, when we use the whole of that amount, which is the 10,000 plus the 6,000, which gave us the 16,000, we cleared off our rent of 1,500. We bought off some furniture using that same cash, and we have remained with a balance of 11,000. That's what it means. So this balance that you are seeing here of 11,000, the balance brought down, will be the balance that we shall transfer to our trial balance. I want to repeat that. We have said that for verification purposes, you have to make sure that you add these two sides to make sure that these balances are equal. And I have also said that the balance carried down, if it is on the credit side of the account, the balance brought down should be on the opposite side of the account. So the balance brought down is on the debit side, but the balance carried down is on the credit side. The other thing that you need to note from here is that these balances should be the same. If the balance carried down is 11,000, even the balance brought down should be or must be 11,000. These balances have to be the same. The balance brought down and then the balance carried down, they have to be the same. So those are the easiest steps you need to follow when you are balancing off any account. What we have just done is what we are going to do on every account that you'll come across, as long as it's a ledger account. Now, one thing, we have now done the closing of account, but we have also to know something that is really important. Something that we call the balance on the account. Balance on the account. Balance on the account. I want to explain it. Balance on the account, this is something that you need to understand. Balance on the account, or balance on an account. Now, a balance is simply the difference between the debit side and then the credit side, meaning that when the debit side is bigger than the credit side, for example, the same way we had here, the credit side was bigger than the debit side. This one we had 16,000, and this side we had only 5,000. It means the debit side was bigger than the credit side. And we have seen that the difference between those two, or the balance between those two, was 11,000. And this 11,000 is the same. We said that 11,000 would be used as the balancing figure, but you can also call it the balance on the account, because the account for cash has a balance of 11,000. That is what we call balance on the account. But specifically, if you want to differentiate the balancing figure and then the balance on the account, the balance on the account is always the balance brought down on that account. That is the balance you are going to remain with, or that's the balance that you are carrying to the next financial period. But remember, we said the balance brought down and the balance carried down, they are supposed to be the same. So it means a balance on the account can be a balancing figure. I want you to understand that. But the only difference is that the balance carried down, or the balancing figure, is supposed to be on the opposite side as the balance on the account. Those are the differences. But we also say that the balance carried down is the balance that is on the smallest side of the account. And then we have the balance brought down on the different, or on the opposite side of the account. If the balance brought down is on the credit side, then the balance if the balance carried down is on the credit side, then the balance brought down must be on the debit side. And if the balance carried down is on the debit side, then the balance carried down should be on the, if the balance carried down is on the debit side, the balance brought down should be on the credit side of that account. Those things are very important, very important. And we said we use short terms. We don't write the full words. In what is allowed, or what is, you'll find in most of the textbook, they will just use balance carried down. They will use it alternatively with what we call balance brought. It is balance brought forward. If they don't use balance carried down, they will use balance brought forward. Those two mean the same thing. The aspect is that if they don't use balance brought down, no, this one is supposed to be balance carried forward. It is a carried forward, not it's a balance carried forward. This one is a balance carried forward. And if they don't use balance brought down, they use balance brought forward. These two mean the same thing. If they don't use, but you don't, if you have used this, then you stick to this. If you have used balance carried forward, then the other one should be balance brought forward. If you have used balance carried down, don't again use balance brought forward. You have to use balance brought down. That's the argument. Now, after balancing off these accounts, then what we do next is extracting a trial balance. So I also want us to look at the concept of a trial balance. So after balancing off the accounts, then what we do next is extract a trial balance. So we are going to extract a trial balance. Extract a trial balance. And I want us to look at the concept of a trial balance. And it is said that in accounting, any statement that ends or obligated to balance then it must balance, and that's why we have what we call a trial. That's why we have what we call a trial balance. And at the same time, we have what we call a balance sheet. Now, these two are supposed to be balancing when prepared. If you prepare a trial balance and a balance sheet, those two must balance. But for a trial balance, it is just a list. It is just a list of debit and credit balances. For a trial balance is just a list of debit and credit balances. And these balances are coming from our ledger accounts. And you remember we say the ledger account is like book. It has two sides. It's more of a T account. It is represented in a T format using letter T, capital T. So the implication is that we only pick the balances, either they are going to be on the debit side or they are going to be on the credit side of our ledger accounts, but we pick those balances that we have on either debit or a credit side of our ledger account. So those balances are the ones that are going to be extracted and form what we call a trial balance. So a trial balance is just a list of debit and credit account balances that are extracted from the ledgers at the end of the period. So what we are going to do for a trial balance, we shall look at the balance sheet later. For a trial balance, what we are going to do, we first of all balance off our accounts, and after balancing off those ledger accounts, then we pick those balances on each and every account that we have opened, and that's what we use to make a trial balance. And that's basically what we call the balances on the account. So we pick those balances on the accounts, the balance brought down on either side of the cash book. They are the ones that we are going to extract from those accounts, and we form what we call a trial balance. And we want to look at the format. I want us to look at a format of a trial balance. And mainly, of course, we are trying to look at the format of a trial balance. Format of a trial balance. Mainly, a trial balance has mainly 3 columns. Mainly, the main one. There are 3 columns. We have what we call a debit column. A debit column, that is the one that has all the debit balances. And we also have a credit column. This is the one that has, this is the column that has the balances that are appearing on the credit side. And the other one, we have what we call the details. The details, or what we call particulars. Particulars column. That's where we write the narration, or we write the account titles. If you don't call them account titles, you can call them details. You can call that column particulars column. So those are the 3 main columns that a trial balance have. But if you go to other books, they include a 4th column, which we call a folio. Folio is more of a reference column. So other books, they include what we call a folio column, and that is just to show the reference where this transaction is coming from. So we can have our format of a trial balance. We said we are going to have the particulars column. You know, a column is just moving downwards. Then we said if you don't call it particulars, you can call it details, or you can call it account titles. Then I've also told you that some other books put what we call a folio. A folio will be the smallest column in a trial balance, because the information that goes there is just a reference, is just a point of reference, that where did we get this info, where can we find this information. So if the transaction is a cash transaction, then we know that we are going to find it maybe in the cash book. So it is just a reference column. Then the other side, we said the major ones are particulars. Then the debit side. The debit side, we can call it DR. D, capital D, then R, small r, in bracket. But all this is always given the debit side. Then we also have the credit side. The credit side, you can call it capital C, then small r, CR, in bracket. Then the debit side, you can call it DR, in bracket. But remember, all these columns, these two columns represent amounts, so we have to put our currency. In Uganda, we use shillings, and that's the short form, shillings. So that's basically how this will look like. That will be the format. I've told you that some books include this folio column, but even if you don't include it, no one will penalize you. But these three, the particulars, the debit side, and then the credit side, must be there. Now, what we do, remember we had our cash account. We had our cash account that we closed off. We closed off our cash account, and that cash account had a balance. It had a balance brought down of 11,000 that was on the debit side. So we have to pick that balance. So the account where we are picking the balance is called a cash account. Where can you find a cash account? We always find it in the cash book. We can use CB to represent cash book. And then we have seen that it had a debit balance, and the balance was 11,000. We only saw one transaction, and that's the ledger account we opened. But if you look at that cash account, we had also capital. So all those individual items that we presented in the cash, they are supposed to also, the corresponding entries are supposed to go in their respective account. Remember, we had the capital. And the capital in its respective account is supposed to be on the credit side. We had it was, I think, 10,000. But this one can be increased or decreased depending. So that's how you keep putting all these information. We also had the sales. We also had the sales, and the sales were 6,000. This is 10,000. We also had the rent as an expense, and it is supposed to be on the debit side because all expenses are debited. The rent expense was 1,500. I just want to show you that even from one account you can, as long as you know where this information falls. Then the last amount, the last item we had in that cash account, we also had the furniture. Remember, furniture is also an asset. It was 3,500. And that's it. So I just want you to know that if I try to balance this account, if I try to balance this account off, it has to balance. If you add this 11,000 plus the 1,500 plus the 3,500, you'll get a total of 16,000. And also if you add the 10,000 plus the 6,000, you end up with 16,000. And you're seeing that these two sides are equal. You double underline them. But we are going to see, we are going to have some accounts that we are going to try and balance. We are going to have some accounts that we are going to try and balance off so that we can be able to see what we have. So that's basically what we presented. If let's say we only had one account, and that's how we would have presented it. Now, the other thing that I need that we need also to understand is the fact that we have seen that the cash account had a balance brought down of 11,000. And it was on the debit side, which means that the cash account has a debit balance and the same amount that as it appears. If the cash account has 11,000, please don't transfer to 11,000. You transfer the exact amount that is available on that account. And you write the account title where you are picking that information from. We are picking it from the cash account. And that account title is what is going to appear in our particulars or details column. However, some books, as I told you, they include a folio. It is just a reference section of which it will be explaining where this information can be found. The information on the account where you go to the figure, the balancing figure that we have transferred to the trial balance. But it's not all that important, as I told you. That's why we are going to do some numbers and we may exclude it. But just know, if you find it in other books, it's also part of the format. However, an account can have either a debit or a credit balance. You have to note, it's not a must that we always supposed to have a debit balance. An account can have a credit or a debit balance. But we say that an account has a debit balance if let's say, just like the way we've looked at the cash account has a debit, it had a debit balance, and that meant that the balance on the debit side was more, meaning in terms of the totals, the total on the credit side was more than the total on the credit side. That's why we ended up with a debit balance. The debit side was more than the credit side. So if the totals of the debit side of any account are more than the totals of the credit side, then we say that that account has a debit balance. And on the other hand, if the totals of the credit side of an account is more, or they are exceeding that of the debit side of the same account, then we say that that account is going to have what we call a credit balance. Those are the two scenarios where we can have interchanging figures. It all depends on the totals or on the credit and the debit side. Those are the ones that are going to help us know whether we are going to have a credit balance or a debit balance. It's not a matter of cramming that this one has to always have a debit balance or a credit balance. But now, there are also accounts that we should know that have a credit balance. These ones you just know from your fingertips that these ones have a credit balance all the time. For example, if you look at the capital account, just like the way you have seen me including here, I included this account, the capital account, on the credit side, because we always know that capital always has a credit balance if you balance off its account. And the reason as why, because at some point you may not even have the amount, because it can happen like for instance, if let's say all the balances are the same, maybe you had all the capital but you withdrew all the capital from the business, and you find that you put in money, then you've taken all of it, and you're seeing that the credit side and the balance, the totals on the debit side are the same as the totals on the credit side, meaning that we are not going to have anything to do with the balancing figure. So the other account that you need to know that are going to always have a debit side, let's say a debit side, because I also told you that even sales account will always have a credit balance. But there are also those accounts that are going to have debit balances. Like for example, if you look at asset accounts, if let's say we look at cash account, if you look at maybe purchases account will always have a debit balance. So the purchases will have a debit balance, the cash account will have a debit balance, the sales accounts is supposed to have a credit balance, and so on. So those are some of the accounts that you will know when you are preparing them, that this account will always have a debit or a credit side, because these are some of the accounts that you are going to be preparing on a daily basis. Because the moment you keep preparing these accounts on a daily basis, you will come to realize that maybe almost every time these accounts are going to have either a debit or a credit side, because you are going to be seeing maybe the debit side will always be higher, which will be otherwise, so that you can be able to conclude that this account will always have a debit balance or a credit balance. As you keep on practicing these numbers, you get to an understanding that actually this account will always have maybe a debit balance or a capital, a credit balance. However, there are some accounts that you are preparing, that if let's say when you are preparing them, like for instance, if you look at the capital account, these are some of the specific accounts. If you are preparing a capital account and then maybe a drawings account, and these are the two accounts that are going to be these two accounts are going to be opposite in nature. By nature, they are going to be opposite. If this has a negative, if this has a credit balance, then this one should have a debit. They are opposite in nature. The other accounts that are going to be opposite in nature, we can have let's say purchases account, and then the return outward account. Then the other account, of course, this one is going to have a debit, but this one will have a credit, return outward, because this one you are purchasing, and this one, as you purchase, you are also going to return. Maybe some items are going to be defaulted commodities. They are not functioning. The other accounts that we can also have is maybe the sales account, and then the return inward account, or sales return. The other one can also be called purchase return. This one is sales return or return inwards. This one can also be called sales return. Like you have a customer, you have sold a good to a customer, but maybe the customer, as he uses the product, he finds that maybe the product is defective, is not working. The customer might return that product. Once they return, of course, here you have made a sale, it will appear on the credit side, but as they return this item to your stock, this will be in debit. We shall be debiting because we are receiving more stock in terms of returns. So these accounts are also going to be opposite in nature. Now, capital accounts are always, these capital accounts are always having a credit balance. Capital account will always have a credit balance. The drawings accounts will always have a debit balance. The sales account will always have a credit balance. The purchases account will always have a debit balance. And finally, the return inwards always has a debit balance, while the return outward is always having a credit balance. So those are some of the accounts that you can know for sure that as I'm preparing them, I know where the balances are going to be, because these accounts are going to have opposite transactions. They are opposite in nature. So there are other accounts that as we keep studying them, we shall see that whereby we always have a debit, and maybe in the other we always have a credit balance. But I also want to explain something to you, that when preparing accounts, because of course, as I told you in the previous video, we prepared some accounts. As I was preparing some accounts in the previous videos, we went to capital accounts. Of course, when we went to the capital accounts, I told you that we are going to credit capital. I've been telling you that we credit capital account. And I promised you that I will explain why we always credit capital. Why we always credit capital account. So let's now look at a reason as to why we are crediting some of these accounts. We look at some of the reasons as to why we are crediting, because we told you there are some specific accounts that are needed to be treated in a different way. So let us try to know the reason as to why we are crediting the capital account. Now, we need to know what type of account or what is the class of account. Class of account. We need to know the class of account this capital account is. Where does it fall in terms of the classes of accounts? Class of accounts. Where does this capital account fall? Because we always say that we credit capital, but what could be the reason and what class rule of account is guiding us here? Now, it is going to be a little bit interesting for you to know that actually capital account is a personal account. Is a personal account. So if you have never heard of it before, just understand that capital account and a drawings account, all these are personal accounts. Capital account and drawings account are both are personal accounts, and we need to know why they are personal accounts. So there are two accounts. These accounts, the capital account and the drawings account, they are accounts of the owner. The owner's accounts. These two accounts, they are owner's personal accounts. Now, let's try to have maybe, we try to draw owner's account. We just call this one owner account. Owner account. Owner's account. But now I told you that the owner is a special, the owner of the business is a special type of credit. We call it a special type of credit, type of creditor, because it provides a special credit to the business. Is a creditor to the business because of the fact that, because now if the owner brings in money to the business, we have what we call the business entity concept. Business entity concept. And this is the concept that is helping us to understand that actually the owner of the business is a special type of creditor to a business. Because we learned from the business entity concept that, or the business entity concept teaches us that the business is a separate legal entity, meaning it is separate from its owner. Business is a separate legal entity. A separate legal entity. Meaning that a business is separate from its owners. In other words, the owner or the person who has started or who has incorporated the business is an outsider. And whatever the resources this person has provided to us, they are going to be treated as an investment. Whichever resources this person has provided, we are going to treat it as an investment. As an investment in the business. As an investment in the business. In other words, the owner will be contributing money to the business, but that will be treated as an investment in the business. Which concludes that the business is going to be indebted to the owner or to the owners, because the business might be having very many owners. So once the owners of the business put money into the business, we are going to see that the owners are going to be treated as if they have loaned money to the business, because from the business entity concept, we know that the entity is going to be a separate legal entity. It's going to be a separate legal entity. Now, so as you try to look at the owner as if the owner has loaned money to the business, we try to understand that as we try to treat the owner as a special type of a creditor to the business. However, we also have to understand that the owner of the business is also a person, meaning that the owner's account is going to be a personal account. So when the owner is giving resources to the business, or when the owner is providing capital and cash, of course, we know capital may not necessarily mean that we are only receiving cash. Someone can contribute maybe in terms of the assets of the business. You can contribute capital in form of assets. So if you are either bringing in cash or non-cash items as capital, and because of the fact that the owner is a person, so it's going to be a personal account. In other words, we are going to be applying the personal accounts rule, which says that, of course, we looked at the double entry for personal accounts. We say that we debit the receiver and then we credit the giver. Therefore, we will now ask ourselves whether the owner is giving the business or is receiving from the business. And of course, we know that since it is the owner who is providing money to the business, is providing capital, he's going to be giving the business. And that's why we said we credit the giver, and hence we are going to be crediting the owners, the owner every time he or she brings in capital in the business. So we conclude by saying that the owner is going to be the owner's account. Since the owner is a human being, then we are going to treat that as, we are going to treat the capital they are contributing as if it is coming from themselves. So we are going to treat it as a personal account, and we will always be crediting whatever capital is coming into the business. And when the owner is making drawings, when the owner removes money from the business, because you know that drawings is also on the opposite side. Because now the owner is rather taking out money from the business, and we shall be debiting the receiver, and then the owner is the one who is going to be receiving the drawings. So the drawings, we will always debit the drawings account as long as the owner is picking out money from the business. So the drawings will always be debited to the owner's account. I had drawn the owner's account. Maybe I can put it on the next page. You say the owner's account, and we are saying that we are always going to be debiting we are always going to be debiting the owner's account the moment we see that we have seen there some drawings. So, and the capital account will always be credited. We credit the owner's account with the capital they are contributing to the business. And we are doing so because the owner is giving out money to the business. However, what we do in accounting is that we don't open we don't open any other account that we call the owner's account. So this is probably what we always what is supposed to be done. But when we try to do the normal accounting, we don't always open what we call the owner's account. We always divide the owner's account into two columns. We put it in a sense, we divide it into the drawings column, we divide into the drawings column, and this drawings column is separate is separated as the drawings account. The drawings account. And then the capital column is also separated as capital account. That's basically what we do. So whenever the owner brings in capital, we always credit the capital account because the owner is giving, and when the owner is also taking out money for personal use, we always debit the drawings account. But it comes, of course, we debit the drawings account because it will be the owner now receiving money from the business because they are withdrawing money for their personal use. So that's basically what we are saying, that drawings account is on the debit side of the owner's account, and the capital side, the capital account is on the credit side of the owner's account. So what we are trying to say is that the drawings and the capital accounts are both personal accounts because they reflect personal accounts of the owner. And that's basically what I wanted to share on the reason as to why we always debit and credit those two accounts. Now, we are going to look at the previous accounts that we did earlier in the previous video in the double entry part 2. We saw we did some number there, but we left off when you have not closed off the accounts or when you have not balanced off the account. So what we are going to do is we are going to look at those accounts and then try to balance them off and let alone extract a trial balance. And once we are done with that, then that will be the conclusion for today's video, because it was basically to help us know how we can be able to prepare a trial balance after balancing off the respective accounts and to transfer their balances to the trial balance. That's what we want to finalize with. Now we are going to look at the previous accounts that we did in our double entry part 2. So that video that we did previously, we had a simulation, and that simulation we had left when we have not balanced off the accounts. And I've prepared all the accounts as you can see them on the screen. These are the accounts, but we are going to make sure that I explain to you how we can be able to balance off all these accounts as you can see them. These are the accounts, the ledger accounts. And at the end of it all, we shall draft what we call a trial balance. That's how it looks like. So let's start looking at all these accounts that we have here. Now, as I explained earlier, we are going to balance off these accounts. And we say that balancing off accounts means making both sides of each account equal. Where there is, of course, where there is a shortage, then we put the difference and we call that difference the balance carried down. And what we are going to do here is that we are going to go by looking at each and every individual account separately, and we balance it off. By balancing it off, we are trying to make the two sides of each account equal. For example, if you look at this cash account, we need to make sure that the totals for each side, this is the debit side, and then this is the credit side. So you can see that the totals are the same, 10,800. That's what we call balancing off the accounts. Now, so let's start with the cash account. These are the accounts as we prepared them in the previous video, the video that is all about the double entry rule, part 2. If you look at that video, you'll be able to continue with this information as you are seeing it. Now, we are looking at we are trying to look at these accounts. We can maybe start with any, we can start with any account, because I'm seeing this one has more information. We can start with any account. We can start maybe looking at, maybe you start from this bottom left. Maybe we start with the capital account. Since we are the first talked about the capital account, let's start with the capital account, because we have just talked about the capital account. So let's start with the capital account. Now, the capital account, we can see that there is only one side. This one side that you are seeing, the transaction happened on June 1st, and that was a cash transaction. So this is the money that we started the business with, and it is cash of 10,000. 10,000. Most of the times you'll find that in these accounts, when they draw the account like this, they always put a currency here, shillings. If you're using dollars, then you put US dollars, whichever currency you're using. But here, I did not incorporate that, but just know it is supposed to be there. Now, when you look at that capital account, I said it has, we've seen that it has only one entry that happened on June 1st. Of course, when you are starting the business, you start by introducing in the capital. All these accounts are for the month of June, so it is on a monthly basis. You can see that at the beginning here, I left a gap when I was drawing these accounts. I left a gap because we don't, the question never gave us a year. But if you have the year, as I told you, when you're posting things to the ledger, you start with the year. If it is 2025, June, you followed by the month, then the date. If the date is 30th, we start with the year. Reason, because this year doesn't really change most of the times in these ledger accounts. It takes long to change, but the month keeps on changing. What changes often is are the days. Because the days, if you are working in days, you are going to find that these days are going to keep on changing constantly. So that's why we put, when we start with the year, the month, we are only going to change the things until they change. Maybe if the next transaction is going to happen on July 1st. So you are seeing we are only changing the month, but we don't write the same year 2025 because it was already written up here. But if you use the other format, the date format, of maybe starting with the day, if you start with the other format, you will see that you will find yourself getting things mixed up. They will not be following. If let's say you start with, maybe it is 2nd of June 2025, you will see that this one is not going to be changing, but it is the one that you have put first. So it means you are going to be writing, maybe if you go on 3rd, 4th, it will look awkward. So that's why we prefer the other date format. So that's the reason as why you are seeing some space there. I left that space simply because we might be working in different periods. So we have put the same 10,000 on the debit side. You are seeing here on this account, we have the same 10,000 here. We have the same 10,000 here. And that same 10,000 is as of June 30th June. That's when we close off the account, because the month of June has 30 days. So we close off the account at the end of the period. So the end of the period now is the end of the month of June, which happens on 30th June. So it will be now the balance carried down of 10,000. And this 10,000, of course, we have closed off. The moment you see double underline here, when you have double underlined something, it means you have closed off that account. What comes next after that double underline will be in the next period. So that's why you are seeing this one. The balance that we have in the capital account, it is on the credit side, but it happened on July 1st. Because that is the next month, that's where we have the balance brought down of 10,000. If we had made some, maybe we have taken out capital. You have to understand that drawings, most of the times drawings can be for cash, but there is when when the drawings are for capital, you have withdrawn the entire capital, because you might have you might pick some cash amount. Most of the times we put it separately. This is what I told you because we had agreed that the owner's account, we don't write it in accounting, or we don't draw the ledger for owner's account. But what we only do, we always separate the drawings column and then the capital column from the owner's account. And we make sure that we debit the drawings account and then we credit the capital account. This is what you are seeing. This is basically what we do in accounting, but it comes from the other aspect. Otherwise, if this was an owner's account, then the drawings account and the capital account wouldn't exist. I hope you remember what we had discussed earlier. So you have seen that we have put that on the last day, that balance carried down. Then the balance brought down, that is the balance that we have at the beginning of the new month. Since the other one was carried down, this one is going to be brought down. when it is July 1st. So this closing balance of the balance carried down, the 10,000 you are seeing here, will be brought down in the next month as 10,000. Meaning this is the money that we shall have at the beginning of the new month, which is July 1st. And it must be the same amount. This is 10,000, even here we have 10,000. But these amounts are supposed to be on opposite side of the account. So since the balance carried down was on the debit side, then the balance brought down should be on the credit side of that capital account. I hope now we can be able to understand and get some refresher on what we had talked about, things to do with capital accounts. So let's now look at maybe the cash account. Because we have seen that the first entry went into the cash account. So since here we have cash, then it is a must that within the cash account we must have an account title for capital to complete the double entry. And this was a credit entry, so in the cash account it must be a debit entry, because in the capital account, in the capital account, we have it as a credit entry, meaning within the cash account we must have capital as a debit entry. That is the double entry rule, and it's still the one that we are practicing, because the moment you understand the double entry rule, then it means you have understood accounting, because that's the golden rule. So you can see it just within the cash account, we have capital which happened on the same date, June 1st, of the same amount, 10,000. So it must be reflecting within the same amount. This one is 10,000, even what we had in the capital account was 10,000. The moment you see any deviation, then just know we have what we call errors. We shall understand when we come to the topic of errors. So that's the first entry, but our aim for today is not to let you understand the double entry, because we have done it, or posting items in their respective ledger accounts, but we have to balance off the account. We say the first step in balancing off an account is to add up the totals. If you add up the debit side of this cash account, you are seeing this is 10,000. So it is a 10,000 plus the 800, that gives you 10,800. That is the total you are seeing here. So we add up this side. This side is 6,000 plus the 100 plus the 1,080 80 shillings. So when you add this one, you don't add it, because this is the balancing figure that happened on 30th June at the end of the month. So when you add this, you will see that it's this side, the debit side is bigger than the credit side. So we take the bigger amount to be the total for both sides. That's why here you are seeing us, we have 10,800, and even on the debit, on both on the credit and the debit side of this cash account. So this 1080, even this one is 1080. Then, as I told you that we always leave a gap, you are seeing this gap that we had left here was the one that we used to write the balance carried down. So once you get the totals of this, of course this is 7,180 is the one that we are supposed to deduct from the 10,800, and we see that we have a balance carried down of 3,620. So that's 3,620 is the balance carried down, or is the balancing figure for this account to balance. So you are seeing, if you add this, if now you add all of this, you add this plus this plus this plus this, you must be getting the 10,800. So since we have a balance carried down on the credit side, the balance brought down should be on the debit side, but it should be in the next period, because we have closed off this account. You are seeing, as long as you have closed the period or the period has ended, you make sure that you do a double underline. You double underline the figures. Now, you are seeing that the balance brought down for this cash account, the 3620 is happening on July 1st, which is a balance brought down for that period. Meaning, when we start spending in July, we are starting off that month with the 3620. That is the implication. So that's how we balance off these accounts, and we are going to do the same thing for all these other accounts. But as I told you, we are going to go into each one of these transactions separately. So we have now finished looking at the cash account. We have got its balance. Then we now get to another account. Maybe let's now look at the bank account. Since it is the next one, let's look at this bank account. This bank account, we are seeing that we have cash that happened on 2nd June. This cash, you are seeing that in the bank account we have a cash, meaning this amount must reflect in the cash account. You are seeing here we have bank. So that's the implication. So what that means is that this bank account, we have to compare two sides. We look at the debit side, we have 6,000. We also add up the totals of the credit side of the bank account. This is 10,000, this is 1,000 plus the 500, that is 1,500 plus the 4. No, this is a balancing figure, we don't add it. This is 1,500. That is the amount that happened or that transpired within the month of June. Now, since this side is 1,500 and this side has 6,000, this debit side is bigger than the credit side, meaning the balance carried down or the balancing figure is supposed to be on the credit side, the side that has the smallest totals. So we have now taken, we take the highest figure to be the total for both columns. So we have 6,000 here that we have closed off the account with a total of 6,000. Even here we have 6,000, but we have closed. The moment you see double underline, you just know you have closed off the period. Now, this, you get now the difference, the 6,000 minus the 1,500. And that gives you a 4,500. This 4,500 will be a balance carried down, and it will happen at the end of the period, which is 30th. And it will be called a balance carried down of 4,000. And the reason as to why we put it on the side that has the smallest amount is because we want to make sure that those two sides are equal. So when you add this plus this, you have to be able to get the balancing figure, the total, the balancing total of 60,000. Since this is a balance carried down, then the balance brought down must be on the opposite side of the account. So you are seeing it, the balance brought down is on the debit side of this bank account, and it happened, it is the balance that is going to be there as of July 1st, and it will be called a balance brought down. If this side you have maybe called it carried forward with that, then this side you have to call it balance brought forward, meaning it is balance that has been brought from the previous period to a new period. So that's what we needed to do to close off that account for the bank, and that account is done. So we can also go to the other accounts, because I told you we take each account separately and then we balance each and every account. So after we have balanced off all the accounts, of course we also have the sales, but you can see that the sales has only one item that happens on Jan 8th, which was cash, meaning they sold some for 800. You are seeing there was nothing. That's why I just closed off from here. As per the examination, make sure you first provide the total. That this is 800 for both sides, because that's balancing off. That's what balancing off means. Then you put a double underline. Then you leave a space for where, because this side has 800 and this side had nothing. So that's why you are seeing balance carried down here as at the end of the period, meaning the next period, which is July 1st, we shall have a balance brought down of the same amount. Then we do the same for all these accounts until we are done with all of them. When we are done with all of them, but I'm very sure you can now know how to balance some of these accounts. You can pick one account from this. You can pause a video, make sure you go through this account and make sure you adjust those balances accordingly. So once we are done with that, the next thing that we are going to look at is going to be the trial balance. The next thing to look at is the trial balance. Now, what are we going to do within a trial balance? Now, when you are doing a trial balance, what we need to get are the things that we call the balances, which are the debit balances, debit balance, and then the credit balance for each and every account. An account which doesn't have a balance, don't take it, meaning it will not appear in a trial balance. Otherwise, if you put it there, it is going to make your trial balance known to balance. So we need to get these. We call these two balances. We call them balance on account. Balance on the account. Balance on the account. It is either going to be on the debit side or on the credit side of each respective account. In other words, we are taking the balance brought down, whichever the balance brought down up, wherever it appears is where we are going to pick this information and we feed into our trial balance. So the balance, the debit balance will appear on the debit side of of the trial balance. And if any account has a credit balance, then it will appear on the credit side. Of course, the debit balance, as I told you, we've looked at some of the accounts that had a debit balance, those that had debit balances. We can see that for instance, we have looked at cash. We saw that cash account had a debit balance. This balance brought down was on the debit side. This amount you are seeing here, this one, that is the balance brought down. That's the balance we are taking to our trial balance. And we can also see that the bank also had a debit balance, because the balance brought down is on the debit side of the ledger account. Then we can also look at those accounts that had a credit balance, like the sales account. If you look at the sales account, it has this amount. The 800 is on the credit side of the sales account. The same applies to the purchase returns, or what we call the return inwards, and the same applies to what we call the capital account. We explained what are some of the accounts that probably would have a debit and a credit balance, as we saw earlier on. However, we are going to pick this balance brought down. As I told you, we are only picking the balance brought down. We don't pick the balance carried down. So take note of that, because you'll always see that wherever the balance carried down is, the balance brought down will be on the opposite side. Just like the way you are seeing the balance brought down this side, but the balance carried down is on the debit side, this balance brought down is going to be on the credit side of that same account. So they are going to be on opposite direction. So we are taking the balance brought down and not the balance carried down. So we are taking these balances. Wherever you are seeing a balance brought down is the one that we are transferring. We only transfer the account title, which is the sales account. Of course, if the title up here says account title, then there is no need for you to write in the particulars and you say sales account, because you will be repeating. This side says details or particulars, so you just say sales. So we are picking this and its balance brought down for all these accounts that we have. We can maybe start off by looking at the capital account. We pick out its balance and we transfer it to our trial balance, or we can follow what we have here. The capital account, we can see it had the balance brought down was on the credit, so we have transferred also to the credit. You are seeing the cash had a debit balance, bank had a debit balance. We have put them in the debit side. This is the debit side of the cash. This is the debit side and this is the credit side. We have seen that sales had a credit, also capital had a credit. All these other ones, the discount received had a credit, and also the purchase return had a credit. All these other ones had a debit balance. So we have to make sure that when you sum these figures, you add all these totals, and when you add all these totals, they must be equal. If you have done these accounts in the right way and you have transferred the right balances, then they are supposed to be equal. That's why here, down here, you are seeing this is 11 220, even this one is 11,220, and those are the totals. So that's how we make entries and how we balance off those accounts. And later, we have seen how we can be able to extract the trial balance. If the trial balance doesn't balance, then it means there is a mistake that you have made in some of the entries. So the next video we are going to look at will be about the books of original entry. So that's all for today, and we'll see you in the next video as we are trying to look at the books of original entry. Hello viewers, welcome back to our YouTube channel, and today we are going to look at another session regarding the books of original entry. Books of original entry. Books of original entry. Some books call them the books. The books. So we are going to look at books of original entry, or what we call the day books. But you have to remember that we already spoke a lot about what we call the accounting books. Spoke a lot about the accounting books, and I'm going to take just a quick recap of what we have done so far in regards to accounting books. But our focus for today is all about the books of original entry, or what we call the day books. We have so far learned the accounting books, or the accounts books, or the books that we use in accounting. We have learned that these books can be split into main categories. We looked at the fact that we have what we call principal books. We looked at principal books, and at the same time, we looked at what we call the books of original entry. Books of original entry. And these books of original entry, they can also be called subsidiary books. Subsidiary books. But we prefer to call them books of original entry. But now, we saw that the principal books we saw that the principal books are the ones that we call ledgers. We saw that the principal books, these principal books are the ones that we call ledgers. And these subsidiary books, or the books of original entry, if you don't call them subsidiary books, we usually call them books of original entry. However, under the principal books, we said we have what we call ledgers. Under the principal book, we said we have under the principal book, under the principal books, we said we have mainly, we have the ledger. And this ledger is the main principal book. The ledger is a principal main book, or is the main principal book, as well as the cash book. As well as the cash book, which is also seen as a ledger. And the reason why these two books are called the principal books is because they follow what you call the double entry system. That is the main reason as to why they are called principal books, because they follow what you call the double entry system. That is the golden rule of accounting. Now, when we talk about the subsidiary books, these subsidiary books, these are books where transactions are first recorded. Meaning that these subsidiary books, that's where transactions are first recorded before they are transferred. Or before they are posted in different respective principal books. So we first register within the subsidiary books before we transfer those figures to posting them in the ledgers and the cash books. So what we are going to do is that we are first going to learn how to record transactions in the subsidiary books. So you first have to understand how to record the transaction in the subsidiary books. And we've said that these subsidiary books can also be called the day books. If you don't call them the day books, you can call them the books of original entry. Books of original entry. And the whole meaning is that these are the books where transactions are first recorded before they are transferred to the main book, the principal books. As I've told you, the categories are two. The categories of accounting books are two. We have the principal books and then the subsidiary books. But within the subsidiary books, that's where transactions are first recorded before they are transferred to the principal books, which includes the ledgers and the cash books. So what we are going to do is we want to first learn how to record the transactions into the subsidiary books, which are also called books of original entry, or the day books. Day books means it means a day, then a book. Something that happens on a daily basis where we record it. That book is a subsidiary book. And afterwards, after recording that information in that first book, we will then learn how to post transactions in the different ledger accounts. And that's what we are going to be doing. But before I list the various books of original entry, let us look at the names that we give these books, because I told you that there are so many names that we can give these first books. So among the names that we have listed, I want to add on some other names that you might find, because I don't want you to find a name and you start asking yourself whether it's really the so-called name. The other name that I want to add on these three is that we can call them books, because we are going to be looking at different books. Different books give them different meanings, and I just don't want you to get lost when you find that they have named in a different way. So other books, they call them books of prime entry. Books of prime entry. And sometimes they are generally called journals. Journals. And some of the other books might call them books of first entry. Books of first entry. Books of first entry. Then other books, they call them day books. If they don't call them day books, they call them books of original entry, or they call them books of prime entry, or books of first entry, or they call them subsidiary books or journals. So all these names, they mean one thing, or they are representative of one kind of books. They all mean the same thing. So all these are books in which transactions are first recorded. And once there is a transaction, for example, you can get an invoice or anything, then you first record it in a particular book of original entry before you post that transaction into a ledger or other principal books. And that's basically the reason why they call them books of original entry. So, since it is the origin of double entry, then they have to make sure that you have all these documentations done in the right way. But the key issue when you are recording the transactions, they are recorded in the order of their occurrence. So what you have to note, having known all these names, the key issue is that we have to record the transactions, transactions in their order of occurrence. In their order of occurrence. In other words, we put them in what we call a chronological order. Chronological order. In other words, if a transaction happened, let's say we are in January, and the transaction happened on 1st Jan, it should be written first. The one that happened on 2nd Jan should be written second. But not having a transaction that occurred on, let's say, 5th, or that happened on 10th, let's say 10th Jan, to be the first transaction that will appear in that book. No. You write these entries as they are occurring, meaning you are right. That's why we are saying they are books of first entry. That's where you first record the transactions immediately when they have happened, before you transfer them to other books, because even when you are transferring to other books, you have to follow the order. You can't put a transaction that happened on 22nd and you put it as if it happened on 1st of that month. So that is the whole idea. It is very important that we follow that order, because you cannot record a transaction that happened on a given date and you record it as if it happened on another date. As long as those transactions they were happening in the same month, they should follow that chronological order, or in the order of occurrence. Now, I'm going to list down the books that follow into this category, which are the books that we call the books of original entry. So I'm going to record all of them and we see what we have. So let's have a list of books of original entry. The first one, we have what we call the sales journal. Remember I told you it can also be called a journal. The second one, we have a purchases journal. The third one, we have what we call sales return journal, or the book. The fourth one, we have what we call the purchase return journal. And also we have what we call the general journal. And finally we have the cash book. But let me write this cash book using a different color. I will explain why. This cash book, because we have seen a cash book appears in books of original entry and at the same time appearing in the principal books. And the reason is very simple. We say that a cash book is appearing in the principal books because it follows the double entry system. That's the only reason as why it is categorized the other side. But otherwise, if it wasn't following the double entry, because when we are recording in a sales journal, we don't follow any order. We just follow the order of occurrence. But when you are registering in the cash book, we register transactions following the double entry. That's the only difference. So this one will just follow the order of occurrence, but the other side in the principal books will follow the double entry system. So if you are the one, maybe you have been wondering why we are writing a cash book here, is because a cash book of course, we know that in accounting, a cash book is the only book that belongs to both a book of original entry and at the same time belonging to principal books, or what we call the ledgers. And it's belonging to the subsidiary because the transactions are first recorded in them. And it's the book of original entry for all the cash transaction. So this records everything that has to do with cash. So that's why we are saying it is belonging to the books of original entry, because it records transactions for the first time as they are occurring, as long as they are cash in nature. But the other argument is that when it comes to principal books, it belongs there because a cash book, even though it's a book of original entry, also follows a double entry system. And those books, those principal books, they are there for them to execute the double entry system. And also a cash book does that. It executes the double entry system, which means that these first 5 books of original entry don't follow the double entry system, and that's the meaning. That's why you are seeing me putting it in a different color. So these first 5 books, they don't follow the double entry, but this one follows, and that makes it to go into the principal books and at the same time happening under the subsidiary books. Now, before we move to the practical aspect, which is the main objective for this video, I want to emphasize on some important aspect of what we are going to be doing, or what we are going to do. And we are going to look at the purpose of these books, each one of them. For example, if let's say we look at maybe the sales journal, for example, this first sales journal. The sales journal, for example, the purpose of this sales journal is to record credit sales. The purpose of this credit journal, the sales journal, is to record only credit sales. So it records credit sales alone, and any transaction other than a credit sale, it will not appear in the sales journal. So the sales journal will record credit sales alone, and any other transaction that is not, that will not come to that sales day book. So when you are going through the transactions, because in the exam they are going to give you a list of different transactions that transpired or that occurred on different dates. When you go through those transactions, you have to make sure that you look out for the credit sales, and you know that those are actually going into the sales journal. But if you see maybe a cash sales that are cash in nature, please don't be tempted to put them in this account. Then the other thing that doesn't fall into the sales journal is a sale of a current asset. Sorry, a sale of a non-current asset. For example, we have sold, let's say, a motor vehicle, and our business is not dealing in selling motor vehicle as its inventory, then we are not supposed to include. That will be called a disposal of a non-current asset. So as long as you are seeing there is a sale of a non-current asset and it is not a sale that we know, of course we know a sale, it is from the normal trading inventory of the business or stock of the business. If the company doesn't deal in selling, let's say, those non-current assets, because it might be a property agent, a property company where it buys and sells land and buildings, then it would mean that their inventory would be those land, even though they are fixed assets, but that would be their inventory. But as long as that's not the case, then we are not supposed to include that into our sales journal. So whenever we talk about a sale, we are basically looking at disposal of stock or inventory. Now, when you look at, of course, when you look at these, the purchases journal, when you look at the purchases journal, it also caters for credit purchases alone. This purchases journal caters only for credit purchases. And that means that apart from these credit purchases, we don't bring any transaction into this purchases journal. We only record credit purchases. If the purchase happened on cash, then it's supposed to go into the cash book, because a cash book is the only journal that records cash transactions. So when we say purchases in accounting, we are referring to the goods or the stock or the inventory that has been bought with the intention of reselling. So whenever you see that maybe the business has bought or has purchased a non-current asset, we don't call that a purchase. Purchases are only stock that we bought for the purposes of reselling. And what we only include in the purchases journal are the purchases that happened on credit alone. If you purchase using cash, you have to transfer that to the cash book. Now, let's look at the sales. Let's look at these sales return journals, or what you call, sometimes they may call them return inwards journal. And these are returns of credit sales. This handles credit sales returns. What you have sold and they have returned it. Maybe the product was not functioning well and the customer returns the good. That's where we record it. But we only do that if the sale was on credit. If something had been sold for cash and the customer has returned that product, we don't record it in the sales return journal. We only record transaction that initially happened on credit. If the sale wasn't on credit, we don't include it. So when the return of a credit sale is done, we record it in the sales return journal. Now, when you look at this one, the purchases return journal. The purchases return journal will be for returns for credit purchases. Whatever that we bought on credit, and maybe we found, maybe the supplier sent the commodities, but we found maybe the commodities are not aligning with what we requested. Maybe we requested for soap, but maybe for a specific type of soap. Then the supplier gave us a different brand. Then we can return as long as it was on credit. But if we had paid money, then the adjustment would not be done within the purchases return journal. It would be done in the cash book, because the other supplier will have, either if he doesn't have the brand that we want, the supplier will return back our money. But here we don't have any, we have not paid money. It means we are only reducing on our debt, on our debt with the supplier, because we didn't pay the money. So you have to get these very clearly. The moment you get them, you never fail anything to do with books of accounts. So you can now see that these first 4 books, you can see that these first 4 books, the sales journal, the purchases journal, the sales return journal, and the purchases return journal, you can see that those first 4 books, they are dealing with credit purchases or credit sales. So the first 4 books, everything is on credit transactions alone. And those are the only things that are going to appear in those books, these first 4 day books. But now when it comes to the cash book, when it comes to the cash book, this last one, when it comes to the cash book, then it's for all cash transactions, as long as there is cash movement, any cash movement. As long as there is a cash transaction, there is movement of cash, either cash coming in or cash moving out, then we record those transactions in the cash book. So here with the cash book, as long as it is a transaction that happened on using cash, we don't care whether it is which item, whether it is a sale, whether it is a purchase, whether it is part of purchases or it is part of the non-current assets, as long as it happened by cash, whether you are selling assets. So once they are involving cash, either coming into the business or going out of the business, then we will record that transaction in the cash book. And that's the reason why these 4 books, these are the 4 books that are on credit transaction, and the cash book is for cash transactions. Now, I want us to look at something different. We know that we have cash transactions and credit transactions. And I'm saying that all cash transactions are taken to the cash book, and all credit transactions. Remember here, I've told you that all cash transactions are going to go into the cash book, all of them. We don't care as long as cash was involved. But the other thing that you need to note is the fact that not all credit transactions are covered by these 4 books. These 4 books are specific to each item. They are handling a specific item. But there are those things that are going to happen on credit, which are not going to be sales or purchases or any of their returns. The moment you realize that it's not a credit sale, it's not a credit purchase, It's not a credit sales return, and it is not a credit purchases return. Then the question is, where does that item go since it is on credit? Remember, if it had happened on cash basis, then it would have gone to the cash book. So you have to note that not all credit transactions that are covered by the business are going to be recorded in these first four books. Those first four books only covers purchases and sales. Therefore, we need to ask ourselves, what happened to other credit transactions that are not purchases and sales? So all these other transactions that are not purchases and sales, they will have to find themselves in what we call the general journal. Therefore, once you look at any transaction, any general transaction, after removing those transactions that we have specifically looked at that are meant for some books, then the general journal will take any other transaction that is not belonging to any of these other four journals that we spoke about. However, you will also need to note that the first four books are specifically made for specific transactions. The cash book is made specifically for cash transactions, but for the general journal, there could be so many other transactions that could appear in it. Therefore, we call those special journals that are specific for certain transactions. And if you want to talk about specific journals, then we have to give special books of original entry, because for them, they are tailored to a specific transaction, except the general journal. So some of these things, as I emphasize on them, because I know some students are going to be doing some objective questions. They may tell you which of these item or which of these day books is not a specific book of original entry. That would be a general journal, or what we call, sometimes they call it a journal proper. Now, what we are going to do is first focus on these first four day books. And for the cash book and the general journal, we shall have a specific video lecture on them, one by one. But these first four, since they are going to be looking at a specific item, then we have to make sure that we handle them separately. So, I want us to learn how we can make entries in a sales journal, how we can make entries in a purchases journal, how we can make entries in a sales return journal, and how we can make entries in the purchases return journal. And remember that I told you that these are credit sales and credit purchases. And the returns of both of them, that's how we want to use, that's how I want us to look at these four journals that I have specifically talked about. So what I'm going to do is to give you a format of the first four journals, which are the sales journal, purchases journal, sales return journal, and then purchases return journal. And the good news is that all these four have the same format, that when I give you one format, you can use it throughout for all these four books. So once I give you a format for this, then you will be able to use it throughout for all these four journals. So format of the journal. And remember the journals that we are talking about. We've said we are going to talk about the sales journal, purchases journal, sales return journal, and then the purchases return journal. So we have the date. We start with the date. That's when the transaction happened. Then we put the details, or what we call particulars. These are the details, what that transaction is all about. The format of the journal. Format of the journal. Format of the journal, we start with the date. We start with the date, followed by the particulars column, or what we call the details. Then we have the folio. Folio, I told you it is more of a reference. Folio. This folio column is always small. You can call it folio or ledger. Then you always have the details. The details, then the amount. The amount is always in, you put the currency. So you can put it as shillings. So here it depends on the heading that you have. It will depend on the headings that you have. It might be a sales journal. So any heading that you want to give to this format, if it is a sales journal, then you call it a sales journal. Of course, you call it a sales journal on the top, then you proceed and go ahead to write what you want to write. But the same format will work for purchases journal. The same journal will work for the returns of both purchases and the sales. So there is a date column as the first one. We always have a date column as the first one. There is also a column for particulars. There is a column for particulars. There is also a column for folio, or this one you can call it a ledger. There is also a column for details. This column for details, and there is also a column for amounts. So detail column, this one and this one. The detail column, because in the details it's where we will work out for the discounts, if any. Within this is where we are going to have things to do with the discounts, if they are there. Either discount received or discount allowed. Now, of course, this one is also in shillings. We put it in shillings because the amounts are going to be in shillings. Now, we have to take note that this format, like I said, it works for all journals. And then what you should also remember is that these books don't follow a double entry system. They don't follow a double entry system of recording. So when you are recording to them, they don't follow. They don't follow the double entry system. Otherwise, if they were following the double entry system, then they would be called principal books. So it is very simple, because when you meet any transaction, be it, as long as it is a credit sale or a purchase, you are not supposed to do a credit or a debit when it comes to books of original entry. And what you only do over here is to list you just list. This is just a list where you will just list the transactions in order of occurrence, which is what we call the chronological order. Now, as I said, we start with the dates, then particulars, and these will be the same name for debtors or creditors, and then followed by, of course, the dates here that we are going to have. We are going to have the dates for when the transaction happened, and within the particulars, we are going to either have debtors or creditors, depending on which one we are working on. If it is a purchase, then we are going to have creditors. If it is a sale, then we are going to have debtors, because they are going to be on credit sales or credit purchases. Then we shall have a folio or a ledger, and that will be a number that will be referencing either a debtor or a creditor or a supplier. So it can be because you may be having very many suppliers who have given you goods on credit. Maybe you have supplier 001, 002, 00. So you give them supplier numbers, and the same applies to the debtors numbers. So this 001 will be reflecting in the purchases ledger. I hope you are getting, because now if let's say you have written maybe Chuck's Holdings Uganda Limited as maybe your supplier, you'll find that Chuck's Holding will have his ledger account, and this ledger number will be appearing there. So when you are posting these transactions, you also have to include these reference. They are just reference numbers. Of course, when you look at this journal, if let's say it is a purchases journal and you have maybe a ledger number 001, you will just check maybe it is this supplier 001. Then when you look at that, it will give you a reference where to find this same information for that particular supplier, because you might receive one supplier or 5 suppliers, but each supplier is going to be supplying you goods or products or services at different intervals. So you may find that one supplier has supplied the business maybe for 5 times in a year. So you'll have those different items but they are going to be all belonging to a similar supplier number, because you allocated those supplier numbers to each and every individual. So the folio column will be followed by the details. This details column is where we are going to calculate the discounts, and the discounts we are going to apply that are going to be here are the ones that are discounts which are not of cash. We don't have cash discounts here, because we said everything that deals with cash is supposed to be in the cash book. So the discounts that we are talking about here, they are going to be what we call the trade discounts. Trade discounts. They are not cash. Maybe someone can tell you, if you buy 10,000 kgs of sugar, I'm going to give you maybe a 50 kgs free. So you'll find that this is a trade discount. It's not a cash discount. So those trade discounts are the ones that we are going to be adjusting in that details column. That's why you are seeing we put shillings, we put currency, to show that we are actually going to have amounts there. But it's not a must that on every transaction, either a purchase or a sale, we are going to have trade discounts. So we shall look at the different aspects to do with the discounts. But one key thing that you need to note is that these are trade discounts. They are not cash discounts. And we'll explain later when we take maybe a practical question. Then the last column, of course, we have the amounts. That's where we put the final amounts. However, we said that there is a discount. There is a discount, but the discounts we refer to here is different from the cash discount that we use or that we normally see in the 3-column cash book. You have to take note. So the discount in this is different from what we see in the 3-column cash book, as well as the discount we see in the ledgers. Because what we see in the ledgers or what we see in the 3-column cash book is what we call the cash discounts. But that's where those because within the ledgers, the cash book and the other ledgers, that's where we have those two different types of discounts, which is a discount allowed and then the discount received. But here we basically we have trade discounts and not discount allowed or discount received as they appear in the 3-column cash book. But our two main types of discounts, we have trade discounts and then cash discounts. But among the cash discounts are also categorized into what we call the discount allowed and then the discount received. But the trade discount is different, and when it comes to the day books, then it's the trade discounts that apply and the cash discounts don't apply, but the cash discounts will appear in the ledgers, and that's the difference. I hope you'll be able to understand this because you may get confused. So once we see that we have, maybe in the question we have been given trade discount, then we can apply it. But if you see that they have given you cash discounts, then you are supposed to ignore them because it's not related here in the day books. They are not recorded here in the day books. And that's That's the practicability of trade discounts and cash discounts as far as the day books are concerned. We don't have cash discounts within day books. So without wasting time, I would like to take maybe a practical simulation, and we try to be a little bit straightforward to see what really transpires or what really happens when we are trying to solve a practical simulation. So let's write down the question. Simulation. Let's just use any sole trader here. Let's say Ivan, a sole trader, a sole trader Ivan, a sole trader, made the following transactions. The following transactions in January 2023. So we start with January. We are trying to, we are January 2nd, credit purchase from KC Group. We have the amount as 4,000. Ugandan shillings, comma, Stuart, 3,000, comma, James, 2,500 shillings, full stop. In each case, we are continuing that in each case, a sole trader received a trade discount. In each case, a trade discount, let's just say a trade discount, a trade discount of 10%, a trade discount of 10% is allowed. Trade discount of 10% is allowed. Then we go to the next transaction. The next transaction happened on January 5th. We have credit sales to Bosco. Credit sales to Bosco, 5,000 shillings. Linda, 3,000 shillings. Emma, 2,000 shillings. Full stop. In each case, trade discount trade discount of 15% is allowed. Then the next transaction happened on 10th. Credit purchases from ABC Limited of 4,000 shillings. Samota Limited 2,500 shillings, comma, Odong 2,700 shillings, full stop. Then the other transaction happened on 15th, where we have credit sales to Okelo 6,000 shillings, comma, John 3,500 shillings, comma, Julius 4,500 shillings. Full stop. Then the other transaction happened on 20th. Ivan returns goods to Stuart worth 200 shillings, comma, James 300 shillings, comma, ABC is 500 shillings, full stop. Then the other transaction happened on 25th. That is goods returned to Ivan from Bosco. From Bosco we have 1,000 shillings, comma, Julius 400 shillings, comma, Okelo 800 shillings. Then the other transaction happened on 28th. 28th we have a credit sale to Linda 6,600 shillings, comma, subject to 15% trade discount. Subject to 15% trade discounts, comma, then John 1,800 shillings, full stop. Then the transaction that happened on 30th was a credit purchase from KC Group 3,000 shillings, comma, ABC 2,200 shillings, comma, this one's a full stop. So we have the required part A, open a relevant subsidiary books. Open the relevant subsidiary books. Then part B is post the items to their relevant ledgers. So that's what we have. So want to look at the solution. How do we able to do what they have told us to do? Now, what we are going to do is that we are going to open the relevant, for part A, we are going to open the relevant subsidiary books. Subsidiary books or books of original entries. And we are going to use the format that we have just seen. So we are going to put all those items in their respective subsidiary books. But part B, they want us to post the transactions to the ledgers, post to the relevant ledgers. And we said the ledgers are either ledger accounts or a cash book. So that's all that they want us to do in this number. So you can go through the question and see what they want. So they told us Ivan, a sole trader, made the following transactions in January 2023. They started with January 2nd. We've seen some credit purchases. They went on to June 5th. Then we had some credit sales. They went to January 10th. We had some credit purchases. Then we went to 15th and we had some credit sales. On 20th, we had some returns. Ivan returned goods to Stuart. We need to know, is Stuart, because Ivan is the business. So if the business is returning goods, it must be, these people are supposed to be suppliers, because Ivan can only buy from the suppliers. So once you see Ivan returning goods, then you have to know that these Stuart, ABC, and James are suppliers. Then on 25th, they told us goods returned to Ivan. Goods were returned to Ivan. Ivan is our business. So Ivan is a sole trader. So they are returning goods to the business, meaning that these were the customers returning goods to the store. So Julius, Okello, and Bosco, they are supposed to be customers to Ivan. Of course, on 28th, we had some credit sale to Linda, then and James and John. So the last transaction that happened on January 30th, we had credit purchases from ABC and KC Group. So those are the things that we are going to look at. So what we are going to do, we are going to make sure that we draw each of these accounts. We can draw all the 4 formats at once because we said we are going to be having the same format. It's only the headings that are going to be changing. We are going to have the same for purchases, for sales, and then the sales return and the purchase return journals. We are going to have the same format. And that's basically what we are going to do. So we have Ivan as a trader or as a sole trader who have made the following transactions. So we have seen the first transaction happened on January 1st, on January 2nd, where we had credit purchases from 3 people. And each amount, we are going to be deducting a 10% trade discount. But now we know that credit purchases go into what we call the purchases channel. And as I told you that it's only the cash purchases that will not appear in the purchases channel, because we told you that those ones will go into the cash book. So if there is anything that is related to cash purchase, will be transferred to the cash book. So let's now maybe have the format. We start with that first transaction. We start with the purchase journal. It's a purchase journal. You can start by writing the name of the person, that is the sole trader. That is purchases journal. The format is we start with the dates. We have a column for particulars. We have a column for folio, or what we call the ledger. But this one is always a small column. Then we have details. Details column is where we write they are also supposed to be in shillings because that's where we write the discounts. Then we have the amounts in shillings. So that's our format. So the year must come first. Told us was 2023. 2023. Jan 2nd. January 2nd. So we start with the year, followed by the month, and then the date. So that's the format that we use in accounting. And because we assume that the days will keep on changing frequently, then when you have finished writing the year, then it's supposed to be followed by the month, and later on followed by the date, because most times the years don't change so much, and even if they change, they will still look uncongested. So the 2023 January 2nd, it's under the purchases. So it will come into the purchases journal, and the things that were purchases from KC group. So we have KC group, but they told us in each case a 10% discount. So we write KC group as particulars, and then because there is a discount, then of course, if this part was, since there is a discount, then we are supposed to adjust this for this 4,000 that was paid. But if there was no discount, then this space was supposed to be left blank. Then we put the whole 4,000 this side. But since there is a discount, we have to adjust this 4,000 here. The 4,000 is going to be adjusted by 10%. So we have to less discount. I'm just going to write discount, but just know it is the trade discount. Discount of 10%. So what is 10% of that? 10% will be 400. Once you less it off, then the balance will be the amount that you are going to take this side as 36. We are done with that person. Then we go to this. On the same date, we happen to have another supplier called Stuart. Still, we less off the discount. And this Stuart, we supplied us goods that were costing 3,000. So these were 3,000. Then you less off the 10% of the 3,000 gives you 300. Once you less it off, you'll have 2,700. We'll do the same thing for James. James supplied us goods worth 2,500. Then less the discount. Less the discount. The discount 10% of the 2,500 will give us 250. So it will be a 250. If we less it off from that, we are going to get the 220, the 2,220, the 2,250. Is 2,250 shillings. Then we look for another credit purchase. The next credit purchase happened on 10th, January 10th. So we are seeing that we don't write the January again. We just go on the date. We sold to ABC. And this amount never had any discount. So we will leave the discount part empty and we will record the whole amount as 4,000. On the same date, we had Samota. Samota also never had discount. Supply 2,500. We had also from Odong. Same, we never had any discount. So the amount is 2,700. Then the last one happened on 30th. We got goods from KC Group. Still never had discount, so it goes to 3,000. Then from ABC as well, which never had discount, which is 2,200. And that is all that we had to do with. That's all that we had to do with the credit purchases. So we get now the total. This is 2. When you add all of them, you get 22950. 22950. That is the total you close off. That's how we close off the account. So we have seen that the second transaction that happened on the same day, the one for Stewart, we also adjusted for the other column. We adjusted for the 10% tax. Then the one which happened on 10th and 30th never had anything to do with transaction, with trade discounts. So the same thing that we have just done for this credit purchase journal, or the purchases journal, is the same thing that we are going to do for all the day books until we finish them, because that's the only thing that we are required to do, since we are not going to be following anything to do with double entry system. So we shall do the same thing for all the journals. However, when we reach at the sales, at the returns day book, whether we are looking at return inward or return outward, for you to be sure you need to be sure that it's indeed a return. Because for you to know that I actually have a return, then you must look at a corresponding name of either a supplier or a customer. That is either a creditor or a debtor. So once you see that you have a return, you have to make sure that there is a corresponding creditor or a debtor in the purchases journal or the sales journal respectively, for you to recognize that indeed it's a return. Because the idea is that you cannot return something that you did not buy or you did not purchase. Then the other thing that you need to note as far as returns are concerned is the fact that you need to understand that when it comes to returns, we need to be careful, because when you are returning goods to the supplier, or when the customers are returning goods to you, then you need to be very careful for you to consider the fact that whether these customers or these suppliers gave you a discount at the time of purchase or at the time of sale. So whenever we are returning, we have to be sure that at the time of purchase, maybe from the supplier, or at the time of selling to the customer, we either enjoyed trade discount or not. If we have enjoyed the trade discount, then as we are returning the goods to either the supplier or when the customer is returning goods to us, we need to subtract the discount that they enjoyed in the question. If let's say for instance, if someone bought, maybe, like for instance, we bought these items from ABC for 4,000, but you find that you have enjoyed the 10% discount. That 10% discount of 400 we have enjoyed when we have purchased 4,000, meaning we only paid 3,600. We didn't pay the full 4,000 for the goods. So even when we are returning the goods, even if we are only returning, maybe we are returning 200, we are returning goods worth 200 shillings to the supplier, then we have also to subject this to the discount, to the trade discount that we received. If we are returning this and the trade discount was 10%, we are supposed to make sure that within the details here, we write the 200, then we add just by the 20, so that we can only deduct 180, which is the 90%, because we enjoyed a discount of 10%. So the discount that we enjoyed, either whether we gave a discount to the customer when we are dealing with the sales return journal or the purchase return journal, we have to make sure that we adjust the discount that we enjoyed. If we have not enjoyed any discount, then it's okay. We can take those figures the way they are. So you need to be careful with that. Then the other thing, as of course, when you are done entering all the values in the different journals, then what is left will be closing off the journals. As we said that when you are closing off the journals, you just add up the amounts in the amounts column. You just ignore the rest of the columns, and that's all that you are supposed to do with the journals. But before we conclude, let's talk about this folio, because we've skipped it, the folio column. This folio column, this one. The folio, I've told you that this is just a reference section. And I also told you that it's not all that important for you to actually consider this folio section, because at some point you can skip it. Other books may find when they are skipping it, other books are emphasizing that you put them. But when you are computing, it's more important, especially in practice. You have to at least indicate, because sometimes the documentation, the items may be so many that you may fail maybe to number some of them. But when it comes to ledger folio, it means it is more of a reference column that tells you where else you'll find this kind of information that is contained in each of these journals. Because we are preparing each of these journals independently, so it shows us where else we can find this information. For example, the information in the sales journal will be found in the sales ledger, meaning the values of the different customers will be found in the sales ledger. So if this was a sales ledger, we would just put sales ledger SL. Maybe we give it a number 001, depending on the different customers. That's what we are meaning for a sales ledger. And the same happens for these other ledgers. For example, for this purchase ledger, of course, we shall find this in this purchases journal. We shall find the information within the purchases ledger PL. You can put maybe PL 001 for the different customers, 001, 002, 003 for the different suppliers that we receive goods on credit from. So the PL will be the purchase ledger. However, we said that ledgers are basically pages, meaning that each customer will have a different page number, meaning that when you want to make a reference, then you should show that customer A or supplier A will be in a sales ledger or in the purchases ledger number this, but you go ahead to add a page number, because this is just PL, that is purchases ledger. But we say that these ledgers, they are like books. So we have to know that this customer is on such and such a page. Maybe customer PL, supplier PL 002 or 003, depending on the numbering that you have used. The same applies to the sales ledger. You may use maybe SL 002, 001, 003, and so on, depending on the number of customers. And these numbers that you have indicated will be the pages, because this is a book, a day book. We keep recording these transactions on a daily basis, and we record them in the order of their occurrence. So if I have received goods from KC Group, and this supplier was 001, the moment I have another supply from the same person, I will just write the same reference or the same folio. So that's the implication here. It will be that when I go into my ledger account, I'll just look for a customer KC Group, and I find the information is within the purchases ledger, but on page maybe 002 or 003, because each customer or each supplier is going to be on a different page. So you create one page where you are going to be writing all the items that you have received from that supplier, or all the items that you have sold to that customer. Each customer is going to have a page where we are going to be writing all the transactions that we are going to be going through with that same customer. So when it comes to the totals, of course, that's the same thing that we are going to be doing for all the journals. But now when it comes to getting these totals, getting the totals here, or when we are balancing off, we do the same thing that we are going to do to each and every journal. But now when it comes to these totals will be found in the general ledger. As far as the folio is concerned, it will be in the general ledger, because in the general ledger, that's where we are taking all the information, the totals that are relating maybe to sales returns, that are relating maybe to purchases return. Here for the total, it will be found in the general ledger. Because it is this general ledger that records many transactions, so you should be specific as well to identify where these totals are going to be found. So it is just a reference, the folio is just a reference item or a reference column. So you'll do the same thing for the purchases, for the returns, and others for the different journal pages. So these are the specifically important things, especially for the work issues, than in the examination. But even though we are saying that they are not all that important for examination purposes, you need to make sure that you give the correct reference, because if you don't actually know where certain item can be found, it's better to ignore and you don't put anything than putting a wrong thing. If you put a wrong reference, then it means you are just making your work complicated, because if someone opens the total and they maybe you have referenced these totals as maybe page purchase ledger, it will be a wrong thing, because in the purchases ledger we are going to have details of so many customers. Each customer is going to be on a different page, so you'll find that you are misleading the reader. But these are mainly done at work, because you are going to be doing so many numbers, you are going to be handling maybe very many customers, and you need to have information that is relating to your customers. So that's basically what we are required to actually do. So what I'm going to do is I'm going to try and draw the rest of the journal entries, but make sure you also do on your own, so that you can be able to keep practicing. This I'm just going to take very less time trying to draw them. So we are using the same format. Let's maybe look at the purchases return journal. We've said you have the dates, the same format, dates. We have the particulars. We have the folio. We have the details in shillings. We also have the amounts. in shillings. So this is 2023 Jan. The first transaction on returns happened on 20th, where we had Stuart, that is the supplier, but we had a discount. The return was 200, but on that person we had a discount of 10%, so less discount. We had enjoyed a discount of 10%, that will be a 20. 10% of the 200 will be a 20, so we shall be paying 180. That is the return amount that we will be having. Then we have James. The amount was 300. We have to less return the discount. 10% of the 300 is 30, and that will give us 270. Then we have ABC. For ABC, we never had any discount, so it is 500. Then we close off. That's the only thing that we had there. We get the totals. We just add this column, we ignore the rest. This is 950. As I told you, this will be found in the general ledger. So these are purchase returns that will be transferred to the purchase returns account. Then we do the next one. We can now start with the sales journal, then we conclude with the sales return. Sales journal. And have the dates, have the particulars, have the folio, we show the details, the shillings, then the amount. Amounts also, they are in shillings. So this one happened on Jan 5th. That is the first transaction. The customer was Bosco. We gave a discount, so less discount. But as I told you, this is a trade discount of 15%. Bought 5,000 for 5,000. Receive 15% of the 5,000 will be 750. So we take that off, and it will be 4,250. Then we had a customer called Linda. The amount was 3,000. Then less the discount. The discount was 10%. 15% of the 3,000, that is 450. When you less that, it will give you 2,550. 2,550. Then we have Emma. Emma, the amount was 2,000. This one also enjoyed a discount, so we less off the discount. The discount was 300, 15%, and that gave us an amount of 1,700. So the other sale happened on 15th. The other sale happened on 15th, and it went to Okello, but we never had any discount, so it was 6,000. We had another sale to John, which was 3,500. We never had a discount. We had another one to Julius, of 4,500. Then on 28th, we had the one to Linda, but we gave this one a discount, so less the discount. The amount was 6600. Then we less off the 15%, that is 990. When we do that, we get 5,610. Then we had John. John never had any discount, which the total amount was 1,800. So we get now the total. Totals. The total, of course, it is 29910. That is our total. The totals that will be found in the general ledger. Then finally we conclude with the sales return journal. Sales return journal. We conclude with the sales return journal. We have the dates, have the particulars, we have the folio, we have the details, we have also the amounts. Of course, we have the ones that happened on January 25th. We have Bosco. The amount was 1,000. He enjoyed a discount of 15%. So less the discount, which is 150. That gives us 850. With Julius and Okello, they never enjoyed. So Julius, the amount was 400, and Okello. Hello viewers, welcome back to our YouTube channel, CPH House Cafe Accounting Tutorials. And today we want to start looking at the cash book. We want to look at the cash book in details, and we see what it means, because we saw previously that the cash book is one of the subsidiary books that follows a double entry system. Two, we also saw that a cash book is also part of one of the principal books because of the fact that it follows the double entry system of recording. So I want us to dive in and look at what a cash book is all about. So we are going to look at the introduction to cash book. Introduction to cash book. Introduction to cash book. So that's what we are going to look at for now. So permit me to take off my video so that we can be able to concentrate on the screen as we proceed. So we have the cash book, and we want to understand what a cash book is all about. So the cash book, first and foremost, a cash book is a subsidiary book of accounts that is used to record transactions. And also, a cash book is also said to be part of the principal books because it's the only subsidiary book of account that follows the double entry system, meaning there is always a debit side of the cash book and also the credit side of the cash book, just like the way we've done for ledgers. Therefore, a cash book is seen like a ledger, is more of a ledger, or is more of an account because it follows the double entry system. However, a cash book is a subsidiary book because transactions of cash are first recorded in there. They are first recorded in that cash book. So once you refer to my first video about the accounting books, where we talked about the subsidiary books, where we've seen that we have some special journals or some special books. There are also the general journal, and we also said that the cash book is one of the special journals. It's a special journals because it only records cash transactions. So if there is any transaction that is not by cash, then it's not covered under the cash book. So it will not appear in the cash book. So that's what we can talk about. So it's both a subsidiary book and also a principal book that records cash transactions. That's as per the definition, or definition wise, that's what we can say. But now going forward, what we need to emphasize is that we always record cash transactions alone. Cash transactions, anything that doesn't involve in cash movement, then we don't record it in the cash book. So the analysis that we are going to be doing is we are going to be looking at the cash inflows and the cash outflow, what comes in and what goes out of the business, because the cash book is all about the cash coming in and the cash moving out. However, I want to repeat that we are going to talk about the main levels of a cash book, which include the following. We have the main, if you look at the cash book alone as the cash book, it has types. We have different levels of cash book. We have the first one, which is the single, let me use a different color. We have the single column cash book. And then we also have a double column cash book. This one is also referred to as the two-column cash book. Then the other, we also have the three-column cash book, or which is also known as the triple-column cash book. Now, there are other cash books, but these are the main cash books, main one. But we also have other cash book. So these three, they are the main levels of cash book. And there is also a cash book that is called the petty cash book. It's also a cash book which is called a petty cash book. It's called a petty cash book because it is used to record petty cash expenses. It used to record petty cash expenses in the business, and those are the ones that form the 4 levels of cash books as far as accounting is concerned. But now let's try to be a little bit broad, to broaden them, to see what is all about these different types. Now, for the single column It's the type of a cash book that has only one column for amounts. If you look at that single column, we shall see the single column cash book. The identifying feature is that it has one column for amounts. You can either have a cash column or a banker column, but you can't have both. Just one. If transactions are going to be on a cash basis, then you are going to have one single column for cash. If the transactions are going to be bank transactions, then you have one bank column that is going to record all the banker transactions. So the single column is that type of a cash book that has only one column for the amounts. And it means that when we say a cash book is a single column, then it is either going to have a bank column or the cash column, and it can't have both at the same time. But you have to remember that transactions could be made from cash in hand or cash at hand, or the transaction could also be made from cash at bank. So for a single column, it's either of the two, but you can't have both. So the transactions that are being made from the cash in hand are the ones that we call cash transactions. Then the ones that are being made from cash at bank are the ones that we call bank transactions. Therefore, when we are preparing the cash book, we always do our best to separate cash transactions from the bank transactions. So these are going to be bank cash transactions, then this will represent the bank transactions. So we need to separate these two. We don't need to mix these transactions whenever we are preparing our cash books. So that's what we refer to as a single column cash book. Now, we have a double column cash book. We have a double column cash book. Double column cash book. A double column cash book. And this double column cash book, the implication is that it's going to be a cash book, is a type of a cash book which has columns for both cash and bank. So it has columns of both cash, it has cash transactions, and then the bank transactions. So we have a column for cash and a column for bank. So those are the ones that we call the double column cash book. Is a cash book which has both columns for cash and bank, meaning that we will be creating two columns for the debit side and then two columns for the credit side, representing cash and banker columns. So whenever you are preparing a single cash book, then you will be using that cash book for either bank transaction or you'll be using it for recording cash transactions alone, but you can't use it for both transactions. And the difference between this cash book is that the column amount, the amounts column is the one that is going to be differing. We may have two columns for amounts on either side of the cash book, on the debit side and the credit side. That will be a double column. When you come to a single column, meaning we shall have only one column on the cash, the one column either for cash or bank, that is going to be handling either cash or bank transactions, and that's going to be that on either side, on each side of the cash book. Then when it comes to the three column cash book, then we shall have three columns for amounts. So when it comes to the three column cash book, it's a bit different. Three column cash book, this one is a little bit different. It has three columns for amounts, three columns for amounts. So we have a column for discounts, then we have a column for cash, then we also have a column for bank, meaning on either side of the cash book we have 3 columns: the discounts, either discount received and discount allowed on either side. So those are basically the 3 main cash books that we have. So the differentiating feature is that for the 3-column cash book, it has both cash and bank columns for both the debit and the credit sides, but with an additional column for recording cash discounts. Here we record cash discounts. So here we take into consideration the discounts that could be received or discounts that could be allowed. A discount received will be from the suppliers, then a discount allowed will be from our customers. We may give our customers some discounts. Maybe they have paid on time, then we'll find ourselves giving them discounts. So that will be a discount allowed. But a discount received is when you buy goods on credit. Maybe you have paid the supplier on time, then the supplier gives you a discount for the goods that you have paid for on time. So they use these discounts. Most of the times they are used as a way of discouraging discouraging credit purchases or credit sales. Because if you give someone a discount, he's going to rush to make sure that he makes a payment. At the end of the day, he will be enjoying the discounts. So these discounts must be for cash, not trade discounts. Trade discounts are those that are going to be dealing on quantities, that if I buy so many, they are going to give me at a cheaper price. Those ones we only record them in the day books, but we don't record them anywhere. We shall see how we are dealing with the trade discounts when we start doing our day books or the other journals that we spoke about. So the 3-column cash book will still have a debit. So the debit side will actually have, three columns. We are going to have a column for discounts, column for bank and cash, and that's all. And that makes the difference between the single column, the double column, and the 3-column cash book. And now when we go to the pet cash book, it's a little bit different. It's different from the 3-column cash book and from the other 3 cash books that we looked at, because the other ones, for them, those first 3 that we spoke about, those ones are the main cash books, but this one is just another cash book, but it's a bit different. Now I'm going to try and take a practical question so that we can be able to understand this, but we are going to do this in the next video. But for now, let's first understand what these are so that we can be able to get to an understanding of what we are going to be doing whenever we go to the practical computations. So I'm just going to illustrate the format, then we shall take the practical question in the other coming videos. So let me begin with the single column cash book. So it's just like I said, a single column cash book has a column for either cash or bank column, but not both on each side of the cash book. So it's like an ordinary cash account or bank account, meaning that even though I'm calling it a cash book, but it looks like an ordinary T account, which has both the debit side and the credit side. It can be like this. This can be a cash book. It has some currency signs there. Then of course this is the debit side. Then this is the credit. But what I want you to understand is that the debit side of the cash book is for cash inflows. Then this is for cash outflows. Or this is the payment side. Then this is the receipt side. Therefore, when cash is coming in, if cash is coming in the business, we debit, meaning we put it this side if cash is coming in. If cash is moving out, then we'll put it this side. But for now, I want us to focus on the double column cash book, because for a single column cash book, it is a bit hard for it to be examined. So what we are going to do, we are going to focus on the double column cash book for now, and after that we shall look at the practical question and we try to solve the double column cash book. We see what we can, so that we can be able to understand the double column cash book or the two column cash book, and from there we shall move to the three column cash book and then the petty cash book. So let's meet in the next video as we are looking at the double column cash book. We look at its format and all that. We take also a practical question. Hello viewers, welcome back to our YouTube channel. Today we are going to continue with our series of financial accounting, and the video we are going to look at today, or the lecture we are going to have, is all about the cash books, and we are going to look at the double column cash book, or what we call the two column cash book. So the double column, the double stroke two column cash book, two column cash book. Now, I'm going to give you a format of a double column cash book, and I want you to pay attention here because this area is examinable. And I said we shall look at a practical question to help us understand how to deal with a two column cash book, and then later on we shall look at the three column cash book. So without wasting more time, let's first understand the format of a double column cash book or a two column cash book. So let's look at the format of a double column cash book. Remember that I explained to you that a double column cash book has two columns each side, where one column is for cash and the other column is for banker transactions, for both the debit side and then the credit side of that cash book. So let's try to look at the format, how it looks like. So we are going to have a cash column, a banker column, a folio column, particulars column, and then the debt column on each side of the cash book. So in simple terms, that's basically the format for a double column cash book. So let's first draw how it looks like. So this is the format of a 2-column cash book. A 2-column cash book. So here we have the date, we have the particulars, or you can call it details, but we prefer to use particulars. We have the folio. We have cash, then we have bank. Then also this side we have date, we have particulars, we have, this is the folio, then we have the cash, and finally bank. Now this side is the debit side, DR. I'm using DR to represent debit. Then this is the credit side, CR. So in this, we always have shillings. In these bank columns, bank and cash columns, we have shillings because we are going to enter amounts. Even here we have shillings, even here shillings. They may be in thousands, they may be in US dollars, whichever currency they have given to you. So probably that's the format of a double column cash book. You can see that I've divided it with this. You are seeing there these double lines that I've put. You can use double line, or you can just use a thick line. So you can see that in this I've separated what we call, I've separated the debit side. In other words, we have the debits and then we have the credits. So you can see that this side, we have the debit side from here up to here. That is the debit side. Then from here to here, that is the credit side. So what is going to be this side are the credits. Then what's going to be this side are going to be the debits. So we have tried to indicate here that we have here a double underline. There is a reason as to why we have put that double underline, because one side is basically a book. It's just a book of cash receipts. Whatever you have received, this side, the debit side, is always a book of cash receipts. You know, a book is always divided into two. You always have this middle part. So this page, if this is page 1, then this one maybe is page 2. So this page 1 is representing a book of all cash receipts. Then this side, the credit side, or page 2, is representing a book of payments. Whatever we have paid is going to be on the credit side of our cash book. Whatever we have received as money that is coming into our business is going to be in the debit side. So that's why we are seeing here, I've named this one debit and this side a credit side. That's one thing you can notice from what we what we have drawn. But as I told you, we have this separate line. You can draw it as a thick line, or you can just use double lines, but the double lines are supposed to be a little bit smaller. But even if you just use a thick line, just to show that you are separating the debit side and then the credit side of the cash book. So this is just a space that we have put there just to show that we have two separate sides. We have separated the two sides, the debit side and then the credit side. Now, what I want you to, or what we are going to do, is that we are going to pick a question. But before we pick a question, we need to understand that this is actually what we call double entry. It's more of a normal double entry. So you have to understand that this is like a normal double entry. It is just that when the transaction relates to cash, we record it under cash column. It is just double entry. But one thing that you need to note is the fact that if let's say you have a transaction that relates to cash, we record it in the cash column. If you are receiving money, but you are receiving it in the form of cash, meaning it is a cash transaction, we record it in the cash column. But the question is this a receipt? Are we receiving money? If we are receiving money, we come to the debit side of the cash book, which is the whole part, this side. Then we ask ourselves, are we receiving cash or we are receiving money in the bank? So if you are receiving cash, then we put it under the cash column. If you are receiving that money, but the person who is paying the money to the business is paying it to our bank, then we put it in the bank column. That's the only difference, but it's more of a normal double entry. So the first question you ask yourself is that, are we making a payment? If we are making a payment, then it is supposed to be on the credit side of the cash book. The second question you have to ask yourself after identifying that it's a payment, the question is, are you making that payment by cash? If it is going to be by cash, then you put it under cash column. If we are making that payment through the bank, then you put that payment on the credit side of the cash book, but in a bank column, because you are using the money that is in the bank to make payment for that particular transaction. So that's what you need to understand. So the particulars, this particulars column, the particulars column will be recording the transaction details. Transaction details. You will be recording all the transaction details of for example, where the money is coming from. If let's say this money is coming from our customer, a customer is buying goods and is paying by cash, then we put the name in the particulars, we put the name of that customer, let's say Ivan. Then we ask ourselves, did Ivan pay us using bank or using cash? If it is cash, then we put that transaction within the cash column. If it is through the bank, then we put that transaction through the bank. If the transaction is going to be on the payment side, we ask ourselves, which person are we paying? Are we paying a supplier? If let's say we are paying a supplier, let's say Chuck's Holdings Uganda Limited, we put there the name of the company, Chuck's Holdings. Then the next thing we ask ourselves, did we pay Chuck's holdings by cash, or we paid it by bank. If you have paid it by bank, then you put that transaction under the bank column. That's how we keep recording these transactions. So for the particulars column, we record the transaction details, where the money is coming from, or where the money is going on both sides of the cash book. So if you look at the folio, I told you this folio column is always a reference section where those transactions can be found. In other words, we always put ledger accounts. If we have seen that maybe we were receiving money from a customer, the question is, where can we find the customers? You find that you'll find these customers in the debtors, maybe contra account, or in the debtors ledger. So it is just a reference section of where we can find this transaction. Remember, all these are more like day books, because we said with the day books, if you follow our previous video, we said day books, we record the daily transactions as they occur. But we said the difference between these other day books and the cash book. The cash book uses double entry. And that's why we said a cash book is the only book that follows a double entry system, hence being a principal book, and at the same time, it is a day book because it records daily transactions that are relating to cash, either cash moving in or cash moving out of the business. However, there is certain thing that you need to understand. There is something that is a little bit different that you need to understand. It is called a contra entry. Contra entry. What do we mean by a contra entry? Anything that we call a contra entry, it happens, it comes when maybe we have withdrawn money from the bank and we are holding that money in cash form, or we are banking the money that we have in cash, then we are transferring that money maybe in the bank. We are banking it, we are depositing it in the bank. So under the double column cash book, or what we call a 2-column cash book, of course, a double column and then a 2-column cash book, that's where we find these double entries, the contra entries. And a contra entry is a transaction which involves both. It involves both cash and bank. It involves both cash and bank movement. It's a transaction that involves both bank and cash movements. Let me call them movements, because money can be in the bank, then we withdraw that money from the bank and we have it in cash form. Or it can be that we have money in cash form, then we deposit that money in the bank. Those are the only 2 possible scenarios where we can have what we call a contra entry. Now, you know that all the transactions that we are going to talk about will either be cash, let's say cash in another account, or they are going to be bank in another account. So when we have a transaction in which double entry would be in both cash account and the bank account, then we call that a contra entry when we are going to have, maybe we have cash that is within, of course, when you have cash and you have it, we say that is cash at hand. If you have cash, but that cash is within the bank, we say that that is cash at bank. The whole idea is that when we are transferring money from, maybe from our cash that we have at hand, and we are depositing that money in the bank, one of the account is going to be reducing and the other one is also going to be increasing in the same transaction. If I had maybe 20 million cash, and maybe I deposit 10 million into the bank is going to increase by 10 million. The bank account balance will increase by 10 million, but my cash at hand will reduce by the same amount. So one transaction, but leads to two transactions happening at the same time. That's what we call a contra entry. So when we are recording, we have to show letter C. But this letter C, we show it in the folio column. That's where we put a letter C to show that this is a contra entry. We put it under the folio column to show that it's a contra entry. We can say that cash is deposited into the bank. That is one way. Or we can say cash that is withdrawn from the bank. And these are the only entries that will give rise to a contra entry. Either you have cash and you have deposited it in the bank, or you have cash that you have withdrawn from the bank. Those are the two transactions that will give rise to a contra entry. Now, remember that I told you that when you are the accountant of the business, if let's say you are the accountant of, let's say, Chuck's Holdings. I'm using Chuck's Holdings because this is our company, Chuck's Holdings Uganda Limited. Chuck's Holdings Uganda Limited. That's our company. If you are the accountant of Chuck's Holdings, the business, if let's say you might be the accountant, or you are a student, but in the question they have given you a company called the Chuck's Holdings Uganda Limited. So if you're a student and you are doing the exam, then you will be referred to as the accountant of the business, whichever business that the examiner has given to you in the question. You will be referred to as the accountant of the business. And there is a very big reason as why I'm saying this. You need to be a little bit careful and you understand my argument. Now, if you are the accountant, if you are doing an exam, you will be assumed that you are the accountant of that business, whichever business name they have given to you in the question. Now, we assume that you are inside the organization or you are within the business. As the student, whichever question they're asking you, they ask you as if you are inside that business name they have given to you. Now, when we say that when we say we are referring to the business where we are working. And when we go, maybe we go and withdraw cash from the bank, maybe for business purposes. If you are the accountant and they have sent you to withdraw money from the bank account, maybe for purchasing or paying some raw materials. So it means that the bank is going to be losing. The bank is losing because you are withdrawing money from the bank. The bank is losing, but you are gaining. As the accountant, you are gaining cash. Cash is increasing. Because as you withdraw money from the bank balance reduces or decreases. So that's why you'll find us, we shall tell you that if you are withdrawing money from the bank, we shall tell you that you are going to be, you debit cash, then you credit bank. Why are we crediting bank? We are crediting bank account because we are reducing money from the bank. So what you have just done is what we call a contra entry, where we have cash at hand and we are going to deposit it. Maybe we are withdrawing money from the bank, and the opposite of it, if you are not withdrawing the money from the bank, the opposite of it will be that you have cash at hand and you are going to deposit it in the bank, which means, so when you have cash at hand and you are depositing it in the bank, it means you are going to debit bank because your bank account is going to increase. You debit bank, then you credit cash because your cash at hand will be reducing. But you have to show that, you have to represent it with the letter C to show that it is actually a contra entry. I'm insisting and I'm taking a lot of time to explain this because I know we are going to find it very often, whether we are dealing with a double column cash book or a 3-column cash book. So in other words, if the only exceptions where we can have a contra entry are scenarios where we have cash and we are taking it to the bank, or we have cash that we are taking out of the bank, and no other transactions will be called a contra entry because the other scenarios can't give rise to a contra entry. So don't be confused with the transactions, how they can state them in the question, but we are going to look at some of the questions and we see how we can best interpret what we have got. Because I know the examiner might frame these questions a little bit different, that will make you think maybe it's not a contra entry. But you have to, what you have to understand, you have to stick to the 2 aspects that I have explained to be able to understand. But the good thing, we are going to have a practical question where we are going to look at more transactions that will include even a contra entry. So let's look at a simulation, or we have an example. So the example says enter the following transactions in a double bracket 2-column cash book. Full stop. These transactions are for the month of January. So January 1st, the first transaction will have a cash balance. The cash balance brought forward. Maybe let me put it here. First, we have a cash balance brought forward, which is 10,900. These are shillings. Then the transaction that happened on 2nd, The transaction that happened on 2nd paid cash into the bank. This is one of the contra entry that we talked about of 8,000. The one that happened on 3rd. On 3rd, we had cash sales. Cash sales amounting to 14,000. On 4th, we had purchased goods. Purchased goods paid by check. $3,600. Then on 5th, we had goods sold. Received the check, received the check. Received the check. The amount is 400. On 6th, we don't have 6th. The question has 8th. On 8th, cash sales amounting to 2,400. Then on 9th, we had paid cleaner in cash. Paid cleaner in cash. The amount was 200. Then on 10th, we had paid for petrol by cash, and the amount is 300. 11th, we had cash sales amounting to 1,800. Then on 12th, we had paid cash into bank amounting to 4,000. On 15th, we had purchased goods paid by check, and the amount is 3,000. On 16th, we had received the check for goods. Received the check for goods. Check for goods sold from John. From John, 2,600. On 17th, we had paid wages. paid wages in cash, and the amount is 600. On 18th, we had paid rent by check, and the amount is 1,000. Then on 18th, on 22nd, we had cash received from Ivan, 22,000. Then on 25th, we had paid cash into bank. Paid cash into bank, the amount is 4,000. And 27th, which is the last one, we have cash received from Stuart, 1,600. So that's the question that we have, that we are going to look at its solution. Now those are the transactions that we are going to enter into our 2-column cash book, and we can see that all these transactions happened in the month of January. So in the column for date, I'll only put January, and if there was a year, then we would also put that one also there. So this is a 2-column cash book. You can call it a double-column cash book. Sometimes you may find other books, they have called this receipts, then payments. But if you want, because of space, I'll remove those ones and I put debit or credit. But just know, if they are called the receipts and the other credit side is called payments, it will be also fine. So this is, I'm just going to call debit. This is a credit, CR. So we have this is the bank column. We have the cash column. We have the small column for folio. Then particulars and the date. Have the date, have the particulars, the folio, then the bank and the cash. So this is date. This is particulars. This is folio. This is cash. This is bank. Have the date, particulars, folio, cash, and then the bank. We always give it in that form. We start with the cash, then the last column will be the bank column. So we've seen that all the transactions happened in Jan. I'm just going to use January 1st. So if we had the year, then we would start with the year, month, then followed by the date. So whatever we have to do is just to enter these transactions. But remember, the opening balance was given to us and was only for cash. So the amount that was given to us was cash balance brought forward of 10,900. You can get a question where they are telling you the opening balances for both cash and then the bank. So they might give you those bank accounts and their bank account for cash and then the bank with their respective balances. And that would be balance brought down to for both accounts. But this one, they only gave us one. So under the particulars, we have balance. So we write balance. Under folio, we put nothing. But under cash, we have 10,900. $10,900. $10,900. $10,900. Then in the bank column, we have nothing there. For this one, you can use just a thick line. You just draw one thick line. Just to show. So we go on the transaction that happened on 2nd. We have done with the balances. Now for our case on January 1st, we said there was a balance brought down and that was only for cash. So we have recorded it in the right way. It is either brought down or sometimes I told you how to write balance brought down. You can use balance. You can put it as it is, but it would mean that it is a balance brought down. If you are provided with the bank balance, you also indicate. Then there is also something to note. There are instances where you will find that the balance brought down is a negative, especially in the bank account. You may find that in the bank column, they have given you a negative value, which would mean that that is a bank overdraft, which means that it's supposed to be on the credit side of the cash book. If the balance brought down was a negative, that would mean that because you can't have a negative cash, you can't have cash as a negative. You can't hold a negative. So if the negative, if they give you a negative value, just know that is a bank column and it's supposed to be on the credit side of the cash book under the bank column. It will be this side if it was a negative. So we are looking at all aspects. So the next transaction, they told us that they paid cash into the bank of 8,000. Now, as I told you, this is a contra entry because we are paying cash into the bank. So there is the double entry that is involved is involving two accounts. It's involving the bank and then the cash. And that's why it's a contra entry. Now, if you are paying cash to the bank, then the double entry will be, you will be debiting cash, you debit cash, then you credit bank. So if you are paying cash into the bank, it's like you are depositing cash into the bank. The double entry would be, the double entry would be the opposite. It will be, we are debiting bank because bank is going to increase. Sorry for that. It would be debiting bank and then crediting cash because we are having cash, but we are transferring that cash into the bank. The bank is going to increase, so we debit bank, we credit cash. But now remember, this is our debit side, this is our credit side. So whenever we say credit cash, then it means you are putting it on the payment side, on this side, the credit side of the cash book. If we say debit bank, we are putting it on the debit side of the cash book. So the double entry, we've said, we are going to be debiting bank account because cash is coming into the bank account, and then you'll be crediting your cash account because cash is moving out of your cash account. But because both bank and the cash account are involved, then we call that a contra entry. So this is what we are going to do. I'm going to put the date. Let me first remove these ones. I'm going to put the date when the transaction happened. That was on 2nd. The transaction happened on 2nd. Let me use a different color. The transaction happened on 2nd, and we've said that we are debiting bank with 8,000. So we are debiting bank. And because we are debiting bank, then it will be in the name of cash under the particulars 8,000. Why are we putting cash? Because this is where the money is coming from. We are using cash to deposit money into the bank. So we are debiting, but it's going to be in the names of cash. So remember the double entry for real accounts. We talked about real accounts. So the bank is receiving money in the names of cash, and then I'll come to the credit side of the cash book, or the payment side, which is the credit side, this side. Then on the same date, this is Jan 2nd, we are crediting cash. We are crediting cash. So what we are going to do, it is going to be on the same date, but under particulars, I'm going to put bank. Because this, we are losing money to the bank. This is the payment side. The credit side is always the payment side. That's where our money is going. So our money is going into the bank. Here, we are receiving money in cash form and it is going into our bank account. Here we are losing money. The cash we have, we are losing it to the bank. So in the particulars, we shall have the bank, but I'm going to be crediting the cash column with the same amount, 8,000. I hope now you're understanding the logic behind these contra entries. Now, what is left for us to do is to indicate that this is a contra entry under the folio. You put a letter C, even this side you put a letter C. So we have used a particular bank here, but we are putting the amount under the cash column because it's the cash column that is giving away money to the bank. Remember, this is our receipt side. So this side is receiving money, but this one is losing out money to the bank. This one, the bank account is receiving money from the cash account. I hope you have understood that. That's the same treatment that we shall be doing whenever we have a contra entry, whether it is under the double entry or under the 3-column cash book. Then we go to the next transaction, we have cash sales. We made a cash sale of 14,000. Now, cash sales, it is an inflow, money is coming. So money is coming into the business. So the question you have to ask yourself, are we receiving, is cash coming in or cash is moving out? Is it an outflow of cash or an inflow of cash? That's the first question you have to ask yourself whenever you see any transaction. So here we have a cash sales. So the question we are asking ourselves, is cash coming in or cash is moving out? And we can see that for a cash, we know that for real accounts, this is double entry. For real accounts, when you look at the cash sales, if you look at cash sales, just forget about the idea of a sales aspect. But what I want you to focus on is whether money is coming into the business or it's moving out of the business. And we, the students, we are assumed to be the accountants, so we need to know whether cash is coming into our business or it is moving out of our business. So when you sell goods for cash, then it means that cash is going to be coming into the business. And once cash is coming into the business, then the double entry is debit the cash that is coming in, because the debit side is for receiving, or the receipt side, or the inflow side of the cash book. That's where we record all the inflows. So we are going to debit, and the date it happened on 3rd. Let me try to use a different color. It happened on 3rd, but the entry will be in the names of sales, because where money is coming from, we made a sale. Now, the sales that we are writing in the particulars, we are writing it because that's where the money came from. In the particulars column, we put sales, and it's on cash. But other questions, they may tell you, we've received maybe 50% cash, then the other balance was paid by check. So here, all the amount was paid by cash. There is no bank aspect or check aspect. The amount that was involved was 14,000. So I will record the whole 14,000 under the cash column because it's by cash and not by check or bank. But if they had deposited the money in our bank account, then we would record that sale under the bank column of the cash book. But because it's cash, then we debit under the cash column. So what we are trying to do is that we are trying to separate cash and bank depending on where or what type of payment we made or what type of receipt we have made. So we bring the whole amount, the 14,000, the entire 14,000 is coming to the cash column. In the bank column, we have nothing. And the next transaction happened on 4th. They say they purchased goods paid by check. Now, this time it's a purchase and we are paying. So it's going to be a payment, or it's going to be on the credit side of the cash book, because it's only the credit side of the cash book that records the payments that we have made. But the amount is 3,600 and we are paying by bank or by check. And since we are paying by check, it means it's coming under the bank column and not under the cash column, because the money we paid was from our bank account. Therefore, the transaction that happened on 4th January, it's a purchase. That's what we are going to put under particulars in the particulars column, and it's going to come under the bank column as 3,600. So the transaction happened on 4th, but under particulars we have it's a purchase, but it came out of our bank account of 3,600. If they had split it, maybe the purchase was made maybe 20% by cash and 80% by bank, then we would have split that amount in that same order. I hope you are getting the whole idea, because if you don't get it, then we are going to have problems. For the start, we can indicate these dashes, as you are seeing me indicating dashes here, but you don't need to indicate the dashes as long as you know what to do. But for the start, we want to go and implement that because we are doing it for the first time. But as time goes on, we shall keep changing. So that now the next transaction that we are going to do is on the 5th. They told us goods sold and received check. So the same goods sold is also a sale. We have made a sale, but this time we are receiving money by check, and the amount is 400 shillings. So on 5th, the same sales, that's the name that we are going to indicate in our particulars column. But this time round, because we are receiving money by check, then it's not coming under the cash column, but it's going under our bank column for the whole amount of 400 shillings. So that will be a sale by check. This happened on, let me change also the color. This happened on 5th. And in particulars, we are putting it is a sale, but we received that money through the bank of 400 shillings. It wasn't split. And now the other transaction, we were told on 8th that there was cash sales of 2,400. That's cash sales, which is also debited. So on 8th, it will be a sale again, but because it's cash, then it is coming under the cash column as 2,400. So this is a very simple topic for you to handle, because you just have to know where are we putting the figure. But as long as you know whether it's a payment or a receipt, then you can also be, and at the same time, you know how to distinguish between whether a transaction is on cash or it's a banker transaction, then you'll be good to go. So the transaction happened on 8th, and it's cash sale. So this one is, we say it's a sale. This time we are receiving the money in cash of 2,400. And now the other transaction that happened on 9th, they are telling us they paid the cleaner cash of 200. So we paid the cleaner, and once it's a payment, then it comes straight to the credit side of the cash book. And in the particular column, we shall say, of course, within the particulars column, we shall say it is a cleaner, because this is where we are spending the money. The money is moving out to pay the cleaner. So the narration or the detail where the money is going, it's to the cleaner. And the column that is losing the money to pay the cleaner is cash column. So we shall put the whole 200 within the cash column. So the transaction happened on 9th, and we are paying the cleaner, but the whole amount was from cash 200, no banker entry. So we move on. When we move to 10th, they told us they paid petrol by check, by cash, 300 shillings. So since this is a payment that happened on 10th, in particular, we shall put petrol, because they are buying petrol maybe for the vehicles. And the amount is, the amount that is involved is 300 shillings under the cash column, because they are paying that amount by cash. So this is the same thing that we are going to do. We repeat the same thing until we finish all the transactions. So this one happened on 10th, and they are saying they paid the petrol, and the amount was 300. It came from cash, not bank. So we can conclude, we can finish all the items. So this one was on 10th. Then the transaction that happened on 11th was relating to sales, and there were sales of cash. So we received the cash sales, and the amount was in cash. It is 1,800, no banker entry. Then on 12, we paid cash into the bank. This is a contra entry. On 12th, we had a contra entry. We paid the cash into the bank, meaning our cash was moved into the bank. It is the same transaction like the one that we just did for that happened on 2nd January. Paid the cash into the bank, meaning our cash is going to be losing. We are losing cash, but we are losing it to the bank. So we are debiting bank, then we are crediting cash. So what we are going to do, we are going to have a contra entry. Here we are debiting bank, but it is going to be in the names of cash. we are putting that money into the bank of 4,000. The amount is 4,000, but the moment you realize it is a contra entry, you put a C, the letter C, under the folio. This is a C. It happened on 12th. But here, under particulars, we are putting bank because that's where we paid the money from. 4,000 under the cash column. Let's finalize the entire items. Because what I'm more interested in, you can go ahead and put all those that are remaining. What I'm more interested in is for me to show you how we balance off. Let me delete, but make sure you complete all these that we did not complete, all the transactions. Me, I just want to show you how we balance off. So once you are done with all the entries, once you are done with all the entries, then the next thing that we want to do is balancing off the account. Now, what we want to do, I want to walk you through what we go through when we are balancing off a cash book, and I need you to pay attention as we walk through this. So what we are going to do, we are going to leave like 2 lines. You leave like 2 lines if you are using, maybe you are using a book, because we don't know where the balance is. The balance carried down will be on both sides. The side for the debit and then the side for the credit of the cash book. But once you have left enough space, then we can rule off. By ruling off, I told you, you'll be able to put the totals in both columns. You rule off the bank and then the cash column. Only those 2 columns, both on the debit and then the credit side of the cash book. So we rule off this, but remember I told you to leave some space. Maybe that's enough. We can rule off like that. That's what I'm meaning by ruling off. You close off, and the next thing that we want to do is to get the total. Now, we need to balance off these accounts, but we need to balance each of them separately. So you have also to try and combine, you combine all these figures and you add them up for each column, the cash and then the bank columns. So I don't want you to get confused. So let's try to combine them and we balance off the cash column first. And afterwards, then we shall balance off the bank column to avoid messing up. So we are going to start with the cash column and we want to add up everything that is in the cash column. We start maybe from the debit side. We start from the debit side, then we add up everything, including those that I told you to fill. So you will see that the cash column, if you have balanced it well, it has a total of of 52,700. It is 52,700. 52,700. So it will be, you will see that the 52,700 is the total, the highest. So you add up the debit side, and we get the totals. So once you have added this side, you add this and then this side, you choose the one that has the biggest total. And the one that has the biggest total is the one that has 52,700. So we make that 52,700 to be the entire total. The debit side that has 52,000 is the one that is taking the overall total. For the cash, even this side we shall have 52,700. Then we take where is the balance brought down, the balance carried down, which side has the smallest. You get this total, the 52,700, you deduct from the other small figure. You will see that you'll have a balance, but remember this is happening at the end of the month, 30th June. So this is balance carried down. For the cash, we have 35,600. So when you add the whole of what is in the cash column, it must be now totaling up to this after adding this balance carried down. You do the same thing for the bank. You come under these bank columns, you add the total of this, you also add the totals of this. Once you are done adding them, you pick the total that is the highest. The highest is 19,000. 19,000, that will be the total for both columns. Then you also take this 19,000 minus the other smallest figure, you'll have a balance carried down of 11,400. Meaning the debit side was all bigger than the credit side. So this is a balance carried down. So balance brought down will be this side. So we shall have this balance brought down of the same amount. This one will come to this side, and this one will come this side. This is 11,400, and this is 35,600. That's how we balance off a cash book. So we are going to do more when we go to the 3-column cash book, and we'll also see how we can balance off when we have included another column for discounts. Hello everyone, welcome back to our YouTube channel, and today we are going to continue our sessions on cash book, and we are going to look at the 3-column cash book, because we have already looked at the 2-column cash book, and we also explained what single column cash book was all about, and we want to focus on what exactly the 3-column cash book is all about. The 3-column cash book. Three-column cash book. Now, the difference between the 2-column cash book, the 2-column cash book, and the 3-column cash book, the 3-column cash book, is that this 3-column cash book, this 3-column cash book has a discounts column. Discounts column discounts column introduced. That's the only difference. It has a discounts column introduced in the 3-column cash book. There is introduction of the discounts column both on the debit side of the cash book and the credit side of the cash book, as well as the other items as we saw them. So the rest are the same, and we do all of them in the same way, like we've been doing the one for 2-column and then the one for 1-column cash book. We do the same entry. They all follow the double entry system, but the only difference is that we introduce in what we call the discount allowed and then the discount received. The discount allowed, which is an expense, and then the discount received, which is an income. Discount received, which is an income to the business. This is an expense to the business, and this is an income to the business. That's the only difference. So the rest are the same. We have the bank column, we have the cash column, we also have the folio, we also have the particulars column, and then the date column. But the only part, or the only thing that has been introduced in this is what we call the discounts column on both sides of the cash book. However, the discounts column, the one that is on the debit side, the one that we have on the debit side, we have what you call the discount allowed. That's an expense. The discount allowed is an expense to the business. And then the one that is on the credit side of the cash book is what we call the discount received. The discount received is the one that is on the credit side of the cash book, and we are going to look at the meaning of these two. But this is generally the difference. However, this generally means that there could be situations where we are making payments either by check or by cash, but we may be granted discounts, or we might grant discounts to our customers. The discounts that we give or we grant to our customers are the ones that we call the discount allowed. And then the discount received is the one that we receive from our supplier. The company is receiving discounts from the supplier. Maybe they are buying in bulk, but you have to make sure that these are actually cash discounts. Because remember, we talked about the types of discounts, and we said we have what we call the trade discounts and then the cash discounts. Remember, when you're dealing with the cash book, we only look at cash transactions. So these discounts involve cash movement. If, let's say, you were supposed to pay 10,000, but they gave you a discount and you have paid, maybe you have paid by cash, and the supplier gives you a discount and you pay 8,000. That difference of 2,000 becomes a discount received from the supplier, which is an income to the business, because you would have paid 10,000, but the supplier allowed you or gave you a discount, and you earned, maybe you paid by cash or you paid promptly, and maybe the examiner, the supplier says you pay 8,000 since you are paying by cash. So that amount is going to be an income to the business. Otherwise, you would have paid it if there were no discounts, see, given to you by the supplier. The same thing can happen to us, the business, when we are selling our products to the customers. Maybe these customers, they wanted to get a credit. They wanted to buy things on credit, and we tell them, as part of cash management, we tell them, if you pay cash, then we are going to pay less. And maybe the goods which were worth 20,000, we tell them you pay 18,000, meaning that 2K will be a discount that we allow or that we have given to the customer. To the customer, it will be an income to them, because they, otherwise, if the discounts wasn't there, the customer would have paid the 20,000. But since you have given them a discount, the 2,000 becomes an income to the customer, but it is an expense to the business. Otherwise, we would have received the 20,000, but we ended up receiving less by 2,000. So that becomes an expense to the business. So you have to understand. So the reason why the discounts on the debit side of the cash book, they are called discount allowed, is because when you grant discount to the customers, or when you allow discounts to your customers, you are making, maybe when they are making payments to the business, and once they are making payments to us, it means that we are the ones receiving the money to them from the customers. So we debit the receipt side with the discount, and that's how it's going to be. So what we are doing here is we are going to get the format of a 3-column cash book, but in fact there is no much big difference like the ones we've looked at in regards to the 2-column cash book. But what I'm going to do over here is to show you the format straight away before we look at the practical question, so that we can help ourselves understand. But there is nothing that is going to be unique. The only unique column that we are going to introduce on both sides of the cash book are the discount, and the one that is on the debit side is the discount allowed. The one on the credit side is the one that we call the discount received. So straight away, let's look at the format. Three column. Just as the name suggests, we are having 3 columns. 3 columns on either side of the cash book. Still have that middle part representing that we are showing it's a book. If you go to, if you have ever worked to this local government, those local governments have those local cash books where they used to write the information before they digitalize. I think now they are using IFMS. That's the system local governments are using. But before that, they were doing things manually. They were recording the cash that they have paid out, because even previously they used to pay salaries to the workers and they pay in cash. So that's why those earlier days, they used to have those different cash books where they could put all the transactions. So let's start. This is the debit side of the cash book. This is the credit side. We said the debit side can also be called the receipt side. And then the credit column is credit side can be called the payment side. Don't forget those ones. If you look, because you might look at some books or different textbooks that are giving you information and you start wondering what they are talking about. So even if you see it's a payment or receipt side, just know, as long as they don't interchange, as long as they don't call these payments, they are supposed to be in that form. So we have the bank column, we have the cash column, we have now the other column, which is the discounts. And then we have the folio. We say the folio is always small. Then you have the particulars plus the date. We do the same on the credit side. So we have the one for date, have the one for particulars, folio. Then we have the discount. Now this is the discount received. Then we have the one for cash and then the bank. So this is date, particulars, this is folio, this is discount, this is cash, this is bank, this is date, this is particulars or details, this is folio, this is discount, this is cash, then bank. That's the format. Of course, in here we have shillings, 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 even this side the shillings, because the discounts are also going to be in shillings. We say this is cash. They may be in thousands depending on the figures they have given to you. And we said when you are writing the date, we start with the year. If it's let's say 2025, maybe January 1st. The same thing, 2025, Jan 1st. Then you proceed. So now, having looked at the format, as I said, there is always a double line in the middle of the cash book. And the reason why we put a double line is because we want to show that we have a book of cash receipts and a book of cash payments. And we are trying to join them together. Therefore, there is a double line in the middle showing the joining together of the two books. So each side of the book will have the date, will have the column, will have the particulars column, will have the ledger folio, will have then the three columns of discounts column, cash column, and then the bank column. And that's what we would call the three-column cash book format or layout. So we are now going to solve a question that will help us to understand better, because we have already familiarized ourselves with the two-column cash book, and the only introduction that we have introduced in the three-column cash book is the discount column, which I'm going to teach you on how to go about it. So without wasting more time, let's look at a simulation. We write down the question and we solve it so that we can help ourselves to understand how we can go about the three-column cash book. So simulation. They are saying the following information. Someone said I write badly. The following information relates to ABC Limited, ABC Limited for the month of January. So let's start with the transaction. It's January 2nd. Started business. Started business with, these are US dollars. Started business with 60,000 US dollars in the bank. Then the transaction that happened on 3rd, withdrew cash from the bank. This is a contra entry. Withdrew cash from the bank for business use. For business use, these are US dollars. They are saying withdrew 40,000 US dollars. We continue on 4th. On 4th, the following paid ABC Limited by check. The following paid ABC Limited by check. Have semicolon. We have Godwin paid 18,000 US dollars. Comma, Sule, the US dollars were 8,500 US dollars, and Mohammed 5,000 US dollars. Full stop. All cases subject to 10% cash discount. Full stop. The other transaction happened on 7th. They are saying paid the following by check. Semicolon. They are continuing deducting 15% cash discount. Cash discount in all cases. In all cases. Of course, now the cases, we have Badil, paid 9,500 US dollars, comma, Linda, the amount is 7,700, and Stuart, 6,000 US dollars. Full stop. Then on 11th, paid Daniel his account of US dollars 10,500 by cash less 1,500 US dollars less 1,500 US dollars cash discount. Full stop. That's all that we have. So you can pause the video and be able to write down the question. So let's look at the solution. So let's draw the 3-column cash book. This is the bank column. That's the cash column. Then the discounts column. Of course, the particulars. The particulars column and the date. Let me not forget the folio. So we have the date, have the particulars, we have the folio, we have the discounts, have the cash and the bank. This is 3-column cash book. So have the date here, have the particulars, have the folio, have the discount, have the cash, and then the bank. This is date. Have the particulars here. You have the folio, have the discount, have the cash, and then the bank. Of course, this is the debit side, DR, then the credit side. Now, of course, all these are in US dollars. Now, the first transaction is on January 2nd, which says started business with 60,000 US dollars in the bank. Now, if you started the business with 60,000 in the bank account, and you know that the double entry for this is credit the capital account and then debit the bank account, because the money into the bank, the money is in the bank, but we are not opening any capital account here. So it means that over here, when you are preparing the cash book, you have two questions to ask yourself. Is cash coming in or cash going out? If the cash is coming in, then it's an inflow or receipt of cash. That means you debit it. And if it is an outflow of cash from the business, then you credit it. So if the business owner started the business with 60,000 US dollars, it means that 60,000 US dollars is coming into the business but remember this amount was deposited in the bank. So since it is an inflow of cash, it is coming into the bank account. So we will debit the bank column of the receipt side of the cash book as 60,000, and it will be in the names of capital. And the reason why it is in the names of capital is because capital account will be the corresponding entry if we are to do the double entry. So we go on the debit side, we look at, it started on January 1st, Jan 1st, under narration or details, we have capital, and it came into the bank account. So we have the 60,000 US dollars. You can take off the 3 zeros if you want. Let me remove this one space so that I can get a bigger space here. This is 60,000. That is 60,000. That's the amount we started with. The second transaction says it happened on 3rd. They are saying withdrew cash from the bank for business use of 40,000 US dollars. Now, withdrew 40,000 US dollars from the bank for business use. This means that this is a contra entry because it's cash from the bank account. When cash is coming in, so we are going to have cash coming into our cash account, but we are picking that money from the bank. So the bank balance is going to be reducing. So the entries, we are going to be debiting cash and then credit bank. So we are going to debit the cash account in the names of bank because that's what is increasing the cash account. So on 2nd, we had bank, and the amount they told us is 40,000. But since it is a contra entry, we put a letter C. Then on the same date, this is Jan 2nd. It is Jan 3rd. It is 3rd, not 2nd. The 3rd of Jan. Now this side of the payment side, since money is coming from the bank into our cash, what we are going to do, we are going to credit the banker column in the names of cash. So in the particulars here, we say cash. You don't get confused with this. Money is coming from the bank. Same amount, 40,000. We include in the folio that this is a contra entry with the letter C. So that's what we were supposed to do for that. You have to be careful when it is a contra entry because when it involves both cash and bank, it means it is a contra entry, and that means we are going to have double entries for the transactions, both in the bank account and then the cash account. And then we finalize with writing letter C in the folio to represent a contra entry. So there are only 2 transactions that can result into a contra entry, either cash from the bank or cash to bank. The next transaction that happened on January 4th, the following paid ABC Limited by check. These are people who paid. The following paid ABC. Now, we have Godwin, we have Sule, we have Muhammad. But all the cases are subject to 10% cash discount. Of course, here, there is discount that is involved. And this is where the essence of the 3-column cash book comes in. Apart from the discounts, all the other entries that we are going to enter, they are the same, like the ones in the 2-column cash book. So the moment we reach the discount, we need to be very careful and know what we are supposed to do. So I'm going to spend a little more of my time explaining how we treat the discounts. The other aspect, since they are the same, I'm not going to spend much time. Once you understand how to enter the discounts, then you'll be good to go, because the rest will be the same, just like the way we did the double entry. And I'm also going to change, maybe I change the color for this one. So the one that happened on 4th, they are saying that the following paid by check to ABC Limited, which is the business. Our business is the ABC. That is the business we are dealing with. And it's going to be a cash receipt, because it's people who are paying the business and not the company paying them. If it was ABC paying these people, then it would have been maybe these were suppliers, and it would have been on the payment side or on the credit side of the cash book. But it's the people or the customers that are paying the ABC Limited. So this is going to be a cash inflow. Cash is going to be coming in, and we are going to debit the different accounts. Whether they paid by cash or bank, we are going to see. So Godwin is paying 18,000. Sule is paying 8,500, and Muhammad is paying 5,000 US dollars. But we are told that in all cases, there is a 10% discount of cash. If it was a trade discount, then we wouldn't include it, because it's trade discounts are not supposed to be included in the cash book. So since all the payments are made by check, then we are going to put all these payments in the bank account, on the bank column. But we need to take the discounts into consideration. We need to less off. Remember, these were customers that were given discounts. So it's a discount allowed. The business lost money because it gave discounts to the customers. So if they say Godwin paid 18,000, but we have to deduct the 10% discount, cash discount of course, the 10% of the whole figure, the 18,000, will be 1,800. So we take off that, and then we shall be left with the 16,200 to be debited in the bank column. And then the discount of 1,800 will be also shown on the debit side in the discount allowed column. And that's how we make an entry that is involving discounts. So we are going to do the same thing for all the people that are paying the company. So we come here, the date is 4th. So since it is a 4th, and they are saying that these are payments, these are customers that are going to be paying. So we start with Godwin. Godwin, we've said that he paid in total 18,000. That's what he was supposed to pay, but we received a discount of 10%, and 10% of 18,000 is supposed to be 1,800. So 1,800, then the balance, but remember all the money was through the bank. So the 16 200 is supposed to be in the bank column. So we do the same for all these other customers that paid. So you've seen that we have splitted the 1,800 that was received as the 18,000 that was received in total. Because if you add this plus this, you get to 18,000. We have split it into the discount because this is the money that came into the account of the bank. This one is going to be treated as an expense if you are preparing financial statements. But I also need to remind you that the only discounts that we consider in the cash book, they are supposed to be cash discounts. If these were trade discounts, then they wouldn't appear in the cash book. These trade discounts will only appear in your day books, or what we call the journals. We saw how we prepared those ones, but will never appear anywhere in your financial statements. The trade discounts will never appear anywhere, even if it is in income statement, balance sheet, or cash flow statement. They will never appear anywhere. They will only appear in your day books. So we are only considering the cash discounts alone. So let's now do the whole entries for the people. We have Sule, 10%. Of course, he contributed. The whole amount was 8,500, and the 10% of that is supposed to be 850. Then 850, of course, you get the other 8,500 minus the 850. You remain with 7,650. Once you add this plus this, you must be getting the other total that would have been paid. Then we go to Mohammed. The whole amount was 5,000. 10% of it is 500. So meaning the balance is 4,500. So we have to do the same thing that happened to the other people. So we do the rest. The transaction that happened on 7th, they are saying paid the following. It is now paid the following by check. It is the bank it is the company that pays these people by check. So they paid Badlu, they paid Linda and Stuart. That's the money that was paid to those people, meaning these were suppliers. It is the company paying to them. So these were payments, and they are supposed to appear on the credit side of the cash book. They happened on 7th. So on 7th, we have Badil, we have Linda, and then Stuart. But they told us that 15% cash discount on all cases after deducting. So the company ABC received 15% cash discount from these people. So Badilu, the total amount was supposed to be 9,500, but since this person gave us discount, we get 15% of the 9,500. That will give you 1,425 US dollars. So this will appear here, 1,425. Then what is the amount? Remember, they paid them by bank. So we are going to put everything in the bank column, the balance. So we get the 9,500,000 minus 1,425. That will give you 80.75. Then we'll do the same for Linda. Linda, the total amount was 7,700 times 15%. 15% of the 7,700 is giving you 1,155, and the balance is 65.45. $65.45. And the one for Stuart, the total was 6,000 times 15%. That gives you 900. You put it in the discount. This is the discount received. So you get 6,000 minus the 900, which gives you 5,100. These are all US dollars. Then the final transaction happened on 11th. On 11th, they told us, paid Daniel his account of 10,500 by cash, less 1,500 cash discount. They are saying paid, meaning it is the company which paid Daniel. So Daniel is also a supplier. That's why we are putting it on the credit side of the cash book. So we put Daniel as well. But here they are the computer. They never gave us the percentage. They gave us the actual discount. So the whole amount, his account amount was supposed to be 10,500. But this amount was supposed to be less by 1,500. So the 1,500, that is the cash discount. Then the balance, of course, 10,500 minus the 1,500, that gives you a 9,000. But this one was paid by cash. So it's supposed to be in the cash column here, 9,000. And that's all. So now we are going, we having finished everything, we are going to balance off the accounts. This is where I want you to understand. You are going to allow me to first delete off some figures I get to balance. Let me delete these ones. I get space for balancing this. Hope you have seen the values. So let's go on to balancing off. We said we only balance off the items that have values. So after completing all the entries, we balance the account, or we balance off the cash book, because that's basically what I want you to learn, especially when we have recorded discounts, because the rest of the things will be the same as we did under the 2-column cash book. So let's balance off, and when you're done, we shall call it a day. Now, as usual, you leave a 2-line for both sides because we are not sure where the balance carried down will be. So when you leave 2 lines, of course, you come and rule off the totals. So we just put a double underline to show off that we have closed off the accounts. So we come here. Don't forget that these ones, we deleted off some values just to create space. Now, that's the ruling off. So for discounts, we don't have to balance. In other words, even if we balance, we don't need to have balance carried down. Anything to do with balance brought down or balance carried down, we don't need those values for discounts. That's one thing you need to note. We just add them up and then we show their totals on both sides. So for discount allowed, the total value is 3,150 US dollars. You have to remember that we deleted off some values. So this one we just show it is 3,150. The discount allowed. That is supposed to be taken to the income statement as an expense. We shall know how to prepare income statements. Then the discount received, the balance, the total is 4,980. Please don't ever bring in things to do with balance carried down, balance brought down for the discount column. Now, we can now come to the cash and then the bank columns. And just like I told you in the double entry book, double column cash book, that balance each column separately. So we begin with maybe the cash. So we begin with the cash. So we first, we are going to begin with the cash column. Once it is done, then we shall finish off the bank column as well. Now, for the cash, we can see that we have one entry on the debit side and one entry on the credit side. So we just pick the bigger number. You are seeing this side we had 9,000 on the payments. That was on 11th. But this one we have 40. So we take the 40 to be the total for both. Let me change also the color, because I need you to understand this. So this is 40. 40. That is going to be because it is the biggest, it is going to be the whole total for both columns, as long as they are for cash. Meaning this side was smaller than this. So the balance carried down is going to be this side. So we'll come and bring in, remember we are closing at the end of the period. January ends at 31st. So this is going to be 31st. This is our balance carried down for cash. Here we don't put for discounts. Then we get the difference. 40,000 minus the 9,000. It will give you 31,000. So this one, 31,000. 31,000. Then the cash column is done. Then we go to the bank. So that balance will be the balance carried down on the credit side, which is the smallest amount that once added to this balance carried down, it will be giving us the total balancing figure of 40,000. But now, as you know, the balancing rule, that what is on this, the balance carried down will give a rise to a balance brought down. Now this is going to be first, which month? Feb, because that is the next month. So it will be first Feb, and this will be a balance brought down. This brought down, you can put it under folio if you want. Inside here, particulars, you just put balance. For this one, it is going to be the same amount, but on opposite direction, opposite side, 31,000. And we are done with that. Then we balance off the bank account. So the same thing that we have done on the cash book, on the cash column, is the same thing that we are going to do on the bank column. So we add up this bank column and this bank column, which we add the totals of each column, and then we compare which column has the highest. It is very possible that this one, the balance carried down for the bank column would be this side and the brought down would be this side. It is very possible. So don't assume that it is always going to be that one side is going to be having the balance carried down. No, it can be interchangeably. So we are seeing that the highest value is 88,350. That is going to be the whole total for both, meaning the debit side is bigger than the credit side. So this one is 88,350. So since this one is bigger, so we get this total. Then we less off the total of the other smallest total. We get the bigger total minus the smallest total. When you do that, you get this as 28, the balance carried down, 28,630. So since it is carried down this side, it is going to be brought down. You don't write it again, you just put the figures 28,630, and you are done. That would be the end of that. And that's all. That's how we do a 3-column cash book. So under these cash books, the only cash book that we are left with, it's going to be the pet cash book. So once we are done with the pet cash book, then we shall finalize with the bank reconciliation, and we sort everything to do with the cash books.